StudyIQ IAS, अब तैयारी हुई अफोर्डेबल.
Hello everyone, my name is Ankit and from today onwards we are starting a new series which will involve us solve each and every prelims year's question from the year 2024 and we'll go back in time till the year 2013. Now the purpose of this series of videos is to help you analyze the PYQs in a better manner, understand the concepts and help you integrate the subject matter knowledge into your practical application, which you will eventually use in your prelims examination, which is scheduled on 25th of May in the year 2025. Now, in a series of video that we have put up recently, I highlighted the importance of following prelims previous year question and how it helps you understand the evolution of the exam, helps you separate important topics from the not so important ones. And also understanding the thinking the UPSC undertakes while framing a question will help you understand the current affairs even better. So, without wasting your time, let me first start with the prelims economy section questions, and this will be the questions related to the year 2024. Now we start with the first question and probably the most difficult question in the economy paper last year. It says, consider the following statements. Now the statement 1, it states, if the United States of America were to default on its debt, the holders of US Treasury bond will not be able to exercise their claims to receive payment. Okay. Now this news or this question was asked maybe because last year there was this debate because the budget of the United States government was not passed in its own US Congress, and that led to a clash between executive, that is represented by the president, and legislature, which is represented by the Speaker of United States. And whenever the budget is not passed by the US Congress, it will lead to a breakdown in financing of the US government, which can on a larger case lead to US government defaulting on its own repayment obligations. Now to understand this statement, we need to first understand the term exercising their claims. Now what is exercising their claims? Now you understand bond is a debt instrument, which means the bond issuers, they issue the bond in the market and in return of their bonds, they receive certain amount of money. Now the bond states that after so and so years, the issuer of the bond will pay the principal amount in addition to the interest income also. So bonds are a form of debt instrument. And naturally, if a bond issuer goes back on its own word, that is, they are not returning the debt, it means the bond holders are able to exercise their claim. Now the word here, exercising their claim, means reclaiming their own money. Now this exercising of claim works differently for say corporate sector and it works differently for the government sector, because even legally it is said in the laws of our country, even including India, that corporate bond issuers, if they were to default on their obligations, the bond holders, that is people like you and I, are eligible to exercise our claim, that we can go to court and demand the court to pass a judgment ordering the bond issuing company to repay our debts. So this is what you can call is the term exercise of their claim, that it is a legal obligation on the bond issuers to repay the payment back to the bondholders. Now I told you this example in form of corporates of any country. But is the same exercise of claim valid on the governments of the country? The answer is no. Because the government, you can say, enjoys what is called as a sovereign immunity. That is, for any government's own function, they are not liable to be answerable to the courts. And the courts cannot prosecute the government for any wrongdoing. And that is applicable inside their own sovereign territory. So, the bondholders, they cannot legally exercise their claims on the government. Now, this was the logical or legal argument. I will tell you another practical argument also, that to exercise their claim, more often than not, the bond holders, they demand that the bond issuer's property needs to be sold. That is, in case if it's a corporate, their factories, their land should be sold, and the money recovered out of that proceeding should be given back to the original bondholders. But do you think it is possible for anyone to claim or to ask the government to sell its own property? Can you demand that Rashtrapati Bhavan should be sold, or the Supreme Court of India or Parliament of India should be sold to repay your debts? Not right. So this is why, even in practical terms, exercising the claims over government bond defaults is not possible. So even if you are not aware of the legal background of the knowledge, by quick thinking on your part, you could have solved this statement 1. So the statement 1 here is correct. That is, the bondholders are not be able to exchange their claims to receive the payments in case the United States government defaults on its loan. Now moving to the second statement. The USA government debt is not backed by any hard asset, but only by the faith of government. Again, this statement here is correct. And why am I saying so? Because the government of United States, or for that matter any government, previously they had some amount of gold stored in their own treasury which was able to exercise their claims. But after many countries have moved away from the fixed exchange rate system and the gold based order, now the obligation of any government to repay the loan back is based on its own sovereign promise. That is, the government, for that matter United States government, it has world's largest economy at its disposal, it has world's largest military at its disposal, and that is the sovereign might of United States of America, and this sovereign might lends itself in a form of promise to the bond issuers. So the second statement here is correct, that US government debt is not backed by hard assets, rather it is backed by sovereign promise of the government of United States. Now, which one of the following is correct in respect to above statement? The option A here is correct, because if you add the word because after second statement and combine the second statement to the first, the statement makes a logical sense. Understood? That is why option A here is correct. Now, for the ones who want to have an explanation, I have provided an explanation in this side, and you can download it or read it after the session ends. Okay. Now let us move to another question. Now this question is also a two-statement question like the previous one. Consider the following statements. Now syndicated lending spreads the risk of borrower default across multiple lenders. Whereas the statement 2, it states that the syndicated loan can be a fixed amount lump sum of funds, but it cannot be a credit line. Now this question is about syndicated lending, which the banks and other financial institutions often resort to in case of whenever a large company is demanding a large amount of funds. Now, in the process of syndicated lending, the lender, which is almost invariably a multinational company, sorry, he is not a lender, a borrower, which is a multinational company, approaches a bank or a financial institution for the firm, and if the amount demanded by the borrower is quite high, so in that case bank 1 or the original bank acts as a nodal bank, and this bank may approach another banks to get it involved in what is called as a syndicated lending. That suppose the borrower was demanding rupees 100 crores from the bank called SBI. Now, naturally, 100 crores is a very big amount. So, any bank would be apprehensive of lending this amount to any corporate, be it a big and reputed company also. So, the SBI would say that, okay, I'll be lending you 50 crore rupees, but the rest 10 crore rupees, 20 crore rupees and 20 crore rupees will be supplied to you by another banks. So, this is an example of syndicated lending. That is, you first of all approach a bank and that bank on your behalf approaches another banks, which then involves the process of syndicated lending. Now, originally, the borrower has to approach only just one bank for that matter, and the rest of the paperwork will be handled by the bank themselves, and the borrower will only be signing one document with the nodal bank. Now, the reason for undertaking or in getting involved in a process of syndicated lending is naturally to diversify the risk. What happens if this company fails to repay the debt of 100 crore rupees? So, in original case, if the nodal bank would have extended the entire amount of money, so SBI will have a NPA of 100 crore rupees. But if in the process of syndicated lending, the SBI will reduce its NPA to just 50 crore rupees. So it makes financial sense for any economy to diversify the risks, and that is why this syndicated lending takes place. Now, this syndicated lending is not just available for fixed amount of money. There are other instruments also by which the banks lend it to any borrower, and that is called line of credit. Now, this line of credit was popular because of the Nirav Modi incident. That is, this individual misused the provision of line of credit and he took off with the funds of the bank, especially the Bank of Punjab National Bank. Now, this syndicated loan practice is available not just for fixed amount of loans but also for credit line, which is a form of short-term borrowing which the borrowers usually undertake. So, the statement 2 here is incorrect, whereas the first statement is correct because syndicated lending, it spreads the risk of borrower default across multiple lenders. Now, as statement second here is incorrect, that is why option C is the right answer to this previous year question. Now, we move to another question. The explanation of the previous question is here. You can read it after the session ends. I'm sorry. Now, consider the following statements with respect to digital rupee. Now, digital rupee and other central bank digital currencies have been in news for quite some time because these are sovereign replacements of cryptocurrencies such as Bitcoin and other cryptocurrencies such as Dogecoin. Now, this digital currency is a replacement or an alternative of private cryptocurrencies, but what is different from central bank digital currency is that these are issued by the central banks of our country. That is, in case of India, it will be Reserve Bank of India, whereas for US, it will be US Federal Reserve, whereas for England, it will be Bank of England. Now, this digital rupee is a sovereign or central bank digital currency issued by the RBI, and it has the same value as that of Indian rupee. Suppose there is a 100 rupee note which has been issued by Reserve Bank of India. Now, this 100 rupee note will have a same value as compared to central bank digital currency of the value rupees 100, and you can use it alternatively. Suppose you go into the market and buy chips worth of 100 rupees, you can either pay using the 100 rupee currency note or you can pay using the central bank digital currency, also known as digital rupee. So, let us read the first statement. It is a sovereign currency issued by the Reserve Bank of India in alignment with the monetary policy. Now, this statement here is correct because to undertake the recommendations, Reserve Bank of India constituted a committee called Subhash Garg Committee. Now, Mr. Subhash Garg at the time was the Union Finance Secretary, and this committee recommended to the RBI that you should bring a central bank digital currency so as to prevent people from moving into or moving on to or adopting the private cryptocurrencies. Understood? So, the first statement here is correct. Now, the second statement, it appears as a liability on the RBI's balance sheet. Now, every currency note which is printed by the RBI and distributed in the market, it is a liability on the RBI's balance sheet. Because even on the currency note, you will find with a signature of the RBI governor that I promise to pay the bearer of this note a sum total of that much amount of rupees. And this is the same applicable for CBDCs as well. That is, whenever a person approaches RBI with a central bank digital currency worth of rupees 100, the RBI will compensate that individual with 100 rupees in form of other notes. So, the second statement here is also correct. Now, the third statement, it is ensured against inflation by its very design. Now, do you think the currency notes are protected against inflation? No, right? Because suppose you went to a market to buy something which costs 200 rupees today. But that costs 200 rupees, right? It does not cost you one 200 rupee note. But for some reason, the price of that good increases to 220 in the next year. So, will you be able to buy that same good with the same 200 rupee note? The answer is no, obviously, right? So, from that logic itself, you can say that the CBDCs also, because they have same value as that of currency notes, they are not protected against the inflation. That is why option 3 here is incorrect. Now, moving to the fourth statement, it is freely convertible against commercial bank money and cash. Now, there is a property of a currency note is that it is fungible in nature. What does fungibility of a currency note means? That for say you have a 200 rupee note, it can have, or that 200 rupee note has the same value as that of 450 rupee notes, and same, it has the same value as that of 200 rupee notes. That is what you can call fungibility of a currency. That is, you can exchange the same currency for an equivalent amount of money of another currency as well. Now, as the CBDCs have a same value as that of a currency note, that is why it is also freely convertible against commercial money as well as cash. So, fourth statement here is correct. Now, as only third statement here is incorrect, that is why option D is the right answer to this practice question. Now, moving to another question. Consider the following statements. This also is a second two statement question. Now, this type of questions that are two statements are of recent occurrences, because if you see PYQs of their 2013 to say 18, you won't find such kind of questions. Now, this highlights that the UPSC itself or the exam itself is evolutionary in nature, because they are asking you the information, but the way they ask you the information is changing from time to time. And this is where PYQs are very important. So, let us consider the following statements. India does not import apple from the United States of America. Do you think that happens? Let me tell you straight away, the answer is no. Because India actually imports apple from the US. But why do you think UPSC asked this question? It was because last year, that was in 2023, India reduced the import duties on apples which are imported from the United States of America. Now, why did India increase the import duties earlier? It was because when the US president was Trump back in 2016 or 17, he removed the benefits that was extended to India under the Generalized Systemic Preferences or the GSP program. Now, this program was extended to developing countries like India, and the imports into USA from these countries were subjected to very low or zero tariffs. But President Trump was of the opinion that these countries are somewhat developed now and they do not need preferential access to the US market. So in retaliation to the US withdrawal of this GSP, India imposed tariff on key imports from the US such as walnuts, chickpeas, apples, etc. Now that the matter has somewhat cooled down now, that is why in 2023, India reduced the import duty on apples from the US, and this was the subject of Indian Express article on September the 12th, 2023. So this was the reason why UPSC picked up this question. Now moving to the second statement. In India, the law prohibits import of genetically modified food without the approval of competent authority. Now you know you cannot grow genetically modified crops in India without the approval of Genetic Engineering Appraisal Committee. But when it comes to import, the import of GM products is allowed, but it is not allowed by default. Rather, you have to take the permission of a competent authority. And for imports, that competent authority is the Food Safety FSSAI. Okay. So the second statement here is correct and the first statement here is incorrect because it says is an absolute statement that India does not import apples at all from the United States of America. Now, as the first statement was incorrect, that is why straight away you can mark option D as the right answer. Now another two statement question. And this question was somewhat difficult, but you could have solved it with a presence of mind. So this question required you to have a quick thinking on your feet. Consider the following statements. Recently, Venezuela has achieved a rapid recovery from its economic crisis and succeeded in preventing its people from fleeing, emigrating to other countries. Now, whenever there is a country, and if people are coming to that country from other country, that is termed as immigration. Whenever a person leaves from country of origin to another country, it is called emigration. So the question asks you, has Venezuela rapid recovery prevented its own people from fleeing or moving away to other countries? Now, if you see, in recent times, there was this news that Venezuela is growing or is recovering from its all earlier economic crisis. But do you think that recovery is so rapid that it has prevented people from emigrating to other countries? No, it's not. That is why first statement is incorrect, because although Venezuela is witnessing economic recovery, but it is not enough to prevent its own people from leaving to another countries. Now the second statement, Venezuela has the world's largest oil reserve. Now this is a straightforward fact which is quite well known, that although Venezuela is not the world's largest producer of crude oil, but it has world's largest reserve, and this is what makes the country so coveted. So the second statement here is correct. First was incorrect. Again, option D is the right answer to this question. Now, moving to another question with reference to Digital India Land Records Modernization Program. Now, this is a government scheme and it was not that much in news. So, any question on such topic is naturally going to be difficult for the aspirants. But now that we are solving this question, let me tell you where the question might have come from. Because Department of Land Records of Government of India came up with a report, and in that report the government highlighted the achievements of this scheme. Now, why was this scheme brought in the first place? It was because historically land records in India have been available, but these land records are in form of written documents which some people even do not have. So whenever you are undertaking a practice or going to purchase these land records or land items, you require to have a proper document validating your ownership of that land. So in absence of proper land records, it discourages people from getting into transaction, and it also discourages businesses from setting up their shops on disputed lands. So as to do away with all the disputes, the government brought forward a land records program which would digitize all the physical land records that are available in India. Now the scheme that is in news here, Digital Land India Records Modernization Program, it is a central sector scheme. Now what do you mean by central sector scheme? That is 100% of the funding of this scheme will be provided by the central government. Understood? So the first statement here, to implement the scheme, central government provides 100% funding, is a correct statement. Now moving to the second statement, under the scheme, cadastral maps are being digitized. Now what are these cadastral maps? Now these cadastral maps are the maps which has, first of all, details regarding property boundaries, details regarding who is the owner of the property, and also the geographical characteristic of the land. Whether this land is agricultural or this land is in a mountainous area. All of these are mentioned in the cadastral map, and yes, as you can see from this example, there are following components of the scheme which includes survey and digitization of cadastral maps also. Correct? Now let us move to the third statement. An initiative has been undertaken to transliterate the records of rights from local language to any language recognized by the Constitution of India. Now this is a correct statement. I'll tell you why. Because historically, the land records which is issued in any part of India is usually in its local language, and transliteration of that property details into a scheduled language by on your own is quite a difficult and challenging task. So the government through this scheme has initiated another reform, that is, any land record in a local language will be transliterated into the 22 languages which are mentioned in the scheduled 8th of the Indian Constitution. That is why option third here, or the statement third here, is a correct statement. Now that all the three statements here is correct, therefore option D again is the right answer to this question. Now another question on another scheme, but you'll think this is related to society. So why am I discussing it under the heading of economy? This is because if you look at the prelim syllabus, it says economic and social development. So as far as prelims is concerned, you cannot separate entirely the questions related to economy and questions related to societal issues. Now this Pradhan Mantri Surakshit Matritva Abhiyan was brought forward by Government of India to prevent early child death and mother deaths during the pregnancy period. That is, whenever a pregnant woman who is unable to take care of herself medically, she is eligible for the Pradhan Mantri Surakshit Matritva scheme. Now the pregnancy period of a human being is of 9 months, and these are divided into 3 parts called as trimesters. So this scheme is available in the 2nd and third trimester, that is between 3rd to 6 months and 6 to 9 months of pregnancy. Now, this scheme guarantees a minimum package of antenatal care services to women in their 2nd and 3rd trimester and 6 months post-delivery care service. So, only a part of the question here is correct, because this scheme offers a minimum package of antenatal care to 2nd and 3rd trimesters of women in their pregnancies. However, any care after the delivery is not applicable, thereby making first statement here incorrect. Now, there is also another aspect of this scheme, that is, you can understand the levels of governmental or public health care. It is not as that much prevalent in the rural areas, because India witnesses shortage of both health infrastructure as well as manpower in the healthcare sector. So as to fulfill this vacuum in the rural areas especially, the government wants to enlist the help of private players. And this is why the second statement under the scheme, private sector healthcare providers of certain specialties, especially obstetrician or gynecologists, they are enrolled by the government under this scheme to provide services at nearby health facilities. So the second statement here is correct. As you can see, I've taken the screenshot from the scheme document itself, and it says that it can motivate private practitioners to volunteer for the campaign by developing strategies for generating awareness, and also to provide healthcare services to the women in their 2nd and 3rd trimester of their pregnancies. So the second statement here is correct and first was incorrect, as I have already told you. That's why option B is the correct answer. Now moving to another question, which again is from social development related to Pradhan Mantri Shram Yogi Mandhan Yojana. Now this Shram Yogi Mandhan Yojana is available, or the benefits of the scheme is for old age people who do not have social security, and these people belong to the unorganized workers in our country, because our country has more than 40 crore people who are working in the unorganized sector. Now, with reference to Pradhan Mantri Shram Yogi Mandhan Yojana, consider the following statements. That is, the entry age group for the enrollment of this scheme is 21 to 40 years. Do you think this is correct? This is a factual point actually. Either you know or you don't know. This is incorrect, because this scheme is valid for people between 18 to 40 years of age. Another statement, age specific contribution shall be made by the beneficiary, which is again true, because whenever you enroll into the scheme, there is a table attached on the website, and it states that 18 years of age, the person will pay this much amount of money, and this money increases as you get old. Understood? So the second statement here is correct. Now the benefit of this scheme is that you contribute to the scheme, and an equivalent amount of money will be contributed by the government on your behalf, and the corpus is collected until the age of 60 years of age. Now after the unorganized worker goes to the 60 years of age, after that he'll be eligible to get a monthly pension worth 300 or 3000 rupees every month. So the third statement here is correct, that each subscriber under the scheme shall receive a minimum pension of 3000 per month after the years of 60 years of age. Now family pension is applicable to spouse and unmarried daughters. Now usually for any social sector scheme, the benefits are available to the first beneficiary themselves, and in case of an unfortunate event of the beneficiary's death, the amount of money is also paid in some form to their own spouses and nominees also. But in this scheme, the benefit is only available to the spouses, that in case the beneficiary dies, then the spouse is eligible to get 50% of the benefits that would have been provided to the beneficiary themselves. However, unmarried daughters are not eligible to get any benefits. So, which of the statement given above is or are correct? First was incorrect, fourth was incorrect. That is why second and third is correct. Option B is the right answer. Correct? So, we move to another question, and this was a straightforward factual question. So, in case you are not aware of these airports, my recommendation would have been to you to skip this question. But now that we are solving this question, I'll tell you the correct answer of this question. Now, this highlights 3 airports. Donny Polo Airport is located in the city of Nagaland. Kushinagar International Airport was inaugurated recently in Uttar Pradesh, whereas Vijayawada is located in the state of Andhra Pradesh. Now, this question asks you, which of the above has been constructed as a greenfield airport? Now, to solve this question, you need to understand what is a greenfield airport and how it is different from a brownfield airport. Now, suppose greenfield airport is the airport which is constructed over an existing airport. So, if I say the IGI Airport Terminal 3 or the recently inaugurated Bengaluru Terminal, these were examples of greenfield project because an airport was already functioning here. Because airports were already functioning here, and that is why the newer projects constructed over these airports are example of greenfield projects. But on the other hand, brownfield projects are the one in which the project has been developed from the scratch. That is, there was a barren piece of land or a land which did not have any airport, and you're constructing an airport over that land. That is called as a brownfield project. For example, only yesterday a flight landed on Noida International Airport Limited, which is an example of brownfield project. Understood? Now, among these 3 airports, Vijayawada Airport had existed earlier. So, any project undertaken over this airport would be categorized as a brownfield project. Whereas, first and second airport, they are airport made from the scratch. That is why they are examples of greenfield project. That is why option A is the right answer to this practice question. Now, I had to go through the website of Airports Authority of India and Ministry of Civil Aviation to know which of the following airport was greenfield or brownfield. Now, another question related to the social development part, that it asks you the definition or the meaning of total fertility rate. Now, any country's population is measured by various other parameters, the primary of which is the concept of fertility rate. Now, the fertility rate in general is the number of children born in a particular year divided by the number of women who are in their childbearing age, that is between 15 to 49 years of age, and the number you get out of this division, you multiply it by 1000. So that is fertility rate. Now it gives you a number that how many children are being born into a country for every 1000 children or every 1000 women. So this is an absolute number. But you need to know exactly on an average a woman is giving birth to how many children in their entire lifetime. So from that regard, total fertility rate becomes important because the total fertility rate highlights the average amount of children a woman is expected to bear in their child producing age, that is the age between 15 to 49 years. So from that logic, option D here is correct, as the average number of live births to a woman would have had by the end of her childbearing age is the definition of total fertility rate. Understood? So this was a straightforward question picked up from the NCERT itself. Sorry. Now, there has been a trend in the UPSC in the past that questions have been appearing from relevant topics. And since the COVID-19 pandemic, we have seen that India's financial markets, that is equity market, government securities market, mutual funds, all of this has witnessed increased participation of retail investors, which in Hindi is called khudra investors. Now, these retail investors like you and I, we invest our savings into financial markets of our country. Now, because of increased digitization and low banking interest rates, the participation in retail markets, especially in the financial markets, have increased manifold. And this trend also can be seen in the UPSC questions, especially after the year 2020. So this year we had many questions belonging to the financial sector, and this is the first one of them. Now, the first statement, if you look correctly, belongs to the banking sector, whereas the rest two statement belongs to financial sector. The first statement, in India, non-banking financial companies can access liquidity adjustment facility, that is LAF window of the RBI. Can they adjust? Now, LAF window, which consists of repo as well as reverse repo rate transactions, these are instruments or funds which are available to financial corporations for short-term lending. That whenever any financial institution approaches RBI for lending under the RAF corridor or LAF corridor, the RBI provides these institutions with money, but on return, these institutions have to provide RBI with some form of collateral, which are most recently government securities. Understood? Now, this LAF window is available to scheduled commercial banks, that is all scheduled commercial banks minus regional rural banks. And another set of individuals who are eligible to get funds under the liquidity adjustment facilities are called primary dealers. Now, the logic of most of the students were that if NBFCs were primary dealers, so they are eligible to get funds under the LAF corridor. But let me tell you, this statement only is partially correct, because according to RBI website, there are 21 primary dealers in the country. But do you know how many NBFCs are there in the country? More than 9,400 NBFCs. So although some of the NBFCs have the license of primary dealers, that are only 21, that is why if I say any non-banking financial company can access fund under the LAF, that statement becomes incorrect. Understood? Now, moving to the second statement, that foreign institutional investors can hold government securities. This is a correct statement, because under the fully accessible route, the government has allowed the foreign institutional investors to invest in government securities, and this is a straightforward statement. You do not even have to think much on this statement. Now, the third statement, stock exchanges can offer separate trading platform for debt. Now, this is a tricky statement and it belongs to current affairs, because only last year in 2023, National Stock Exchange, it came up with a separate dedicated debt trading platform, which gave a separate platform to retail investors to invest in corporate bond in a transparent exchange platforms. Understood? So this current development was straight asked here, and the third statement here is correct. Now, which of the statements given above is or are correct? Option D is the right answer, because second and third were correct. Now, let us move to another question, again related to financial market, that which of the following can trade in corporate bond and government securities. Now, you can understand these corporate bonds and government securities are debt instruments. Now, whatever amount of money these corporate companies and government is going to borrow, you understand that is quite a large amount of fund. So naturally, the lenders to the corporates and governments will have to be the institutions who have large money at their disposal. So that is why large financial institutions such as insurance companies, pension funds, they are eligible to trade in corporate bonds and government securities, right? But you will think retail investors like you and I, we only have like 10-15,000 monies or rupees to lend. So do you think retail investors actually can trade in corporate bonds and government securities? The answer here is again incorrect. Correct. And why am I saying it's correct? Because if you had followed current affairs in past few years, RBI came up with a scheme called Retail Direct Scheme. Now earlier, retail investors could only invest in government securities in the secondary market. That is, after they have been issued, but through Retail Direct Scheme, the RBI made it retail investors eligible even to trade in government securities in the primary market. That is, by setting up their digital accounts with the RBI, they can even buy government securities whenever they are issued in the primary market. So this is why this question was somewhat tricky, that even the logic if you had used in the exam would have been dangerous, because you would have marked retail investors as incorrect while it is correct. So all this three option here is correct. Option D is the right answer. Now for knowledge purposes, these are types of financial institutions which are eligible to participate in government bonds and government securities market or corporate bonds. For example, commercial banks, cooperative banks, rural banks, primary dealers, insurance companies, mutual funds, provident funds, pension fund and foreign portfolio investors. Correct. And under Retail Direct Scheme, RBI now allowed the retail investors to directly trade in both primary and secondary market, which I have already told you. Now another question related to financial market. Consider the following: exchange traded funds, motor vehicles, currency swaps. Which of the following is or are considered as financial instrument? Now any financial instrument, if you can trade that instrument, or any legal document which you can trade, is a financial instrument. Now I have to understand what you can trade and what you cannot. So for example, can you trade gold? The answer obviously is yes, because it is a property. The value of gold can increase or decrease depending upon various circumstances. Whether your property paper is a financial instrument, yes. You can use property papers as a collateral in the banks to take funds or take money as loans. So these are examples of financial instrument. That is, an instrument which I have, I can trade it with another person for some amount of money. It is a very basic definition of financial instrument. Now exchange traded funds, they are like shares whose value goes up and down as the market changes. Similarly, currency swap also is an example of financial instrument. Now the question is, what is this currency swap? Suppose I am a foreign investor and I require rupee to invest in India. So I will get into an agreement with a financial institution based in India that upon my need, you have to pay me some amount of rupee, which I will return you with some interest after some time. This is an agreement between two parties to source any currency. And this currency swap involves exchange of currency 1 with that of currency 2. Now this agreement between two parties is also an example of financial instrument. But do you think motor vehicle like cars and two-wheelers are financial instrument? The answer is no, because they are a depreciating asset. That is, the value of car that you have brought today will be lower in a period of 1 month, and it will be further lowering as the time progresses. So second here is not the correct statement. That is why option D again here is the right answer, because exchange traded fund which are a financial instrument, and so is the currency swaps. I have provided the definition of currency swap here, that it is a financial instrument used by financial institutions in which party agrees in advance whether or not they will exchange the principal amount of two currencies at the beginning of the transaction. Agreed? Now the terms of exchange of currencies in a currency swap agreement has been fixed even before the transaction take place. So you know what kind of money you have to return after the agreement expires. Now let us consider this question. It is a straightforward question asked from the NCERT. So I'll expect each and every one of you to already know the answer. But for today's video's sake, I'll be solving this question. With reference to sectors of Indian economy, consider the following pairs. Now I'll tell you there are three sectors in Indian economy, and for that matter any economy. That is primary, secondary, as well as tertiary. Now primary sector is the sector where you harness the natural resources. For example, farming, it harnesses land. That is why cultivation of agricultural produce is a primary activity, whereas mining, you harness natural resources in the land. Again, an example of primary natural resources or primary sector activity. So is dairying, because you are harnessing animals who are again natural resources. So any activity which involves harnessing natural resources, be it agricultural cultivation, mining, as well as animal husbandry, these are examples of primary activity. Now let's come to secondary activity. Now whenever you process these natural resources and change the value of the natural resources into something else, these are examples of secondary sector. For example, you cultivate cotton. Now cultivation of cotton is a primary activity, but you send that cotton into a cloth yarn, and that cloth yarn results into changing of cotton into a t-shirt. Now this is an example of a manufacturing process. That is why it is a secondary activity. That is, any manufacturing activity which changes the character of a natural resources harnessed in the primary sector is called as a secondary activity. Now what are tertiary activities? Any activity which supports primary and secondary sector by method of services, these are called as tertiary activity. For example, you cultivate grains, which is an example of primary sector. However, you are required to store that grains also. So storage of agriculture produce or storage of anything for that matter is a tertiary activity. So is transportation. That transporting, say, a finished good from a factory, it is a service, example of tertiary sector. So is the activities related to banking sector, because banking sector is providing capital to primary and secondary sector, which is a form of banking service. Understood? So this is the concept related to the question. Now based on our understanding of the concept, we will solve this question. Storage of agricultural produce, is it a secondary activity? No, because it is a service offered to agricultural sector. That is why tertiary activity. Dairy farm utilizes animal to gain something which is a natural resource, hence it is a primary activity. Mineral exploration, again utilizing natural resources, so this is incorrect because it is a primary activity. Now weaving cloth, because you cultivate cotton in primary sector and you weave cloth, that is changing cotton to thread, it is a secondary activity, hence it is correct. So as second and fourth are correct, and it requires you to identify how many pairs are correctly matched. That is why option B here is the right answer. Now we move to another question. With reference to physical capital in Indian economy, consider the following pairs. Now physical capital are of two types, that is fixed capital and working capital. Now fixed capital is any investment in your company which is for long term. Now the logic of fixed capital is when you invest in long term, the returns are visible after some period of time and the returns are manifold. Whereas on the other hand, working capital is somewhat short term in nature. That is, to run your company on a daily basis, you need some kind of funds, investment, services. These are examples of working capital. That includes raw material, cash, employees. These are examples of working capital. Whereas any capital investment such as purchase of tools, machinery, these are examples of fixed capital. So is investment in land, factories, etc. So based on this information, let us now solve the question with reference to physical pairs. We have to identify items belonging to the certain category. Now, farmer plow is a working capital, is it? No, because farmer's plow is a long-term investment which the farmer can use even in this agricultural cycle, in the next agricultural cycle, and if the plow remains even after 5 years. So it is an example of fixed capital. Now, computer, is it a fixed capital? The answer is yes, because in any factory, if you install computers, you can use it for 5-6 years until the computers goes bad. So also it adds value to the process, that it digitizes the process, makes it more efficient. So it is a capital investment, particularly for a long-term investment. That is why it is a fixed capital. Now, the yarn used by the weaver is an example of fixed capital. Is it incorrect? Because the yarn, it is used as a raw material, which is short-term in nature. That is why it is incorrect. It should have been working capital. Now, petrol is a working capital, correct, because petrol you used to run vehicles, which is a short-term part of a process, because it is a raw material. Had it been a vehicle, it would have been a fixed capital. Understood? So, second and fourth correct. Again, the answer is option B, because only 2 pairs was correct. Now, we move to another question which is related to Reserve Bank of India treatment of foreign banks. Now, there are 2 statements to the question. There is no minimum capital requirement for wholly owned banking subsidiaries in India, and this is, you can say, even without knowing the fact, is an incorrect statement, because every bank operating in India, be it owned by domestic companies or domestic citizens or owned by foreign owned companies, they are subjected to some kind of capital requirements. That is, in case of foreign banks, they have to have 10% of their risk weighted assets and they have to keep it aside as a form of minimum working capital requirement. So statement 1 is incorrect. Moving to the second statement, for wholly owned banking subsidiaries in India, at least 50% of board members should be Indian national. This is a correct statement, although it is very factual. That is, to know whether this fact is correct or not, you have to know the exact amount of fact. So that is why this question is difficult by the virtue of the second statement. However, if you look at the RBI's website, there is this declaration that wholly owned subsidiaries are required to maintain a minimum capital adequacy ratio of 10% of risk weighted asset, which is first statement correct. Now, moving to the second statement. Sorry, first statement was incorrect because it said the foreign owned subsidiaries did not require to have any fund as a separate capital adequacy requirement. Now, moving to the second statement, to ensure board of directors set up in India act in best interest of local institutions, RBI has mandated that is at least 50% of the directors should be Indian nationals who are resident in India. So you can say statement 2, although a fact-based statement, is a correct statement. Now let us move to another question which is related to corporate social responsibility. Now, Indian economy earlier used to be a socialist economy, and even today there are examples that Indian mindset has become a socialist mindset. And a part of that mindset is that any corporates functioning in India does not just make profits out of their own volition. Rather, it is the role of a society which is also contributing to the profits made by corporate sector. So extending that logic to corporate sector, the government has mandated the corporate sector to return some amount of their profits back to the society itself. And in that logic, Corporate Social Responsibility Act was passed by the Indian Parliament, and it specifies that expenditures that benefits company directly or its employees will not be considered as a CSR activity. It is correct. Second statement, CSR rule do not specify minimum spending on CSR activities. It is incorrect, because the legislation which enacted the CSR activity, it stated that 2% of profits made in the 3 previous financial years should be used for CSR activities mandatorily. Now suppose this financial year is 2024 and 25, correct? So the company is eligible to calculate its 2% of its profit of the year 2023-24, 2022 to 23 and 2021 to 22. So to calculate the CSR obligation of any company in this financial year, the company will have to consider profit, suppose say 100 crore, 50 crore and 100 crore. So this amounts to 250 crore rupees. So the average profit for 3 years will be about about 83.33 crores. Correct? So 2% of 83.33 crores should be utilized by company for CSR activities in this financial year, and this is what the act mandates. Correct? So you can see I've taken a snapshot from the CSR policy rules 2014, which defines CSR, and it specifically excludes some activity to be calculated as a CSR activity, which includes activities undertaken in pursuance of normal business, activities undertaken outside of India except for training of Indian sports personnel, which the company called GSW is doing by training our own gold medallion Mr. Neeraj Chopra. Now, contribution of any amount directly or indirectly to any political party is also outside the ambit of CSR activity. So is activities benefiting the employee of the own company itself. Further, sponsorship activities for marketing benefits is also excluded. So is activities which are to fulfill any statutory obligation passed by the Indian government. Now, section 135 Section 5 of the Act mandates that minimum spending obligation on the company is at least 2% of the average of net profits that the company has made in the past 3 financial years. Understood? So this is why second statement is correct. Second statement is incorrect because it states it does not specify any minimum spending. So first statement was correct. Option A is the right answer to this practice question. And we move to the last question of the day, which was also the last question of the exam with reference to Indian economy. Collateral borrowing and lending obligation are instruments of, the answer is money market. What is money market? It is a market where you borrow funds for a period of less than 1 year. If it was period for more than 1 year, it is called as a capital market. Now, CBLO, which is an abbreviation of the term, it is an instrument which is available to companies to borrow funds for a period of short term. However, to borrow this fund, the companies will have to keep government securities as a collateral or any security as a collateral. That is why it is different from, say, call money market, which also involved lending of money for short term, but for call money market, the borrowers will not have to keep any kind of collateral, which is the case for collateral borrowing and lending obligation. Understood? So with this we complete the previous year question of economy section of the year 2024, and in the another video I'll be solving the questions of every previous year questions of the economy section. So this was from my side today, and I'll come back again with 2023 questions. Now, the first question from economy in this year was related to infrastructure investment trust, which are otherwise known as InvITs. Now, it is a two-statement question. The types of question which you have seen are of recent occurrences. Now, the first statement, it states interest income from the deposits in infrastructure investment trust, they are distributed to the investors and are exempted from tax. However, the dividends are taxable. So you have to understand what kind of returns do people generate in InvITs. Now, what are InvITs? They are pooled investment instruments where money is contributed by investors such as you and I, and this corpus of money is then invested in infrastructural projects. And the returns out of these projects are then naturally distributed to its investors. So technically there are four types of income which is distributed to its investors. These are rent, which are generated from the projects, interest income, dividend, which is distributed among the investors also, and also the money, that is repayment of capital, that whenever you decide to withdraw from your investment from InvITs, the InvITs will return you back the original capital amount. So these are four sources of income that any investor will get out of InvITs project. Now this states that the interest income, they are exempted, however dividend it isn't exempted from being subjected to tax. So historically all these three sources of income, that is rent, interest and dividend, they have been taxable. And in Finance Act of the year 2023, it made repayment of capital also as a taxable amount. So earlier taxes were levied on these three sources of income. However, from the Finance Act of the year 2023, the repayment of capital has also been subjected to taxes. So this first statement here is incorrect, which states that only interest is exempted, however dividend is taxable, because interest also is not exempted from taxes. So first statement is incorrect. Now moving to second statement, InvITs are recognized as borrowers under SURF-IC Act. Now this is a very factual statement, but you have to realize that section 2F of the SURF-IC Act, that is Securities Reconstruction of Financial Assets and Enforcement of Securities Interest Act, it states that InvITs are recognized as borrowers. So the second statement here is correct. Now as first statement was incorrect, naturally option D is the right answer to this PYQ. Now I've attached the solutions here also, so you can take a look at the solution. But with this we move to another question, which also is a two statement question. However, compared to the InvITs wala question, this is comparatively easy. Statement 1, in the post-pandemic recent past, many central banks worldwide had carried out interest rate hikes. And the second statement, central bank generally assume that they have the ability to counteract the rising consumer prices via monetary policy means. Now you have to understand what happened during and after the COVID-19 pandemic. Now like India, most of the nations across the globe, they were subjected to a lockdown. Now this lockdown naturally affected the economic activity, and hence economies across the world witnessed slowdown and even recession. So to bring these economies out of recession after the COVID pandemic has stuck, the government decided what was known as an expansionary fiscal policy. That is, they distributed money among the people in one form or the other by reducing the taxation rates in the country, by giving SOPs to industries, which are all examples of expansionary fiscal policy. Now, the result of this expansionary fiscal policy was that after a certain period of time, all these economies witnessed high inflation rate. So, from your economy class, you must recall that whenever there is an increase in inflation, the central banks, they have a tendency to rise interest rates. That is, by rising interest rate, they want to reduce the money supply, thereby controlling the amount of inflation. And this is what many central banks did, including India's very own Reserve Bank of India. And the second statement, it is a straightforward statement that central banks can control inflation via monetary policy means, that is by changing the levels of interest rate in the banking system. Now, whether first and second, although both are correct, so is the second statement a correct explanation of first statement? And you can gauge this by just adding the word because after the first statement. So, in the post-pandemic recent past, many central banks had carried out interest rate because they generally assume they can control consumer prices via monetary policy means, and this perfectly makes sense. Hence, option A is the right answer to the second PYQ. Sorry, I have a bad throat. You have to excuse me on that. Now, moving to another question, which one of the following activities of the Reserve Bank of India is considered as a part of sterilization? Now, you have to understand first what this sterilization means. Now, you can understand for every dollar, there is a certain amount of rupee that you have to pay currently, which is for $1, the value of rupee is 84. Now, the value of dollar and rupee is based on its relative money supply. So, in case the supply of rupee increases, the value of rupee will go down, that is, it will become 86, 90, etc. That is, it will become 84, 86, etc. So, to control the value or to control the depreciation of rupee, what the RBI does is that it removes the excess money or excess rupee out of the market through some kind of operation. And this is called as sterilization. Now, this operation can also happen in opposite case. That is, whenever the supply of dollar increases, it will mean that the rupee is getting stronger. That is, the value of rupee will increase to 82, 81, 80, etc. So, in that case, the supply of dollar is more than compared to, well, supply of rupee. So, to counteract this appreciation of rupee, what the RBI does is that it increases the supply of rupee in the market or it reduces the supply of dollar in the market. And both of these phenomena, that is increasing or decreasing the value of rupee, is called as a process of sterilization. Now, from your economy class, you can recall how does RBI increases or reduces the supply of rupee, that is by buying or selling the government securities. Now, whenever RBI supplies government securities in the market and takes cash for it, it reduces the supply of rupee. And opposite, whenever it buys the government securities from the market, in return it has to provide rupee, thereby increasing the supply of rupee. That is called as open market operations. Understood? So, that is why option A is the right answer to this PYQ. Now, moving to another question which is related to India's financial markets. Now, you may recall during our discussions of PYQ 2024, I highlighted that country's financial market is witnessing increased participation of retail investors, especially after the COVID-19 pandemic. And because of this phenomena, RBI is also, or the UPSC is also taking keen interest in this very field, and thereby you can see more amount of questions from this very section in the economy. And this question is quite straightforward. It states how many of these four instruments can be included in capital markets. But you have to first understand there are two types of financial market, that is, for short term market is called money market, whereas long term market is called capital market. Now, government securities which have been issued for a time period of less than 1 year, they are termed as short term securities, that is, any financial transaction which will be completed before 1 year period of time, that is called as a money market operation. On the other hand, whenever any capital instrument or any financial instrument which has a expiration period of more than 1 year, be it 5 years, be it 10 years, all of those are example of capital markets. That is, when the validity of that instrument is more than 1 year. So, treasury bills, they are bills of central government which has expiration period of less than 1 year. They are example of short term instruments. So it does call money market instruments. So these are incorrect from our questions perspective because they are instruments of money market. Whereas government bond markets, these are bonds which are issued for a period of more than 1 year, they are long term securities of the union government, hence they are instruments of capital market. And so is stock market such as equity and mutual funds, that are, you can hold these stocks and equities for more than a period of 1 month. That is why they are also the instruments of capital market. So how many of the above are included in the capital market? Correct answer is option B, because two, that is government bond market and stock market, are the instruments of capital market. Understood? Now let us consider this question, which is quite straightforward, as it asks you to, which one of the following best describes the concept of small farmer large field. Now, Indian agricultural sector witnesses participation of majorly small and medium farmers. That is, almost 84% of country's land is operated by small and medium farmer. Now, a consequence of a small farmer operating their agricultural venture is that the production will be quite low. So their ability to sell their produce in the market is also very low, because naturally they will consume and only a little amount of agricultural produce is available for them to sell in the market. And also, as a buyer of agricultural commodity, it makes sense to source their agricultural produce from larger farmers because they have large quantity of agricultural produce. So to negate this disadvantage of small farmers and medium farmers, what the government has done in recent past is that it has promoted what is known as food farmer producer organizations. Now these FPOs are sort of an arrangement where small farmers, they come together and form an organization or a cooperative, and they decide on what kind of crops to grow, where to sell, etc. Also, these organizations helps the individual farmers in their input support, in providing them with the advisories on how to grow crops, and that is why such kind of groups are very essential, and it negates the negative impact the small and marginal farmers usually face. So this question was asked in this regard, and naturally the correct answer will be option B, because it states many marginal farmers in the area organize themselves into group and synchronize and harmonize their agricultural operations according to the decisions made by the grouping. So B is the correct farmers. Now this, otherwise you will be confused with, is in an example of contract farming and not FPOs. So that is why option B is the correct answer. Now let us move to another question, and this was a tough question because you can know that rice, wheat, pulses, etc., they are eligible for benefits incurring out of the MSP program, that is minimum support price program. Now in the MSP program, what the government does is that before sowing of crops every season, the government announces prices for some crops, which is 23 crops in general. Now the prices, that is MSP of these crops, are announced, which is aimed to encourage farmers to grow these crops and then sell them to government. And in case the prices of the market goes below the MSP, the farmers always will have an option to sell their produce to the government under MSP program. So usual or the crops in news such as wheat and rice etc. have been in news, but this question was asked not on those crops but rather on Niger seeds. Now these Niger seeds, these are seeds primarily used by tribals, and it is cultivated during the monsoon season, which is known as a Kharif season. Hence second statement here is correct, and the first statement here is also correct because among the 23 crops, Niger crops is one of them. And do you know that Niger crops commands one of the highest MSP among all crops? However, despite such support which is extended by the government, the Niger seeds and its production has witnessed drop of almost 80%. And this is because Niger seeds, which is in Hindi called as Ramtil, its demand has reduced and the demand is left only with the tribal people who use Niger seeds and its oil for cooking purposes. So all these three statements here is correct. That is why answer of this question is option C, that is all three statements are correct. Understood. Now this was a factual question that it was asked related to a hitherto unknown crop, which is Ramtil or Niger seeds. Now moving to another question. It states 4 types of investments and which of the following are considered as intangible investments. Now from your history lessons you may know that tangible means something that you can touch. Suppose I am tangible, that you can touch me and you know it is a tangible thing. And so is this mobile phone because you can touch this mobile phone. Whereas on the other hand, intangible is something you cannot touch. This is the meaning of the term intangible. For example, the heritage of our country can't be untouched. It is an intangible thing. Whereas our monuments, they are tangible things which you can feel. So which of the above is or are intangible instruments? Now among this 4, you know inventory. It is a stock of goods which are not sold by any factory and it has been kept in the factory premises or in the godowns. So it is a physical thing, right? So that is why inventory, it can't be a intangible thing. Now brand recognition is something that exists in the market. That is, if a company has a good brand, that is something exists in the market and you cannot touch it physically. Hence it is an intangible investment, and so is the intellectual property. Another investment that the company has is the mailing list of their clients, which is an important corporate asset or an important organizational asset. However, you can't touch the mailing list, right? It exists over the internet or in the computer. So again, this is an intangible investment. So as 3 options here are correct, that is why option C is the right answer. Now moving to another question which states, consider the following. These are 5 options, and for the horizontal tax devolution, the Finance Commission used how many of the above criteria other than population area and income distance? Now first of all, you have to understand what is horizontal tax distribution. Now Finance Commission is an constitutional body formed under the Article 280, and it determines distribution of net proceed of taxes from union government to state governments. So union government is here and it distributes taxes to state governments. It can be state 1, it can be state 2 and it can be state 3. Now devolution of funds from union to state levels, it is called as vertical devolution, whereas distribution of funds among state governments is an example of horizontal distribution. Now to differentiate between which state needs more money from the union government and which state needs less, the Finance Commission has come up with certain parameters, and these parameters were given in the Finance Commission's report, and I have attached a screenshot here. So you can see income distance is one of the parameter, so is population, so is the area, forest cover, forest ecology, demographic performance and tax effort. Understood? So based on this, we can safely say that demographic performance here is correct, so is forest and ecology, and so is tax and fiscal efforts. Whereas Finance Commission does not take into account governance reforms and stable government, that is why third and fourth is incorrect. So first, second and fifth was correct, that is why option B here, that is only 3, is the correct answer. Understood? Now with this we move to another question, and this was a straight away factual question, that is why it was very tough. So any candidate in the exam setting, if you have no idea about that question, my recommendation to you will be to entirely skip that question, because from a probability perspective, the chances of your correct marking this answer will only be 25%, which is not worth taking a risk over. So for our today's discussion sake, let us solve this question. Now UNOPS is a project services body of the United Nations. Now a key development happened in this organization, that is, it became the first standalone organization in the aegis of United Nations to have a standalone business unit, and this was known as an S3I office, which is a full form for Sustainable Investment in Infrastructure and Innovation Office. Now the purpose of this office was to invest both public related funds and encourage private funds to invest in certain areas. So you know why I called this question tough, because it requires you to have an exact idea on what fields this body encourages investments on. So from this you can say it encourages investment on affordable housing, renewable energy and health infrastructure. All of this is interested to increase the levels of social and economic inclusion in the country. So coming back to the question again, you can see mass rapid transport isn't a field in which this body encourages investment, while as rest of the 3 are the correct option. Hence option C, that is only 3, is the right answer. Now moving to another question which is related to the micro, small and medium enterprises or the MSME industry. Now this MSME industry is very important as far as Indian economy is concerned. You ask why? Because they employ as many as 11 crore people in India. These MSMEs, they also account for about 30% of our nation's GDP and almost 50% of our exports. Now to promote these companies or organizations, what the Indian economy and the government and its related body does is that it encourages flow of funds to these units and it wants to make these units more economically productive. So as a result, they extend cheaper finances to MSMEs, they extend multiple schemes which aims to encourage the economic productivity of MSMEs. So naturally, any enterprise would want it to be classified as MSME. And as a result, the government has come up with a classification criteria that which of the company is eligible either to be categorized as a micro, small or medium enterprises. Now, this question was probably asked in the year 2023 because government made a changes in the criteria during the COVID-19 pandemic. And you can see from this slide that the government has unified the categories related to investment and turnover in the companies, and it has classified micro, small and medium enterprises according to their investment and turnover limits. Now coming back to the question, and you can see here medium enterprise are the ones where investments are between 10 to 15 crore rupees, whereas for small enterprises it is between 1 to 10 crore, whereas micro enterprises it is up to 1 crore. So according to these investment criteria, a company can be classified as micro, small or medium enterprise. Now among certain benefits also, the RBI has a policy called priority sector lending, where a certain amount of credit which is extended to banks are given to some important sectors, which include infrastructure, agriculture, MSME, etc. So according to this criteria also, MSMEs are eligible to be counted as eligible for priority sector lending requirements of the bank. So this is aim to increase the formal credit outflow to the MSME sector, which they usually face difficulties with. Now coming back to the question again, according to Micro, Small and Medium Enterprises Development Act of the year 2006, the medium enterprises are the ones with investment in plant and machinery between 15 and 25 crore. Now if you remember the last slide, medium enterprises are the ones which have an investment between 10 to 50 crore rupees. Hence, first statement here is incorrect. Coming to the second statement, all bank loans to micro, small and medium enterprises qualify under the priority sector target, which is correct. Although it is an absolute statement, but it is a correct statement. So, students pay close attention that not all absolute statements given by the UPSC are incorrect, which has been the misconception in the previous past. So as second statement only here was correct, naturally the answer to this PYQ is option B, that is only second statement is correct. Now let us move to another question which is related to central bank digital currencies. Now, central bank digital currencies have emerged as an alternative to private cryptocurrencies like Bitcoin, Ethereum, etc. Now, why are central banks bringing this CBDCs? Because these CBDCs, although have a legal sanctity of a normal physical currency, but they have certain advantages. That is, any digital currency which is brought forward by a central bank can be reprogrammed for a certain use. That is, if a central bank provide 100 rupees to any farmer, that fund can be programmed so that farmer can only use that 100 rupees for certain purposes. And this is a quality of CBDC. So, the second statement, a digital currency can be distributed with the condition programmed into it at the time frame for spending it, it is a correct statement. Now let us understand the first statement. Is it possible to make payments in digital currencies without the use of US dollar or the SWIFT system? Now the SWIFT system is a system which takes into account the cross-border flow of funds. That is, if I am an importer of any good and the exporter is located in the US, I have to pay that exporter in form of either rupees or dollar. However, the settlement of funds between me and the another party is taken with the process of banks. Now, these banks, they settle funds which requires you to use the SWIFT system. However, once CBDCs comes into play, the need for having a commercial bank goes away. And this is where the settlement of funds from across the border becomes easier with the help of CBDC. That is why statement first here is also a correct statement, that it is possible to make payments in digital currency without the need of converting it to another currency or using the SWIFT system. That is why option C here is the right answer, because both of these statements are correct. Now, moving to another question. It is also related to financial market, and it asks us to identify what is the term called beta. Now, there are certain terms in the financial market. First is alpha, which means if your financial instrument has a higher returns than market, that means your investment strategy can be called as alpha. Now, what does beta means? Beta means it indicates the volatility of the financial instrument. Now, it is a numeric value. That is, if beta is greater than 1, that means it is more volatile. Whereas, if beta goes below the value of 1, it means the volatility in that instrument has become less. So, from the 4 statements here, option D is the right answer, because beta is a numeric value that measures fluctuations of a stock to change in the overall stock market, which means beta is an indicator of volatility in any financial instrument, be it government securities or be it stocks. Now, moving to another question that is related to self-help groups. Now, these self-help groups are groups which are made by individuals like you and I, especially the ones belonging to poor and vulnerable sections of the society. Now, we have heard that in case any poor person wants to start an enterprise and it goes to a bank for seeking loans, the bank naturally will deny that person a loan because he or she does not have the means to return the money. So, as a counter to this problem, there emerged a concept called self-help groups, which was originally introduced in the lexicon of economy by one professor known as Muhammad Yunus, who currently is the chief advisor to the Bangladesh government. Now, he started an institution called Grameen Bank, and it played a pivotal role in popularizing the concept of self-help groups. Now, usually how does lending happen in self-help groups? Because bank, it lends the money to self-help groups, and the individuals in the self-help group, they decide on how to distribute the funds among its own members. So, from that logic, you can say in self-help group, all the members of the group take responsibility of the loan that an individual member takes. Now, the purpose of self-help group was originally for the bank that it reduced the risk of lending to a vulnerable person. And to compensate the risk, the self-help groups, they undertook a responsibility that give funds to us and we will distribute it among members, provided that we take the responsibility of the funds given to us by the government. So, second statement here is correct. Whereas, if you look at the first statement, self-help group programs were originally initiated by the State Bank of India. It is incorrect, because although it was originally introduced in Bangladesh, however, in India, the institution which took the responsibility of its introduction was National Agricultural Bank for Rural Development, called NABARD. So, first statement was incorrect. Now moving to the third statement, the regional rural banks and scheduled commercial banks support self-help groups. It is a correct statement because originally it was regional rural banks who started extending credits to self-help groups, and eventually, according to RBI, even scheduled commercial banks started doing this. That is, they extended credit to self-help groups through a program called Bank Linkage Program. So, as second and third statement here is correct, that is why option B is the right answer to this practice this PYQ. Now let us move to another two statement question, which asks us whether Switzerland is one of the leading exporters of gold in terms of value and whether Switzerland has the second largest gold reserves in the world. Now this is a completely factual statement that although you will be able to correctly mark this statement because it has been in news quite for some time, because historically Switzerland is the largest exporter of gold in the world. That is, even gold sourced in India are imported from Switzerland. However, the second statement is a very factual statement and you have to know the exact details of which country has the most and second most reserve. Now coming to the reserves of gold in general, Australia comes in the first place with reserves of almost 10,000 tons. Whereas the second place is not of Switzerland but that of Russia, which has about 5,500 tons worth of gold reserve. Now talking about Switzerland, it does not even have reserves which will be enough for it to be placed under top 5 reserves country. So second statement here is incorrect. Now naturally, as the second statement here is incorrect, option C is the right answer and you do not have to think about whether first explains the second statement or not. Correct? Now as you can see, in the year 2021, Switzerland exported gold of more than $86 billion, making it largest exporter of gold anywhere in the world, whereas in terms of reserves, Australia is at first and Russia is at the second place. Now moving to another two statement question, which although was a very straightforward question had you followed the news. However, in exam setting, when you are under tremendous amount of pressure, even such simple questions can prove to be difficult. So, to remove your uncertainties, let us solve this question, which states India accounts for 3.2% of global export of goods. Now, this is an incorrect statement because in terms of export of goods, India exports somewhere around 1.8 to 2% of total global goods. But when it comes to services, India is responsible for export of 4% of services in the globe. So the first statement indirectly here is incorrect because India exports only about 1.8 to 2% of global goods. Now the target of the government is to increase this 2% to 3% by 27 and to 10% by 2047. Now to increase India's export, government wants to undertake huge levels of manufacturing in the country, and for that it has brought programs like Make in India, it has brought programs like Production Linked Incentive Scheme, which has enabled to some extent manufacturing in India. For example, as many as $15 billion worth of phones were exported out of India in the last financial year, whereas few years back, India was a net importer of mobile phones. So this transformation has taken place because of Production Linked Incentive Scheme, and in this scheme, both domestic companies and foreign companies are eligible to set up their manufacturing units in India, and based on their incremental sales, the benefits or the incentives will be provided to them by the government of India. So the second statement here, many local companies and some foreign companies operating in India have taken advantage of Production Linked Incentive Scheme. Take for example, foreign companies like Apple, Foxconn, Pegatron, they've set up their manufacturing locations in India, and so has local companies such as Lava, etc. That is why second statement here is correct, as first was incorrect. So naturally it will be quite easy for you to guess that option D is the right answer to this practice question. So with this, we conclude our discussion. Now the first question that appeared in the year 2022 from economy was related to a current event. Now if you can recall, back in 2022, Sri Lanka was facing severe balance of payment crisis. That is, it did not have enough foreign exchange reserves to pay for imports. Now Sri Lanka in general is dependent on imports to fulfill most of its domestic demand for food, fuel, etc. And this created an economic crisis in Sri Lanka. So naturally, like Pakistan, Sri Lanka also approached many countries to gain emergency funds, and this also included approaching the International Monetary Fund. And this was the subject of this year's question. However, the question was not asked on Sri Lanka, rather it was asked on funds utilized by the International Monetary Fund to provide emergency line of credit to countries who are facing BOP crisis. And this year it was Sri Lanka. Now these funds are not just available for countries during emergency crisis, but are also available for them to undertake various development of their infrastructure as well as undertake good governance reform. But the subject of the news was emergency line of credit to absolve or to solve the BOP crisis, and this was why the rapid financing instrument and rapid credit facility both are part of International Monetary Fund. That is why this question was asked. Now, what is more important among these two is the Rapid Credit Facility, called as RCF, because it is a part of Poverty Reduction and Growth Trust of the IMF, and it provides financial assistance which are concessional in nature to low income countries. Now, this is to alleviate their balance of payment crisis, and also these financial supports can be tailored for undertaking the diverse requirements of the least income countries. Now let us move to another question, and this one is a tough one. Why? Because it does not ask you the value of Indian rupee, whether it depreciates or not, but rather it goes deep by asking nominal effective exchange rate and real effective exchange rate. Understood? Now, for example, you may have heard in the news that value of rupee vis-a-vis US dollar is depreciating. That is, earlier for $1 you could gain as much as 50 rupees, but now you end up paying, for $1 you end up paying almost 84.5 rupees. So this is an example of depreciation of Indian rupee. But you have to understand that India does not trade only with the US, rather it trades with every other nation on the planet. For example, it trades with Japan, and there the payments may be made in yen, or if it trades with United Kingdom, there the payments may be made in in pound sterling. And this is where the net effective exchange rate or the concept of effective exchange rate comes in, because it is like an index where the important trading partners of the nation, the weighted average of the total trade value that is happening between India and its partner nations, it is calculated in a form of index. Now, when the weighted average of these trade is taking place, that is called as a nominal effective exchange rate. But if you adjust this NER or nominal effective exchange rate with that of inflation, the term is called a real effective exchange rate. But you have to understand that any increase in the nominal or the real effective exchange rate means that the currency value is appreciating. That means if NER increases, that means the value of rupee also increases. And same is that with relation to real effective exchange rate. So the first statement, an increase in NIR indicates the appreciation of rupee, is correct. The second statement, an increase in REER indicates an improvement in trade competitiveness. Now, how does value of rupee relates to trade competitiveness of Indian products? Now, for example, earlier the value of Indian rupee for every dollar was rupees 50. So technically, for every $1 paid by a citizen of America, they can get goods worth value of rupees 50. However, coming to the present time, where value of $1 is more than 84.5 rupees, that means for every dollar now, the American citizen will be getting 84.5 rupee worth of Indian made goods, which means for every dollar they are getting more amount of money. So in terms of competitiveness, it is naturally more beneficial for an American citizen to get more amount of rupee per every dollar they spend. And this is the sign of trade competitiveness. That is, the value of Indian goods in outside market, they are cheaper now, which means it will promote Indian exports to other countries. So an increase in real effective exchange rate means appreciation of currency, which means you can understand that is India's trade competitiveness will reduce and not increase. So second statement here is incorrect. Now there is this indicator called if the real effective exchange rate is greater than the value of 100, that means rupee or the trade competitiveness of Indian goods reduce. Now, I told you the difference between nominal and real effective exchange rate is that nominal is the value of exchange rate in the current year, whereas real effective exchange rate comes after adjusting NIR with that of inflation. So, in case there is an increased amount of inflation in any country, the value of NIR and REER will diverge. And thus third statement, an increasing trend in domestic inflation relative to inflation in other countries is likely to cause an increasing divergence between NIR and REER. It is a correct statement. So which of the above statement is or are correct? Second is incorrect. So option C, that is first and third are correct, is the right answer. Now let us move to another question. With reference to Indian economy, consider the following statements, and the first statement here it says that if inflation is too high, the RBI is likely to buy government securities. Now you have to understand how does RBI intervene in the money supply or how it controls the money supply. For example, whenever there is an inflation, which means there is an increase in money supply. Understood? Now to control or to reduce the money supply, in order to reduce the inflation, what the RBI does is that it tries to reduce the money supply. And by reducing money supply, RBI can control the inflation. And it can reduce the money supply by selling government securities. That is, whenever government security is sold in the market, that means the investors now will have government securities in hand, whereas the cash they had will now go to RBI, thus sucking out the liquidity in the market. So, in case the inflation is too high, the RBI is likely to sell and not buy government securities, because if RBI buys government securities, it will provide the investors with the requisite amount of cash, furthering the inflation, that is taking inflation higher. So, this is an incorrect statement. Now, if the rupee is rapidly depreciating, RBI is likely to sell dollars in the market. Now, whenever the rupee depreciates or the value of rupee goes down, whenever the value of rupee goes down, it means the supply of rupee is too high. And this supply of rupee is vis-a-vis compared to foreign currencies like US dollar. So this supply and demand mismatch between rupee and dollars can lead to either appreciation or depreciation of rupee. Now, rupee depreciation happens whenever the supply of rupee is higher compared to dollars. So, to balance this equation, what RBI does is that either it sucks out excess rupee or it pumps out excess dollar in the market. So, in case the rupee is depreciating, RBI is likely to sell dollars in the market to increase the supply of dollar, thereby controlling the supply of rupee and preventing its depreciation. So, second statement here is a correct statement. Now, moving to third statement, if interest rates in US or European Union were to fall, it is likely to induce RBI to buy dollars. Now, whenever an interest rate lowers in an economy, the value of its currency decreases. Why? Because the supply of currency increases. So, whenever a currency is available for cheaper amount of money, it is more likely that any foreign bank such as RBI will buy those money at a cheaper rate. That is why if the interest rate in US or European Union were to fall, that means the value of dollar or the value of euro will reduce, thereby making it cheaper for RBI to buy these, and hence third statement here is also correct. Now we have to identify correct option, hence option B here is the correct answer. Now moving to another question with reference to Indian economy, what are the advantages of inflation indexed bonds? Now bonds, you understand, are debt instrument which are sold in the market, and the returns that the investors get of holding these bonds are in form of interest income. However, the interest rate charged by these bonds are called as nominal interest rate. That is, suppose a bond offers 5% interest rate, that is called as nominal interest rate. But what happens if that year the inflation in the economy was higher than the bond rate, which means what if the inflation was 6%? So technically the investor will be losing money, and this is where the inflation index bonds come in. Because these inflation index bonds, they say that we will pay you premium over the inflation rates. For example, if the wholesale price index or this consumer price index is 6%, the inflation index bond says that we will pay 2.5% over and above the value of inflation. And this is just an example. So the intention of bringing these kind of bonds is to provide protection to investors from uncertainty regarding the inflation. Thereby, option second here is correct. Now, can government reduce its coupon rates by borrowing in way of inflation index bonds? Technically, yes, because as against offering a lump sum of interest rate, if the government says that we will provide you some premium over the inflation rates, it means that in case the inflation goes down, the government ends up paying less amount of interest. Whereas if the inflation was fixed the interest rate was fixed irrespective of the inflation levels, so there may be a time where the government ends up paying higher interest. So technically the cost of borrowing through inflation index bonds can reduce, and thereby government can reduce the coupon rates because the investors are already protected from the impacts of inflation. Option second here is also correct. Now moving to the third statement, the interest received as well as the capital gains on inflation index bonds are not taxable. It is incorrect, because like every debt instrument, both the interest income as well as the capital payment are subject to be liable for capital gains taxes. Thereby, third statement is incorrect. Now we have to identify correct options here. Option A is right because first and second was true. Okay. Now let us move to another question which is related to foreign direct investment or foreign owned e-commerce firms. Now technically e-commerce firms, they are of two types, that is inventory based firms or marketplace companies. Now in inventory based firms such as Blinkit, Big Basket, these companies or e-commerce companies, they maintain inventory by themselves. That is, they purchase goods from other companies and they stock it with themselves, thus thereby enabling them to fulfill the orders which are made by consumers on their platform. On the other hand, marketplace model, for example, these include Amazon, Flipkart. These are marketplace models. That means these websites, they provide a platform to sellers such as A, B, C, whereas these sellers list their goods on the website provided by the service provider and the consumers order them from this website. However, in the process of marketplace model, the websites which are hosting the marketplace model, they do not have any inventory with themselves. And in India, the foreign direct investment is permitted in marketplace model, whereas it is not permitted in the inventory based model. Now, there are certain restrictions on marketplace model also. That is, the companies which are related to the providers of the marketplace model should not sell their goods on the marketplace model company, and also they are not liable to holding any inventory of their own. So, the first statement, they can sell their own goods in addition to offering the platforms as marketplaces, they are incorrect. Whereas the second, the degree to which they can own big sellers on their platform is limited. It is also incorrect because they cannot own any company which are sellers on their platform. So, it is not limited, rather it is prohibited. So, in case the word here was prohibited, this would have been a correct statement, which it is not right now. So, from our discussion, what we infer? That both first and second are incorrect. Thereby, option D, neither 1 and 2 is the right answer to this practice question. Now, moving to another question, which is somewhat a straightforward question, but is also a tricky one, because it asks you to identify which of the following activities constitute real sector in the economy. Now, what do you mean by real sector? Real sector is the one where you cultivate, produce and sell the goods and services, that is called as real sector of the economy. As against, there is another paper sector or financial sector. These are interchangeable terms. That means any sector which involves transaction of money and funds or finances, these are called as paper sector. Now, understood the difference between real and paper sector? So, farmers harvesting their crops, it is an example of real sector, hence it is correct. Textile mill converting raw cotton into fabric, a production activity, again example of real sector. Now, third and fourth. A commercial bank lending money to trading company, is it real? No, it is related to money or financial transaction, hence it is a financial sector. A corporate body, pay close attention, issuing a rupee denominated bond overseas. Now, here the corporate body is not producing anything, rather it is issuing a debt instrument in the market, which is an example again of paper sector. So, third and fourth is incorrect because they are examples of paper and not real sector, whereas first and second are correct. That is why option A here is the right answer. Now, which of the following situation reflects indirect transfers often talked about in the media with reference to India? Now, India is a country where foreign investors invest in sectors such as defense, IT, etc. Now, there is this catch. That is, whenever these foreign investors are investing in India, so naturally they want to take out the returns also. But these returns are not taken out in a direct form. Rather, they are done so in an indirect manner. That is, an investor might be investing in a company and a return of which they might be getting their shares. So, rather than selling the physical items of the company, what the investor does is that they transfer their shares to other investors. And this is the what called as the process of indirect transfers. That is, a foreign company, when they transfer their shares and such share derives their value from the assets located in India, is an example of indirect transfer. That is, for example, Amazon India has certain amount of shares which is owned by the parent company, that is Amazon Inc. located in US. Now suppose, to get out of India, what the Amazon Inc. can do is that they can sell out their warehouses and other assets which are located in India. But rather than selling that assets, it can lead to significant amount of protest from India. What Amazon does is that it transfers the share to another investor. And this is what an indirect transfer is all about. Hence, option D here is the right answer. It was a straightforward question, directly appeared from the news. So, students who were appearing in that year might not have faced any problem with this particular question. Now, coming to another question which is related to expenditures made by an organization. Now expenditures made by organization are of two types. They are of revenue expenditures, that are expenditures which occurs in their day-to-day operations, like paying salaries or buying goods and services or paying pensions to their ex-employees. All of these are recurring instances of expenditures, thereby categorized as revenue expenditures. On the other hand, there are capital expenditures, which means any expenditure made by company on buying more assets like land, establishing factories, buying new machinery, or even upgrading their current ones are examples of capital investment, because these capital investment, they are intended to expand the businesses of company and enable the company to gain higher profits in years to come. So it is a long-term investment, whereas revenue expenditures are short-term expenses of the company. Now, acquiring new technology is a capital expenditure, which is a correct statement, quite straightforward. That is, acquiring new technology will help company have a technological upgradation, which again will enable the company to have higher productivity and naturally higher profits in upcoming years. So, first statement here is quite straightforward and also correct. Now, the second statement, debt financing is considered a capital expenditure, whereas equity financing is considered a revenue expenditure. Now, capital account deals with expenditures or liabilities made by the company, whereas revenue are not liabilities. That is, in case company sells goods and services into the market, the money coming in return for those goods and services are revenue income of the company. Whereas if the company takes loan in one form or the other, be it equity, selling of their shares through equity, or getting loan from the bank in form of bonds and agreements, these are examples of capital receipt, which means it creates a kind of liability on a company which the company has to return after the expiration of that liability. So, both examples of debt financing as well as equity financing are considered into the capital account and not revenue account. Hence, second statement here is incorrect. Now, the correct answer of this practice question is of this PYQ is option A, because only first statement was correct. Now, moving to another question. With reference to Indian economy, we have to consider following statements. The first statement, a share of household financial savings goes towards government borrowing. Now, which financial savings is the question talking about? Is the question related to public provident fund as well as other small saving schemes such as Sukanya Samriddhi Yojana. Now, a significant portion of the money of Indian people are invested in such small saving schemes because government offers higher return as compared to market returns. Thereby,
first statement here is correct. That is, a share of Indian household financial savings goes towards government borrowings. Now, these borrowings made by the government are a liability on the government. That is, after certain years, government has to return the principal amount of money in addition to interest rate to the original investors. So that is why they are a liability on the government account, and from polity, these are part of not consolidated account but public account of India. Now moving to second statement, dated securities issued at market related rates in auctions form a large component of internal debt. Now, internal debt is the debt which the government sources from inside India. It can be debt from other governmental bodies, it can be debt from RBI, or it can be debt from its own citizens. Now, major chunk of India's debt, that is more than 90% of debt incurred by Indian government, is sourced from domestic sources. And how government borrows these money is through marketable as well as non-marketable instruments. Now, example of market instruments are government securities, treasury bills, because the holders of these government securities can sell them in their open market to get the original money back from another investor, which means these instruments are liquid in nature. Now, about 70% of total government debt goes from or is taken from these following instruments. That is why they are a large component of internal debt, that is more than 70% in total. So, second statement here is also correct. Thereby, the correct answer to this PYQ here is option C, that is both 1 and 2 are correct. Now, I have given a detailed explanation of this also. And if you can see here, dated securities account for more than 70% of total internal debt by the government. So that is why they are large component. And marketable debt instruments include treasury bills, which are issued in auctions, and also other instruments such as government securities or state developmental loans, which is securities issued by various state governments. Now moving to the next question, which is quite a straightforward question. Tight monetary policy of United States Federal Reserve could lead to capital flight. Now what happens if US Federal Reserve were to follow tight monetary policy, which means the interest rates in US economy will rise, which means it will make it attractive for investors to invest their money in the US economy. So in case the US Federal Reserve increases the interest rate, that is following a tight money policy, that will lead to capital flight from countries like India, where otherwise foreign investors have been investing their money from. So first statement here is correct, because tight monetary policy increases the attractiveness of any economy, and if it happens in US, that can lead to capital flight from countries like India to US. Now, capital flight may increase the interest costs of firms with existing external commercial borrowings. Now, what happens when a company goes to borrow from external sources or outside India? Now, technically, the borrowings made by companies from outside India are made in foreign currency, which means whenever they have to pay the money back, originally they will converting their domestic currency into foreign currency. Now, in cases of capital flight, what happens is that the supply of dollars in Indian economy reduce, and it increases the depreciation of Indian rupee, which means earlier if you were to pay only 80 rupees per dollar, after capital flight there is a chance that the value of $1 in Indian currency terms may increase to 85 or 90. So naturally, if you were to return fixed amount of dollars from India, it will require you to spend more rupee for every dollar that you have to do. And this may increase the interest cost of firms also. So, second statement here is correct. Now, devaluation of domestic currency decreases the currency risk associated with ECBs. Now, in case of devaluation of domestic currency, the value of rupee decreases, which increases the cost of companies of returning their loan back. That is, you can also say that when the cost is increasing, that means the risk is also increasing, right? So, third statement here is incorrect because devaluation of domestic currency increases and not decreases the currency risk associated with external commercial borrowing. So, third statement was incorrect. That is why option A here is the right answer, because we have to identify correct options. Now moving to another question, and it was somewhat a tough question because the questions is related to credit rating agency. Now, you all may have heard about what are credit ratings, because these credit ratings which are issued for you and I, it reflects our ability to return any loan that we have taken back. So, higher is the credit rating, which means the more it is likely that the person with that higher credit rating will return the money back. And banks naturally want to give loans to trusted people, that are people who can return money back timely. And this is what credit rating agencies do, that they assess our ability based on various data, that is data of our previous transaction with financial institutions, data related to our utility payments such as electricity bill, telephone bills. These are data which are utilized by credit rating agencies to provide a credit rating for individual borrowers. Now, this was called a credit score, which is related to individual borrowers. Credit rating agencies, they assess credit rating of companies or of sovereign bodies like governments. Now, in India, these credit rating agencies are regulated by Securities and Exchange Board of India and not the Reserve Bank of India. So, first statement here is incorrect. Now, second and third statement, if you can see, are very factual in nature. That is why I told you this question will be tough. Now, there is this rating agency called ICRA, which was set up back in 1991 as a public limited company by our country's leading financial institutions, banks, as well as other independent financial services company. Now, the purpose of this body is to provide or act as a credit rating agency. Hence, if you can see, second statement here is a correct statement, because although it is a public limited company, however, it is also a credit rating agency. Now, moving to the third statement, Brickworks Rating is an Indian credit agency. Again, a very factual statement and also a correct statement, because this company is indeed an Indian credit rating agency, and the name of this company is also reflected in the website of SEBI, probably from which the UPSC has formed a question. So, these kind of questions which have absolute facts, and in case you do not have an idea about the absolute facts, you may try to skip this question, because guessing this question is a tough job. Now, as first was incorrect, second and third was correct. That is why option B here is the right answer, because we were to identify statements that are correct. Now, let us move to another question. This was a simple one. It is reference to Bank Boards Bureau. Now, Bank Boards Bureau was an agency previously which was replaced now by a different body called Financial Services Institution Bureau. Now, if you can recall, this was an autonomous body, part of Government of India, which was tasked primarily to select and search for persons who can appointed to be the board of public sector units and banks. Now, not just banks, these board was also responsible for selecting and approving of persons who can be appointed to the directors of public sector insurance companies also. Now, the mandate of this bureau, in addition to appointing and searching the eligible people, was also to help the government deal better with the banking business. And in that regard, this bureau also provided helps to banks by developing better business strategies and how to raise capital from market. Now, the chairman of this banking board bureau was appointed by the union government, and he was not the chairman of, or he was not the governor of RBI. So this was an easy question. So coming back to the question, the RBI governor, is he the chairman of Bank Board Bureau? No, incorrect, because chairman of Bank Board Bureau is a different person who's appointed by union government, and ex-CJI, Mr. Vinod Rai, who you may recall became famous because of 2G scam, because he unearthed the scam. He was appointed as the first chairperson of the Bank Boards Bureau. Coming to the second statement, Bank Board Bureau recommends the selection of heads for public sector banks. Directly a correct statement, because it was the primary responsibility of Bank Boards Bureau. And the third statement, it helps public sector banks in developing strategies and capital raising plans. So third statement here also correct. That is why option B is the right answer, because second and third is the correct statements. Now, let us deal with question related to convertible bonds. Now, you may realize bonds are debt instruments, which means investors in bonds are liable to get interest income in addition to their repayment of capital. Now, the question is, what are convertible bonds? Now, there is an option in a convertible bond that the holders of the bonds, they may change their debt stake into an equity stake. That is, for exchange of their money that they have paid as a debt, they can change their ownership of the debt into an ownership of a stock. And this gives the benefits of the investors, such as the investors are now liable, after converting their bonds into an equity instrument, of undertaking or gaining more profits from the company. And this is what the convertible bonds is all about, that there is an option to exchange these bonds for equity. Therefore, convertible bonds in general, they pay lower rate of interest because they are a more flexible kind of instruments. That means the person who is owning a convertible bond can change their bond to an equity instrument anytime. That is why their demand in the market are higher. So the companies provide lower interest rates on these bonds. Now, the option to convert to equity affords the bondholder a degree of indexation to rising consumer prices. Now, what happens in case any fixed bond witnesses an increase in inflation? Now, I told you already, there is a nominal interest rate which the bond might offer, say 10%. Okay. But what if the inflation levels in the economy becomes 12%? So from that logic, the real interest rate on these bonds is minus 2%. That is, the investor is losing 2% of their money because of rising interest rates. Now, in case there is an increased inflation, so what the convertible bond owner will do is that he or she will change that bond into a convertible bond, which means their debt becomes equity, thereby they are liable to be protected against increase in interest rates. So, second statement here is correct, whereas first also was correct, because the convertible bond are a more lucrative investment device. That is why the demand for these instruments are higher in the market, which enables the companies to lower down their interest rates. So, option C is the right answer, because first and second statement are correct. Now, moving to last two questions, and these two questions are very straightforward. Which of the following is responsible for maintaining price stability by controlling inflation? Now, if you can recall our previous discussions, that the RBI Act of the year 1934 was amended back in 2015, and it gave the responsibility to RBI to keep the inflation levels in Indian economy between 2 to 6%, that is 4% and plus minus 2%. So the RBI now has a statutory responsibility. That means it is legally a responsibility of the RBI to control inflation in the economy. And how does RBI control inflation? Through monetary policy. That is, it can increase or lower the money supply in an economy, which naturally will control the inflation. So option D here is the right answer. Quite a straightforward question. And with this, another question: which of the following compiles information on industrial disputes in India? It is the Labor Bureau which does that, as it compiles the information related to which companies are facing closures or they are laying off employees. So Labor Bureau is the right answer to this question. So this concludes our discussion of the year 2022 prelims PYQs. Now let us consider this first statement. Consider the following statements. The governor of RBI is appointed by the central government. Now recently a very big development happened that after the 6 years tenure of outgoing governor Mr. Shaktikanta Das, new governor has been appointed, that is Mr. Sanjay Malhotra. Now who is appointing the governor of RBI? Is it the president or is it the central government? Now according to the RBI Act of the year 1934, it is the central government who appoints the governor of RBI. So first statement is correct. Now moving on to the second statement. Certain provisions in the Constitution of India give the central government the right to issue directions to the RBI. Now we know RBI is an autonomous organization. However, this autonomous is not an absolute autonomy, but rather a qualified autonomy, that under usual circumstances, the government, it does not interfere with the day-to-day functioning of the RBI and country's monetary policy and the banking system, the regulation of which is given to the RBI without any interference by the government. However, in case public interest justify, the government can intervene or give or issue directions to the RBI. But the provision of this direction is not given in the Constitution. Rather, it is given under Section 7 of the RBI Act. Now, this section has been reported quite frequently that whenever there is a disagreement between the government and RBI, there are media reports that says that the government should use the provisions of this particular section of RBI Act and issue directions to the RBI. But certain directions given by the government comes with a caveat, that is, it will compromise, you can say, the autonomy which is otherwise extended to RBI. So in practice, although this section exists in the RBI Act, but in practice this has not been yet applied by the union government. So second statement here is incorrect because it is given not in the Constitution but in the RBI Act. Moving to the third statement, the governor of RBI Act draws his power from the RBI Act, and third statement is correct because if you look at the solution that I have provided to you here, under Section 7 subsection 3 of RBI Act, the charges of superintendence over the banking sector or handling the normal affairs and business of the RBI, it is vested in the office of RBI governor, and in his absence it is discharged by the deputy governor of RBI. So third statement here is correct. Now first and third is correct, second is incorrect. That is why option C here is the right answer to our first question in 2021. Now let us move to another question. With reference to casual workers employed in India, consider the following statement. Now, all casual workers are entitled for employee provident fund coverage. Now, employee provident fund coverage is extended to casual worker or is it not? Yes, coverage of employees provident fund is extended to casual worker, but there is a catch. That is, only firms who employ more than 20 people, which includes both fixed and casual worker, are eligible to contribute to EPF fund. So technically, if a casual worker is employed in a company which has only 10 employees, then that casual worker will not be eligible for benefits under the employee provident fund. So the question asks, are all casual workers entitled? The answer is no. Only the casual workers who are employed in companies providing employment to more than 20 people are eligible. Therefore, first statement here is incorrect. Now moving to second statement, all casual workers are entitled for regular working hours and overtime payment, and this is correct. That is, employment rules of the year 1950, it states that every worker, be it casual or fixed, are entitled to overtime pay. Now this overtime pay for agricultural worker is 1.5 times the usual wage rate, whereas for all other workers it is twice the amount. That is, the per hour basis of their wages are calculated, and if they are working 1 hour more, then they are eligible to get twice the amount of per hour basis compensation by the employee. Understood? So second statement is correct. Now government can by a notification specify that an establishment or industry shall pay wages only in the bank account. This is also correct. Now, usually the payment to casual workers are made in form of cash. However, this allows the company to keep the worker in an informal sector. That is, the workers, even if they are getting more amount of money, the money will not be subjected to taxation because it will be outside the formal banking system. Now, government on the other hand, it wants the companies to pay directly to the wage workers and directly transfer the amount into their bank accounts. So this provision has been provided, and therefore third statement is a correct statement. So which of the following is or are correct? Easily we can mark option B because first was incorrect, whereas second and third are the correct options. Now let us move to the third question. Which of the following steps is most likely to be taken during an economic recession? Now, economic recession is a period of slowdown where the overall growth levels of the economy reduces, and it also has implications on less creation of jobs, and can also lead to people getting fired from their jobs. So in order to bring the economy out of recession, what the government and central bank wants to do is to increase the level of money supply. How can government or central bank increase the level of money supply? That is through expansionary fiscal policy and monetary policy. That is, in terms of fiscal policy, the government will try to reduce the tax rate so that people have more disposable income, whereas the central bank will try to reduce the market interest rate so as to make loans cheaper, thereby promoting economic growth. So any measure, be it fiscal measure or a monetary measure, if it is expansionary, it will be taken during a time of economic recession to bring the economy out of recession period. So cut in tax rates is an expansionary fiscal policy accompanied by increase in interest rates. It is a rather contractionary monetary policy. So first is incorrect. Increase in expenditure on public projects is correct. Why? Because by increasing expenditure on public project, what the government wants to do is wants to first of all create infrastructure, and not just create infrastructure, but these infrastructural projects will employ more and more people, thereby enabling them to gain sufficient income out of their work. Also, such infrastructural project has a long-term implication on the growth levels of economy. That is, when you create infrastructure level, it will lead to higher economic growth in the future. Now, third, increase in tax rate is an contractionary fiscal policy. whereas accompanied by reductionary interest rate is an expansionary monetary policy. So third also is incorrect. Reduction in expenditure on public project is the opposite of what B intends to do, hence it is incorrect. So option B here is the right answer to the following question. Okay. Moving on to another statement, and this is related to microeconomy, but I'll ask students not to get afraid by the term microeconomy, because most of these questions which are asked in the economy section, they can also be solved by application of simple common sense. And let me tell you how to solve this question without having the knowledge of microeconomy. Now consider the following statements. Other things remaining unchanged, market demand for a good might increase if. So it asks, what if the demand of good increase? So what are the conditions will promote demand or market demand of a following good? The first is price of substitute increases. Now there are two closely related beverage, that is tea and coffee, and these are substitute beverages that people either drink tea or they drink coffee. So what if the prices of coffee increase? That is the substitute of tea. So people who are drinking coffee will then move towards tea because it is a cheaper alternative. Therefore, we can say the demand of tea will increase in case the prices of coffee increase. Understood? So first here is a correct statement. Now price of its complement increase. Now there is a beverage called tea, and what is the complement of tea? That is sugar in most cases, because people in India specifically prefer to drink tea with sugar in it. So sugar is a complementary good of tea. Now what happens if the sugar's prices increase? So naturally, a person who is drinking 4 cups of tea every day will try to reduce the amount of tea so as to reduce the amount of money they spend on sugar, which the price of which has increased. So the consumption of tea in this regard will decrease because of increase in prices of a complementary item called sugar. So price of its complementary item increases, the market demand reduces, hence second is incorrect. Now the good is an inferior good and the income of consumer increases. For example, people who smoke bidi. Now bidi is an example of inferior good. So if the income of a person who smokes bidi increases, don't you think that person will move to smoking cigarettes? So in case the good of is an inferior good and the income of consumer increases, the demand for inferior good reduces, thereby market demand of inferior good reduces. Option 3 is incorrect. Now fourth is quite a straightforward point, that is what if the price falls? So naturally, if you are consuming tea every day and the prices of tea falls, so previously you might be having 4 cups of tea every day, now you'll start having 5 or 6 cups every day. So the market demand of any good increases in case its price falls. So fourth here is correct. So which of the statement given above are correct? First and fourth is correct. Therefore, option A is the right answer to this practice question. Now, let us move to another question related to Urban Cooperative Bank. Now, Urban Cooperative Bank has been in news for quite some time because many urban cooperative banks, particularly in the state of Maharashtra, went insolvent, and as a result, the deposits in these banks became a risk of being non-payable by the banks. So as a result, what the RBI did was that it brought urban cooperative banks within the regulatory ambit of itself. So are urban cooperative banks regulated and supervised by local boards set up by state governments? The answer is no, because urban cooperative banks are subjected to dual regulation. That is, their administrative work is handled by local state boards established by state governments, whereas their banking related functions are handled not by local boards but by the Central Bank of India called Reserve Bank of India. So first statement here is incorrect. Now urban cooperative banks can issue equity shares and preference shares. This is correct because earlier the urban cooperative banks were restricted from issuing shares and therefore they can only gain more and more capital from their investors, that is their depositors. But this led to solvency problem in the urban cooperative banks. Therefore, government changed the regulation and enabled these urban cooperative banks to issue equity shares and preference shares to other investors so as to allow them to have more and more capital. Therefore, second statement is correct. Now, third, they were brought under the purview of Banking Regulation Act through the amendment in 1966. This is a correct statement because Banking Regulation Act was amended. Therefore, they were brought under the purview of RBI through this very regulation. So, third statement also is correct. Now, as first was incorrect, therefore, option B is the right answer. That is 2 and 3 are correct. Now, let us move to another question. The Indian government bond yields are influenced by which of the following? Now, this is a very important concept as far as your prelims examination is concerned. That is the concept of bond yield. Now, bond yields cannot be judged directly. Rather, they can be judged with relation to their bond prices. And let me tell you how the bond prices change. For example, a bond was issued at a face value of rupees 100 and it provided in return that after a year, the bondholder will get rupees 105. That means the interest rate on this particular bond is 5%. And this is what bond yield is also called. That is, the return on the bonds is called bond yield. Now, what if for some reason the bondholder, which has brought that bond for rupees 100, wants to invest the money which is locked in the bond somewhere else? So that investor will be forced to sell this bond to another investor for rupees 95. But originally the bond said that it will pay 105 to the bondholder after a period of 1 year. So in that regards, the interest rate of the newest bondholder who has purchased the bond for 95 becomes 10.5%. So bond yield has become more than doubled. Now, if you can see, as far as bond prices are concerned, as the bond prices reduce from 100 to 95, the bond yield increases from 5 to 10.5%. So we can establish a correlation here. That is, bond prices is indirectly proportional to bond yields. I will write it again. That is, bond prices is indirectly proportional to bond yield. So in case bond prices reduce, bond yield goes up. Now, each and every correlation in terms of bond, you have to establish the correlations with bond prices, and naturally you can then realize what the effects on bond yield will be. And let me tell you how. For example, actions of the United States Federal Reserve. What if the United States Federal Reserve increases their interest rate? So the investors in the case of an increased interest rate of United States Federal Reserve will be selling their bond holdings in India and move their money instead to US so as to gain much better economic returns in US. So naturally, in that case, if the bond prices go down and up, it will have an impact on bond yield. So first statement here is correct. Now, actions of the RBI. This is also the same as compared to United States Federal Reserve. Now, bond are a debt instrument that people who have invested in the bond have locked their funds for a period of 1, 2 or 3 years. Now, what if in that case the RBI increases the interest rates in Indian economy? So naturally, the bond holders in India will want to shift their funds to the banking sector so as to gain maximum advantage of this increased interest rate. So again, the prices of bond will reduce, thereby increasing their bond yield. So again, actions of the RBI has impact on government bond yields. Now, inflation and short-term interest rates. Now, in case there is an inflation, it puts bondholders at a disadvantage. Because, for example, earlier, if the bondholders had blocked their fund at 5% interest rate, and if the inflation level becomes 6%, so technically the real interest rate for bondholders will be minus 1%, that they will be losing 1% of their money because of inflation. And also short-term interest rates by the RBI again can put bondholders at disadvantage. So as a result, bondholders in cases of inflation will try to sell their bonds and move to other financial instruments which are paying higher interest rates or higher economic return. So third statement here is also correct, because inflation levels changes the levels of bond prices, thereby impacting or affecting their yield. So all these three are correct. That is why option D here is the right answer. So in case any bond yield question comes, you do not have to worry. You first have to establish the correlation with bond prices, and naturally by following this formula, you can highlight that in case bond prices goes up, bond yield goes down, and vice versa. Understood? Now let us solve another question where 4 instruments are mentioned, and which of the following can be included as a part of foreign direct investment. Now, by the definition of foreign direct investment, any investment made in India, if it is more than 10% of the total value of the company, it is categorized as a foreign direct investment, and if it is less than 10%, it is categorized as foreign portfolio investment. So this is the definition. Now, foreign currency convertible bond. Now, these are bonds, which means they are debt instruments, so cannot be equity. However, when the convertible bonds are there, which means the bondholders, they will have an option to change their debt instrument into an equity instrument. So any bondholder who has purchased the bonds worth more than 10% of the value of company, that can be converted into an FDI, hence first is correct. Now, foreign institutional investment with certain condition. Now, foreign institutional investment, as I've already said, are investment less than 10% of the company's value. But what if this investment after some period goes more than 10%? So in that case, the FPI is now eligible to be converted into FDI. That is under certain conditions, that is more than the required level of investment required for FDI. Therefore, second is also correct. Now, global depository receipts. Now, these are receipts which are issued by Indian companies in foreign markets, and by purchasing these receipts, the investors, foreign investors, can invest in Indian companies without the need of undergoing KYC requirements in Indian stock markets. However, this is also a equity instrument. That is, in case an investor purchases more than 10% of equity, that case he or she will be eligible to be called as a foreign direct investor. So first 3 are correct. Now moving to the fourth, non-resident external deposits. Now these are deposits made by non-resident Indians into Indian banks, and these can be in form of savings or fixed deposit. So these deposits actually are bank deposits which are made in the bank itself, and it has no relation with respect to investment in any company. So fourth here is incorrect. That is why from our discussion we can safely conclude first 3 is correct. Therefore, option A is the right answer to this practice question. Now let us solve another question which is quite straightforward. The effect of devaluation of currency is that it necessarily, which means you have to gain a certainty with respect to devaluation of a currency. Now suppose today $1 has a value of rupees 80. So what will happen when the rupee devaluates, which means after devaluation we can say that the value of $1 becomes 90 rupees. Value of $1 becomes 90 rupees. So this is the effect of devaluation of the currency. So is increase in foreign value of devaluation currency an effect of devaluation? The answer is no, it is the opposite, that it reduces and not increases the foreign value of domestic currency, which you can see from this example. Earlier, for every dollar you were only required to pay 80 rupees. Now you have to pay 90 rupees. That is the value of rupees decreasing. Now, does it improve the competitiveness of domestic exports? The answer is yes, because earlier foreign investors or purchasers of goods and services in India, they can get maximum of 80 rupees worth of goods for their $1. But what if the currency devaluates? So suppose they were purchasing goods worth of 80 rupees, for which earlier they were required to pay $1 every time. But now their dollar can be exchanged for as much as 90 rupees. So in case they were purchasing good rupees 80 rupees, they have left 10 rupees with themselves even after purchasing of goods. So this in effect highlights that the domestic products, by the virtue of devaluation of currency, becomes cheaper, and hence it improves the competitiveness of domestic exports. So earlier they were required to pay $1 for every 80 rupees, but now they will only be required to pay, say, $0.8 for every good that they are required to purchase. Now, does it improve the trade balance? The answer is no, because in case the country is a net importer of goods, and after the devaluation stuff happens, the country's imports will become more expensive. However, it is also true that their exports will increase because their goods competitiveness has increased. But we can't say for sure whether imports will be more or exports will be more. So it can improve, but will it necessarily improve the trade balance? The answer is no, because it can also worsen the trade balance. Thereby, as only first statement is correct, hence option A is the right answer to this question. Now let us move to another question. Which of the following effects of creation of black money has been the main cause of worry for government? Now all these four are a cause of worry, but what is the most or the main cause of worry for the government is that creation of black money means that the money is out of the formal financial system. And in that case, when it is out of India's financial system, the government can't assess the flow of black money. So in case my income is in form of black money, the government will not be able to impose taxes on my black money income. And this will result into loss of state exchequer of the government due to a process called tax evasion. Now, all of these three are also a cause of worry, but the main cause of worry you have to understand is the loss of revenue to the government because of tax evasion. And this eats up the economy in longer term. Because although the large donation to political parties happen or unproductive investments happen, these have somewhat short-term implications. But on an economy, the long-term implication is that the government will not be able to muster enough resources for its day-to-day functioning. And this creates a problem of debt in the longer term. Now, let us solve which of the following is most likely or most inflationary in the effect. That is, all of these four are somewhat inflationary in effect, but we have to understand which of the following creates highest amount of inflation in the economy. Now, repayment of public debt. So in that case, the government may borrow from Reserve Bank and then repay the public debt. However, the total number of money supply may remain the same. Now, borrowing from the public to finance budget deficit also leads to same amount of money supply, because rather than borrowing from another sources, government is borrowing from public. So the money which is sucked out of public is then used by government to repay their debt, thereby keeping the money supply exactly the same. Now, borrowing from banks to finance budget deficit also has the same impact, that bank could have otherwise extended the loans to private sector or the individuals like you and I, but rather when government is providing the same amount of money to government to fulfill its borrowing needs, it creates no change in money supply. Now let us consider the last statement, that is creation of new money. Now creation of new money itself means the money supply will increase. Now as money supply increases, this is the most inflationary impact on the economy, and thereby option D here is the right answer to this PYQ. Now money multiplier in an economy increases with which of the following? You have to first understand what is money multiplier. Suppose I deposit rupees 100 into my bank account. Now naturally there are reserve requirements with the bank, that is 80 rupees or 20 rupees of this money has to be kept by the bank in cash reserve ratio or statutory liquidity ratio, whereas the rest of 80 rupees can be given by the banks in form of loans. So suppose person A gets this loan from my bank. Now what this person does is takes 80 rupees from bank and deposits into his or her own account in form of 80 rupees. Now this exactly the same thing will happen, that is 20% of 80 rupees, rupees 16 will be kept by bank as reserve, whereas next 64 rupees will be given as a loan to another people. Now this process repeats until the total reserve requirements becomes 100. That earlier it was 20, then you add 16 rupees. So technically for every 100 rupees deposited into bank account, and if the reserve requirement is 20%, the bank can extend loans for as much as 400 rupees. Now this is what money multiplier is. That is originally 100 rupees becomes 400 rupees by the virtue of banking system, that it multiplies multiple times because of banking system. So naturally any habit in the banking which promotes persons to deposit their funds into banking account is what increases the money multiplier in the economy. Now suppose increase in cash reserve ratio in the bank. So what if bank increases this reserve ratio requirement? So technically if from 20 the bank increases it to rupees 30, that means the banks then can only extend rupees 70 in first case, and out of 70 they can only extend 49 in the second case. So for every 100 rupee deposited, in case the bank increases the reserve requirements to 30, it will become rupees less than 400. Sorry, it will become less than 400 rupees. So by increasing the cash reserve ratio and liquidity ratio in the banks, what the bank is or the central bank is trying to do, it is trying to reduce the money multiplier levels in the economy. So first and second won't be the correct option. Now increase in banking habit of the people. Yes, increase in banking habit means more and more money are deposited into the banks, which will enable banks to then give away these monies at a form of loan, thereby increasing the levels of money multiplier in the economy. Now increase in the population levels of the country does not necessarily increase in money multiplier, because what if this population does not deposit their money into banks and they keep cash with themselves? So fourth also is incorrect, thereby option C here is the right answer to this practice question, because in any cases of increase in reserve requirements, the money multiplier goes down. And what if the central bank, that is RBI, wants to increase the money multiplier? It reduces the levels of CRR and SLR, which are reserve requirements on the banks. So option C here is the right answer. Now let us move to another question with reference to economy. Demand pull inflation can be caused by which of the following? Now there are two types of inflation. First is demand pull inflation, and second is cost push inflation. Now, demand pull inflation, naturally from the word itself, you can say this inflation is caused by increase in levels of demand in the economy. So in any case, if the bank follows an expansionary monetary policy, that is promoting more money supply in the economy, this will lead to increased demand for goods. Thereby, the resultant inflation will be called as demand pull inflation. Now, the second is called cost push, which means increase in cost pushes the inflation up. And this can be caused by increase in factors of production. That is, what if the rent of the factory increases, or what if the wages of worker increases, or what if the cost of capital increases. All of this will increase the cost of final products manufactured by the company, and thereby increasing the inflation, and will be called as a cost push inflation. So the first statement here is expansionary policy. It increases money supply. Therefore, it is an example of demand pull inflation. So is the fiscal stimulus, which is again intended to increase money supply, thereby increasing the demand levels in the economy. Now, third is higher purchasing power. It is again an example of demand pull inflation, because higher purchasing power means the demand for goods and services increases. Thereby, this results into inflation called as demand pull inflation. Now, rising interest rates is an example of reducing the money supply. So, this does not lead to inflation, hence, fifth is incorrect. Now, inflation indexing of wages. Now, what if there is an inflation in the economy? That means the wages of workers will increase as per inflation, thereby increasing the cost of goods manufactured by any company. And this is an example of not demand pull inflation, rather it is an example of what? Cost push inflation. So, third here is incorrect. So, first, second and fourth is correct, thereby option A here is the right answer. Now, retail investors through Demat account can invest in treasury bills and Government of India bonds in primary market. This is a correct statement. And why is this a correct statement? Because they can literally invest in primary market through RBI's retail direct scheme. That is, earlier only scheduled investors such as primary dealers and financial institutions were allowed to participate in the primary market, but to increase the participation of retail investors, RBI has brought this retail direct scheme, thereby enabling retail investors to invest in government bonds in the primary market itself. Now, what is primary market? It is the market where these bonds and treasury bills are issued. Now, after these are issued and given to investors, and if the investors decide to sell these securities, it will then be called as a secondary market. Now, second statement, the negotiated dealing system order matching is a government securities trading platform by the RBI. Again, factual and very much a correct statement, because the membership of the system is open to entities like bank, primary dealers, etc., who maintain a sovereign account with the RBI. Now, these primary members are permitted by the RBI to become members of the negotiated deal settlement platform. So, you can look at the solution that I have provided here after the session ends. And the gilt account holders who have gilt account with the primary members are permitted for indirect access. So, if the question would have asked, are gilt account holders can access NDS OM platform, the answer would have been no, because they are allowed to indirectly access through their primary merchants or primary members. Now, the third statement, that is CDSL, is it promoted jointly by the RBI and Bombay Stock Exchange? Although it is promoted by Bombay Stock Exchange, however, it is not promoted by the RBI, rather it is promoted by a handful of public sector scheduled commercial banks. So, third statement here is incorrect. So from the question, we can safely say first and second was correct. Thereby, option B here is the right answer. Now in India, central banks function as lender of last resort usually refers to which of the following? Now central bank like RBI plays a very important role in the economy. That is, it is a banker to the government. That is, when governments require funds or requires money to borrow, they do not approach scheduled commercial banks. Rather, they approach the Central Bank of India, RBI. And RBI also has another important function, that is, it is lender of last resort, that whenever banks face liquidity crisis and they cannot get more liquidity in the open market, then they can approach to the RBI to enable it to get more liquidity. And these liquidity are extended to RBI at interest rates which is called as a repo rate. Now, does lending to trade and industry bodies when they fail to borrow other sources is a function of RBI? The answer is no, because RBI does not involve in direct lending. Rather, it promotes scheduled commercial banks to engage in direct lending. Second, providing liquidity to the banks in the temporary crisis. Yes, it is an example of lender of last resort function. Thereby, second is a correct statement. Now, lending to the governments to finance budgetary deficit, it is a part of responsibility of RBI as it is a banker to the governments, be it state or be it union. So this is a function called banker to governments. Hence, it is not a function to be categorized as a RBI acting as a lender of last resort. Thereby, third, although a function of RBI, but cannot be said as a part of lender of last resort function. So from our discussion, we can safely say option B is the correct answer because only second here statement is a correct statement. Let us move quickly to the first question, that is deals with exposure of global financial crisis to Indian economy. Now, if you read the question here, if another global financial crisis happens in near future, which one of the following actions or policies are more likely to give some kind of an immunity to India? Now, why does any financial crisis have global implications? Because now the world is interconnected. That is, the world witnesses flow of goods and services across the borders, which also entails flow of money from one country to another and to third country and so on. So any global financial crisis will have implications just because there involves a global transaction of goods and services and money. So any policy which reduces this India's exposure to foreign markets will reduce India's chances of coming under a global financial crisis. So first, not depending on short-term borrowings, that is foreign borrowings. Now, for any foreign borrowings which is made by Indian entities, it has to return that exact borrowing into the currency from which it was originally borrowed from. For example, if any foreign borrowings was made in form of US dollars, then the Indian companies will again have to repay the loan in form of US dollars only. And during the time of global crisis, what we witness that the exchange rate of one currency, that is rupee, from that of dollars varies. It varies quite a lot. So when India is not depending on short-term foreign borrowings, it will reduce India's vulnerability from coming into global financial crisis. Also, it is important to note short-term borrowings. Now, any borrowing which is made for a short-term period, that is less than 1 year, you have to repay that loan back quickly, and it makes you more vulnerable to any currency crisis, that is change in the rates of rupee with that of other foreign currency. Okay. So first here is correct, that is when India will not depend on short-term foreign borrowings, then India will have a reduced vulnerability as far as global financial crises are concerned. Now opening up of more foreign banks. Now opening up of foreign banks in India puts India at a risk of global financial crisis. How? because you understand a foreign bank will have branches not just in India but also in their parent country and also another countries. So the chances is that the bank's balance sheet may be affected due to global financial crisis, which will also have an impact on Indian economy. So opening up of more foreign banks makes India more vulnerable and not less vulnerable to global financial crisis. So from the perspective of this question, second statement is incorrect. Now third statement, maintaining full capital account convertibility. Now what do you mean by capital account convertibility? That is capital account, that is restrictions related to FPI or foreign institutional investment. When they are eased in India, it is called as full capital account convertibility. That is, there are no restrictions on foreign investment in India. That is why such move, that is easing out the restrictions on capital account, will again make India more vulnerable to global financial crisis, because if India eases the conditions for foreign investment, and in case of global financial crisis, these investments will try to sell off their positions in India and move to their domestic country, again making India more vulnerable to such global crisis. So from the perspective of the question, again third here is incorrect. So which of the statement here is correct? Correct answer is option A, as only first was correct. Now let us quickly move to another question, which is quite a straightforward question. But in an exam condition, this question will prove quite tricky, and let me tell you why. Because questions regarding money supply or articles regarding money supply are frequently available in the news cycle. But do you know this question was asked on a very basic topic which is available even in the NCERT. That what happens if you withdraw 1 lakh rupees in cash from your demand deposit account at your bank, and the impact of this move on country's aggregate money supply. Now what is money supply? There are various definitions to it. But let us consider the narrow definition of money supply termed as M1. Now this M1 of money supply, it includes cash in hand plus deposits in bank. Now what kind of deposits are eligible to be counted as under money supply? Does it include demand deposits, which include demand deposits in your current account and saving account? Yes, it does. Because these kind of deposits, they are liquid in nature, which enables you to withdraw them from your bank account and deposit them into bank account at your own ease. Another kind of deposits are term deposits, which are deposits made for a longer period of time. This includes fixed deposit as well as recurring deposits. Now this term deposit will not be counted under the definition of money supply, that is narrow definition of money supply. So cash as well as demand deposits are already counted into money supply. And what happens if you withdraw 1 lakh rupees from your deposit account and it is available to you in a form of cash? However, if you go by this particular definition of money supply, there will be no change in the money supply because you are withdrawing the money from demand deposit of your account. However, if you had withdrawn the money from term deposits, then it would have increased the money supply by a sum value of 1 lakh rupees. So coming back to the question, if you withdraw 1 lakh rupees from your demand deposit account, it will have no impact on the money supply. Therefore, it will leave the money supply unchanged, and hence option D here is the right answer. Now let us move to the third question, which is related to gold tranche, also known as reverse tranche, and what does it refer to? Now if you look, the countries which are members of IMF, they are allocated a certain amount of quota based on many conditions. For example, the highest quota which is given to a country in IMF is naturally the United States of America, because it is the world's largest economy. Whereas the quota of India in IMF is 2.75%, which was only increased a few years ago. Now, based on quota which is allocated to every country, the countries, they are required to deposit some kind of money with the IMF. Now, technically, it is 1/4 of the quota which is allocated to every country. Now, this money, that is 1/4 of your quota, it is kept with the IMF by the country called India or other countries, and India can withdraw the money from this account under certain circumstances, which include balance of payment crisis. So this is what reverse tranche is all about. That is, a country, based on their respective quotas and 1/4 of the amount of money, they are required to keep into IMF as a form of deposit, and it is also counted under the foreign exchange reserves with any country maintains. So this is a part of IMF, and it can be used for different purposes, including the purposes of balance of payment crisis. So, going by our discussion, the correct answer to this question is option D, as it is a credit system granted by IMF to its members, and the members can utilize this credit system, the money which they have kept with IMF themselves, under certain circumstances. So this was a quite straightforward question. Now moving to another question which was somewhat trickier, because it asked a question related to interest coverage ratio. Now, interest coverage ratio occurs quite frequently in the newspapers. However, the attention to this kind of a topic is somewhat less as far as UPSC exam is concerned. However, now such type of questions have been asked, so you are required to understand different terms which are used in the economy lexicon. Now, the interest coverage ratio, it means the ability of the company to repay the loan back. And how do you calculate the interest coverage ratio? Interest coverage ratio, quite simply, is the ratio of profits of the company divided by the interest on loans that they are required to pay. So you understand, higher the profits of the company, the better will be the interest coverage ratio, which in economy terms means that the ability of the company to repay the interest of their loans solely out of their profits. So higher is the ICR, the better place the company will be to repay their loan back. Understood? So this is what ICR is all about. So moving on to the statements, it helps in understanding the present risk of a firm that a bank is going to give loan to. It is quite correct, because if any country in present has less amount of profit, then that company's interest coverage ratio will be low. That means the ability of the company to repay the loan back will be lower. Hence, banks use these kind of indicators to gauge the financial health of the company and the ability of the company to repay the loan back. Understood? So first here is correct. Second, it helps in evaluating the emerging risk of a firm that a bank is going to give loans to. Now suppose if there's a projection that the company's profit is expected to rise in upcoming years, which means naturally the interest coverage ratio of the company will also improve, thereby indicating that the company will be better placed in future to repay any loan back. Hence, second statement here is also correct. Now, higher a borrowing firm's level of ICR, the worse is it the ability of it to service the debt. Now, this third statement here is incorrect. Why? Because from this equation we understood higher the income interest coverage ratio will mean that the company is generating more and more profits, and for every interest that they have to repay the loan back, they are gathering more and more profits. So higher ICR or higher profits means higher ICR, or lower profits means lower ICR. So higher the profit or higher the ICR, it means the company will be better placed to repay the loan back. Hence, it is opposite of what the third statement is saying. So we have to identify the correct answer, and from our discussion, option A is the right answer because first and second here are correct options. Now moving to another question, a quite straightforward question, and it appears almost every month in the newspaper. Now, which of the following factors and policies were affecting the price of rice in India in the recent past? Now, price of rice is not just determined by the levels of production, but also by various transactions that happen in the country's agricultural market. For example, government brings MSP or announces the policy of MSP, which means the price that the government will pay to farmers to procure their food grains. Now you understand, higher the MSP of the government, higher will be the money that the farmers will get for their crops, which will again increase the prices of any agricultural commodity, be it rice, be it wheat. So minimum support price. And this question is asking you what is affecting, and it is not asking you what will increase or what will decrease the prices of rice. So if any factor has an effect on the prices, we will consider it as a correct factor. So MSP, as I told you, has an implication on prices of agricultural commodities. So first is correct. Now third is consumer subsidies. Now suppose government offers subsidy on rice, which means the price of rice which is available for it in the market will reduce, thereby affecting the price levels of rice. Hence fourth is correct. Now to ensure higher amount of supply of food grains in the market, government undertakes several transactions in the agricultural market. For example, it maintains a sufficient level of stockpiles, which ensures that the government can deal with any food security related crisis in the future. And if the prices of any commodity in the market increases beyond a certain threshold limit, the government also ensures to liquidate the stock from this stockpile, and by increasing the supply of such food grains, what government does is that it reduces the prices of any agricultural commodity. So both maintenance of stockpile, which drains out the stocks from the market, and liquidation of the stockpiling in form of trading changes the levels of supply of food grain, thereby naturally affecting the prices of the food grain. So all of these four are correct from the perspective of our question. Hence option D here is the right answer. Now let us move to another question, and this was a very factual question. That is, if you know the facts related to this question, you will be able to mark the answer correctly. However, if you don't know the facts, you will not be able to answer correctly. So if you are able to manage one or two facts in the question, I'll request you to attempt the question, or otherwise you can skip such questions. Now let us consider or solve this question for our today's discussion. Consider the following statements. The value of Indo-Sri Lankan trade has consistently increased in the last decade. Now there are quite a few questions that have been asked in prelims regarding to certain trends, be it trade, trends related to trade, trends related to production of a commodity, etc., trends related to growth of our country. Now what you are required to do in your preparation phase is not follow the entire trend. Rather, what you have to follow is the break in consistency from the trend. And this is what, if you'll remember, you'll know how to solve such statements. Now, usually what UPSC does is that it asks you a consistent performance in the trend, whereas in real life, such consistent trends always meets a kind of an aberration or a break from the trend. And this is true even in the case of Indo-Sri Lankan trade. Because if you can look from this trade data that I have picked up from government's website, it states that India's level of trade with Sri Lanka peaked at around 2013 and 14. However, after that, it has reduced. Now, this was exports of India to Sri Lanka, whereas the levels of imports have stayed plateau and it has increased after some time. So the total amount of trade that you can deduce has reduced here as compared to 2013 and 2014. So this is what you can call a break from the trend, because it was increasing consistently here. However, it started to reduce after 2015, 2014. Okay. So moving back to our question, the first statement, the value of Indo-Sri Lankan trade, has it consistently increased? The answer is no, because it has decreased after a certain period. So first statement is incorrect. Now in recent past, especially in the past decade or so, Bangladesh has emerged as a global hub of textile and textile related articles, because most of your cotton clothes that you see in India, they are, by the chances of it, that they are manufactured in Bangladesh. So textile and trade articles, by virtue of just common sense, they become an important trade item between India and Bangladesh. So second statement here is correct. Now third statement is a purely factual statement, that is, in last 5 years, Nepal has been the largest trading partner of India. Now, is it true? The answer is no, because in the past decade or so, it is not Nepal, but Bangladesh that has emerged in as India's largest trading partner in South Asia. So third statement here is also incorrect. So from our today's discussion, we can safely say that only option 2 is correct. That is why B answer is the right answer. Now let us move to another question which relates to inflation indexes, that is consumer price index as well as wholesale price index. Now there are differences at which levels the prices in CPI and WPI are calculated, because as the name suggests, WPI, it calculates inflation levels at the wholesale level, whereas CPI, that is consumer price index, it calculates the levels of inflation at the retail level. So naturally the coverage among these two indices will vary. Now in terms of items which are covered, WPI covers more item than consumer price index, but the weightage of food, it is higher in consumer price index because it has about 46.8% weight to food, whereas WPI, it gives weightage to food only at about 24%. So that is why first statement here is correct. Now there is also a difference in WPI and CPI in terms of areas which is covered, whereas CPI covers both goods and services, whereas WPI calculates inflation levels only for goods and not services. So WPI does not capture change in price of services, which the CPI does, is a correct statement. Now, what does RBI take into account while deciding on its monetary policy? Earlier it was WPI, but from 2015 onwards, it has been statutorily mandated on RBI that it will track the inflation levels based on consumer price index, that it has to keep the inflation levels of CPI between the inflation levels of 4 plus minus 2%. That is, RBI has to keep inflation between 2 to 6% of what? Of consumer price index. So RBI has now adopted WPI as its key measure of inflation, and on deciding on changing the key policy rates is an incorrect statement, because here it calculates using CPI. So again, first and second statement here is correct. So again, option A here is the right answer to this PYQ. Now, another question which is a straightforward question, but this one is from financial markets. Now, with reference to Indian economy, consider the following statement. Commercial paper is a short-term unsecured promissory note, which is a correct statement, because commercial papers are distributed by financial companies, and the purpose of distributing this commercial paper is to gather short-term loans from the market, and the repayment of these loans is done instantaneously, that is within a period of 1 day. So commercial paper is a correct statement. Now, certificate of deposit is actually a deposit that you make in your banks, and banks in return provide you a certificate called certificate of deposits. Now, it is different from, say, certificates of fixed deposits, because there is an option for you to prematurely withdraw funds from a fixed deposit account, whereas the same cannot happen as far as certificate of deposit is concerned. So it is a long-term instrument issued by banks and not RBI to corporations. So second statement here is incorrect. Now moving to third statement, call money is a short-term finance used for interbank transactions, which is a correct statement because call money, as the name suggests, are short-term transactions which the banks undertake to do away with the mismatches in their assets and liabilities, that is their balance sheet. So in case a bank witnesses on an overnight basis that there is a mismatch in their assets and liabilities, so they are liable to get loans under call money function, which will be repaid back instantaneously in a period of 24 hours. And also, by the word call, it determines that you have to return the money whenever the lender asks you to return the money. So third statement here is correct. Now, zero coupon bonds are naturally a long-term financial instruments which are generally issued by governments and companies. Now, what does zero coupon bond means? That is, this kind of a bond does not have any coupons which enables the investor of these bonds to get interest rates. Rather, they are issued at a price discount rate. For example, if a company has a bond of face value rupees 100, which is a zero coupon bond, that means that bond will be issued at a discounted rate of 90 rupees, and after it is matured, the investor will get the face value of the bond back. That is why signifying a rupees 10 return on a zero coupon bond, which is a form of interest. Now, it is an interest-bearing short-term bonds issued by scheduled commercial banks to corporation. It is not short-term and it is not issued by scheduled commercial banks, but rather by corporations and government. Hence, fourth here is an incorrect statement. Now, I provided the definition of such instruments here, so you can take a look and read these instructions, but these are basically what I've told you in the slide. So, from our discussion here, first and third is correct. That is why option C here is the right answer. Now moving to another question. It is a straightforward question with reference to foreign direct investment in India. Which of the following is considered its major characteristic? Now let us dissect this one by one. Is it an investment through capital instruments, essentially in a listed company? Here it is incorrect because it is done in a non-listed company. So first is not correct. Now third, is it an investment which involves debt servicing? No, it is an investment which involves capital infusion into the company, which means the company can use this fund to undertake capital investment, that is, invest in buying more land, investing in newer machineries or establishing newer factories. So these are the purpose of foreign direct investment. So third again is incorrect. Now, it is an investment made by foreign institutional investors in government securities. No, it is an example of portfolio investment and not foreign direct investment. So third here is again incorrect. So that is why it is largely a non-debt creating capital flow, which is a correct option. Now I've provided the features of FDI in this list. You can read it by pausing the video. And with this, I move to the next question, which is with reference to international trade in India at present, which of the following statements is or are correct? Now, such data related to Indian trade with other countries, they are usually available in the economic survey of that year. So that is why we recommend you students to at least read any summary of the economic survey, because such summary provides you with the enough content and data related to India's external trade. Now, India's merchandise exports are less than merchandise imports, which means India, according to this statement, India is witnessing merchandise trade deficit. So, is it the case? Let us understand this with the help of this graph. Now, if you see the screenshot that I've taken again from Economic Survey of the same year, it states that India's merchandise trade balance is in negative. That is, India is importing more than it is exporting. Correct? So that is why India's merchandise trade balance remain in deficit. If India were exporting more than it would have been importing, that would have been called surplus and not deficit. However, in current circumstances and in past few years or so, India is witnessing a merchandise trade deficit. That means it is importing more than it is exporting. So, moving to our first statement, from we can infer that India's exports, they are indeed less than merchandise imports. Hence, first statement here is correct. Now moving to third statement, India's export of services are more than import of services, which means India is witnessing services, what? Surplus. So let us see this with the help of again another graph. That if you see the graph of net services as a percentage of GDP, it remains in the territory of positive, which means India is exporting services more than it is importing. Correct? So, from that discussion, we can safely conclude our option third here is correct. Now, coming to India's overall trade level, it suffers from a current account deficit. So, what does it mean by current account deficit? That is net money flowing for trade of merchandise and services out of India. It is more than money coming into India. So, is it the case? Again, let us refer to this graph here. And if you take a look at this graph, it states that India's current account deficit remains positive, which means India is exporting less than it is importing. So that is why India is witnessing current account deficit. Now, although India has a negative or deficit in merchandise account, however, this deficit cannot be compensated by mere surplus in the services account. And that is why when you combine both trade in merchandise with trade in services, what we get is a current account deficit. Understood? So, that is why, that is why fourth statement here is correct. Now, first, third and fourth we have established is a correct statement. So, moving on to the second statement, which is the most trickiest of the statement. Now, India's imports of iron, steel, chemical, fertilizers and machineries, they have not decreased, rather they have increased in recent years. Why? Because as you can understand, India is undertaking huge leaps in manufacturing sector. Now, India is a key manufacturer and exporter of iron and steel, chemicals and also machinery. However, to manufacture these components, India also needs some kind of raw materials. For example, India needs raw chemicals from Europe and it enables it to manufacture higher industrial chemicals, and same can be said about machinery, because to manufacture machinery you require raw materials such as spare parts, which is essentially imported in India. So higher is India's exports out of these goods, it will also mean that the imports of these goods have also increased. So second statement here is incorrect, because our imports of these goods have increased and not decreased. So first, third and fourth is correct, thereby option D here is the right answer. Now let us move to another question. It is a straightforward but a technical question. It asks you to identify non-financial debt. Now there are two types of debt. First is naturally financial, which includes debt incurred by financial companies or financial institutions like banks, etc. Now, any debt which is incurred by a non-financial institution will be termed as a non-financial debt, and it includes debt of households, debt of governments, as well as debt of corporations. So, all of this are part of non-financial debt. So, based on this discussion, let us now consider these statements. Housing loans owned by households are part of household debt, hence non-financial. Amounts outstanding on credit cards, again made by households and corporations, again correct. Whereas treasury bills are issued by governments, particularly central government. So third here is also not financial. So which of the statements or correct answer is the option D? Because all these three are examples of what? Non-financial debt. Had it been loans taken by the banks, then it would have been a financial debt and incorrect from this question perspective. Now moving to another question. With reference to trade-related investment measures or TRIMs, which of the following statement is or are correct? Now, TRIMs is a global agreement on how foreign investors should trade in any country. Now, this agreement imposes some kind of prohibition on its signatories that they cannot discriminate, first of all, between foreign investors and their domestic investors. Also, whenever a foreign investment is made in a signatory country, that should not be subjected to certain restrictions. And what kind of restrictions are these? Such as local content requirements or restrictions regarding import of raw material. Such restrictions cannot be imposed on foreign investment because it negatively discriminates against those investments. So this is an agreement where WTO members agreed on not to discriminate with respect to foreign investment. However, this has certain kind of limitations also. That is, investment in the field of services, they will not be covered. Rather, it only covers trade in goods. Now, this TRIMS committee, it monitors the operation and implementation of the agreement, and it allows members the opportunity to consult on any relevant matters. So in case any two parties, that is an investor and a jurisdiction, that is a country, are having some kind of a disagreement, they can approach to TRIMS committee for resolution of the same. So based on this discussion, let us now solve. Quantitative restrictions on imports by foreign investors, they are prohibited. It is correct because trade related investment measures, it prohibits discrimination against foreign investment. Now second, they apply to investment measures related to both trade in goods and services. Incorrect, because I told you it only relates to trade in good and not relates to trade in services. So second here is incorrect, whereas first was correct. Now they are not concerned with regulation of foreign investment. It is also correct, because regulation per se of foreign investment is a power given to respected governments. That is, Indian government through Foreign Exchange Management Act, it regulates foreign investment in India. Thereby, TRIMS does not have any power to regulate foreign investment. So third is a correct statement. So first and third is correct. So from our questions perspective, our option C is right, because we have to identify the correct answer. Okay. Now let us move to another question. If the RBI decides to adopt an expansionary monetary policy, which one of the following will it not do? That is, what RBI will not do in case it undertakes expansionary monetary policy. Now, what do you mean by expansionary monetary policy? That any monetary policy decision which aims to increase the levels of money supply in an economy is called as an expansionary monetary policy. Now, does cutting and optimizing the statutory liquidity ratio means expansionary monetary policy? Yes, it does, because by reduction of statutory liquidity ratio, government unlocks the funds that was earlier deposited under SLR and then enables the bank to divert these funds for the purpose of loan making, thereby increasing the money supply levels in the economy. Now, cutting the bank rate and repo rate again increases the money supply, because loans now are available at a cheaper rate, which will encourage more people like you and I to get loans for our personal requirement, for our professional requirement, etc. So that is why cutting the bank rate and repo rate makes the credit cheaper, thereby increasing the money supply. Now, marginal standing facility is available to banks to get loans or obtain loans from the RBI. But these loans under the MSF facility, the banks can only take once they exhaust their levels of money taken under the LAF, that is Liquidity Adjustment Facility corridor, which includes loans undertaken at a repo rate interest. Now, increasing the MSF, it will increase the cost of loans, thereby it will reduce the money supply and not increase the money supply. So, second here, from our questions perspective, is an example of contractionary monetary policy and not an example of expansionary monetary policy. So, first and third are correct. Hence, option C here is the right answer to this practice question. Now, let us move to another question. With reference to Indian economy after 1991 economic liberalization, consider the following statements. Now, why such question was asked in 2020? Because you understand India witnessed economic reforms in 1991. So, why this question was asked in 2020? That is 29 years later from 1991. The answer is that Niti Aayog came up with a discussion paper which was called Changing the Structure of Rural Economy and its Implication for Growth and Employment. So this was the context based on which the question was framed. Now, according to this report, the report states that the worker productivity in India has increased in both rural and urban areas. Now, it has predominantly, India was earlier a rural country and it remains even today. However, country's population even today, 68.8% in 2011 resided in rural areas. However, we are witnessing a steady transformation in India's demography and urbanization trends, because more people are moving from rural to urban areas in search for better and higher economic and well-paid jobs. So as a result, this steady transition from rural to urban areas over the years has led to a decline in rural share in population, workforce and GDP of the country. That is, the contribution the rural areas had previously in our population, in our workforce and GDP is coming down or going down, and the contribution of urban areas in these three factors are increasing. And also during the post-reform period, the growth in agricultural sector has reduced to 1.9%, whereas growth rate in non-farm economy has accelerated to almost 8%. So coming back to our question now, worker productivity increased in urban areas while it decreased in rural areas. So if you look at the statement given here, it directly states that the worker productivity increased both in rural and urban areas. So first statement here is incorrect. Now, percentage share of rural areas in the workforce steadily increased. It is again incorrect, because as you can understand, the percentage share of rural areas in workforce, it has rather reduced, because people are moving to urban areas, thereby reducing the amount of workers who live in rural areas. Now, third, in rural areas, the growth in non-farm economy has increased, which again is a correct statement, because post-reform, the growth in non-farm economy has overshadowed the growth, or rather degrowth, in the agricultural sector. Also, the effect of slowdown in agriculture and rural economy is that it has been offset by higher growth in non-farm sectors, and this has accelerated the growth rate of rural economy above 5%, which was earlier only 3.72%. So the share of agriculture in rural economy, it has reduced from 57 to 39%, and country is becoming slowly reorienting towards non-farm economy. That is, it has become more non-agricultural by the year 2004 and 5. So coming back to our question, the rural areas, the growth of non-farm economy has increased. It is correct. Whereas the growth rate in rural employment has it decreased. Now you know the absolute numbers of workers available in rural areas, they have decreased. So has the rural employment also decreased? And let us understand this with the help of this table that I have attached here. So if you look at this table here, it tells you the terms related to employment or trends in the year 2005 and 6. And if you look at the total trend here, it has actually reduced. That is, employment status in rural areas in 2015 and 2005 to 12 period, it has reduced by 0.3%. So this is quite a straightforward fact, which many of you will find difficult in the exams, that the growth rate in rural employment has actually decreased after 1991 economic, and hence this is correct. So from our today's discussion, we can safely say the third and fourth statement is correct. Hence option B here is the right answer. Now moving to another question. In terms of short-term credit delivery to the agricultural sector, the district central cooperative banks, they deliver more credit in comparison to scheduled commercial banks and regional rural banks. Now if you look at the share of respective banks in terms of credit extended to the rural areas, you will see the highest credit share is that of scheduled commercial banks, which contribute almost 3/4 of the total share in credit, and this is followed by cooperative institutions whose share lags at around 15 to 16%. So from this discussion, we can say the first statement here is incorrect, because rather scheduled commercial banks, they provide more credit than district commercial cooperative banks. Now, one of the important functions of DCCBs are to provide funds to the primarily agricultural credit societies. Now, you have to understand the structure of cooperative banks in the country. That is, at state level, there is a state cooperative bank which provides guidance to district cooperative banks at the district level. And what the district cooperative bank does is that it acts as an apex of cooperative banking system in the country. And these district commercial banks provide fund to primarily agricultural cooperative societies, which are cooperative societies formed at the level of respective villages. So this acts here as an apex of commercial cooperative banking. So one of the important functions of DCCBs is to provide funds to primary agricultural credit society, which you can see from here. All the financial transactions of cooperative sector are conducted through DCCBs. Understood? If you can't see this here, need not worry. We will upload the slides in the comments. So from that discussion, we can say that second statement here is correct, whereas first was incorrect. So which of the following statements is or are correct? Option B again is the right answer to this question. Now the first question in this year's paper was with reference to land reforms in independent India. Which one of the following statements is correct? This means you have to identify the correct statement among these four options. Now first let us understand what or why was Government of India wanting to bring land reforms at the time when India got independent. And the reason was that at that time, India only had a few or a very less amount of population, and which was controlling and owning the land belonged to agricultural sector. Now this concentration of ownership of land at that time was a result of British policies in the past that we have seen. Policies such as permanent settlement, rights settlement, these policies were meant to bring about or inculcate a section of people who were responsible for collection of revenue from farmers, and then that very people deposited their share of collection to the British or the colonial government. Now, this section of population, when India got independent, naturally inherited most of our agricultural land. And this kind of a policy, it prevented a large section of people, especially the ones who were landless and poor, from ownership of their own land, and rather they acted as a tenant on lands that was owned by these very section of people. So the primary intention of land reform was to decentralize or distribute the excess land among landless and poor section of the society. Now there was a set of policies that were brought under the umbrella objective of land reform. First was sealing laws. Now, as the name suggests, sealing laws were intended to put limit on ownership of lands at the hands of both individual and families. So they were aimed at family holdings and not individual holdings, becomes an incorrect statement because they imposed a limit on land which was owned by both families as well as individuals. Now it resulted into cultivation of cash crops as a predominant form of cultivation. Now this statement is incorrect. Although after independence we saw growing propensity of people to grow cash crops, but their growth of cash crops were driven primarily by an economic objective, that is, these cash crops enabled the farmers to get more income out of their agricultural produce. So the cultivation of cash crops had an economic objective and was not a part of land reforms. Hence option C here is also incorrect. Now let us consider the last option. Land reforms permitted no exemptions to the ceiling limits. Although the ceiling limits were quite wide, however, there were certain exemptions also. For examples, plantations such as sugarcane, tea, coffee, they were exempted from land ceiling laws. So were orchards of fruits as well as land owned by religious institution. All of these were exempted from ceiling limits. Hence, if the statement says no exemptions, it is not a right statement. So D is incorrect. That is why option B here is the correct answer, because the major aim of land reforms were indeed to provide agricultural land to as many as people possible, that is, to all landless people. So option B here is the right answer to our first question. Now with this, we move to another question. In a given year, official poverty lines are higher in some states than other because. Now you have to identify the correct reason why poverty lines varies from state to state. Now to calculate poverty, there were various committees that was constituted, and these committees came to a conclusion that poverty means if a person is unable to fulfill or buy anything for their basic necessity, that is food, clothing, shelter, etc. So these constituted your basic necessities, and if a person was not able to buy these items in the market, that means that person is poor. So our current poverty projections, they were made according to the recommendations made by Tendulkar committee. There was another committee which was brought after Tendulkar committee, that was C. Rangarajan committee. However, the recommendations of C. Rangarajan committee was not accepted. Thereby, Tendulkar committee was only referred to in calculation of poverty estimates. Now, how does this committee calculated poverty? That is by understanding what is your basic need and the cost incurred by a person in fulfilling that basic need. And if the person's income was below that cost, that means that person belonged to a poverty or belonged below poverty line. So this was the reason. Now you have to understand the poverty lines, it varies from state to state because the price levels of different items, it also varies from state to state. For example, if I am living in a rural area in Bihar, So my cost of living, that the cost of purchasing the items for basic necessity, suppose it will be rupees 500. But suppose if I were to migrate to Delhi, for purchasing the same items in Delhi, I'll have to incur a higher cost, that is 600 rupees. So this is the difference in purchasing a same set of items from different states to states, and this is the reason why price levels vary from state to state, and this is the reason why official poverty lines are also varying from state to state. So here also option B is the right answer. Whereas poverty rates, they do not vary from state to state, rather it is the price levels that vary. On the other hand, gross domestic product of a state does not have implications on the number of people living below poverty line, because technically even if there are a few section of people who are well off, it will result into GSP of that particular state getting increased. And the quality of public distribution has implications on food security and not on poverty. That is why option B here is the most appropriate and the correct answer to this PYQ. Now, let us move to another question. Consider the following statements. Purchasing power parity exchange rates are calculated by comparing the prices of same basket of goods and services in different countries. Now, let us understand the concept of purchasing power parity. Now, this is a macroeconomic tool which was used by many countries even today to compare the levels of economic productivity and exchange of goods and services between one country and another. Now, this purchasing power parity means there is a basket of goods which is considered, and the price incurred in purchase of that basket of goods is compared from country to country. So suppose if same basket of goods valued $10 in US, and in India it amounted to rupees 8,000. So from that logic, if you compare, for every dollar you are required to spend, for example sake, you are required to spend 800 rupees in India. So from that logic, for every dollar you are required to pay rupees 80 worth for same basket of goods. This means from a purchasing power parity concept, the exchange rate for every dollar is rupees 20. Understood? So this is how purchase parity exchange rates are calculated. And combining the purchasing power parity of the country, we can also estimate the levels of the GDP, which is even currently done. So the first statement here is the first statement here is correct, because purchasing power parity exchange rates are used to determine the purchasing power of a person living in a country in buying same basket of goods as compared to buying the same basket of goods in another country. Now, in terms of PPP dollars, India is the 6th largest economy in the world. Now, this statement here is correct because in 2019, in terms of purchasing power parity dollars, the world's largest economy was not US but China, second was US, and third was India. So it was third in the position and not sixth. That is why option B here is the wrong answer. So from our discussion, we can safely conclude option A is the right answer, because we have to identify statements that are correct. Now let us move to another question. Which one of the following is not the most likely measure the government or the RBI will take to stop the slide of Indian rupee? Now you have to understand, when does slide or depreciation of Indian rupee happens? That is when supply of rupee is more and the supply of dollar reduces. And this can happen under many circumstances. Suppose if we reduce the interest rates of the economy, which means the money supply increases, again this will mean that the value of Indian rupee Now let us move to another question. Which one of the following is not the most likely measure of the government or the RBI will take to stop the slide of Indian rupee? Now you have to understand first, when does slide of Indian rupee or the depreciation of Indian rupee happen? Now depreciation of Indian rupee can happen when the demand for dollar increases or the supply of rupee increases. So whenever there is a supply and demand mismatch between dollars and rupee, it can create an upward or downward pressure on rupee. Now this question asks you to identify the downward pressures on the rupee, which means whenever the value of rupee depreciates, this is what is called slide of Indian rupee. Now value of Indian rupee might depreciate because of many reasons. First of all, when there is an increase in money supply, or reduction in interest rates, or when your imports increase, or when your exports decrease, all of this leads to depreciation of Indian rupee, because under these circumstances, what we are required to do is we have excess money in Indian rupee, that is Indian rupee is in excess amount, whereas the supply of dollar reduces, thereby increasing the demand of dollar. So this mismatch between high supply of rupee and low supply of dollar creates a downward pressure on rupee. Now in this regard, whenever we are importing more, it leads to depreciation of rupee. So in order to control the depreciation, what we have to do is we have to reduce the imports. So curbing imports of non-essential item and promoting exports, which is here, is a correct option. Now encouraging Indian borrowers to issue rupee denominated masala bonds means that the supply of dollars, if we have to borrow it in external currency, we have to increase or use US dollar. However, to prevent people from demanding more and more dollars and to further prevent the rupee from downsliding, what we encourage is that Indian borrowers should issue not dollar denominated bonds but rather rupee denominated bonds, as it does away with the need of having any foreign exchange. So first, second here is also correct, that is, it is a likely measure. Now easing the conditions relating to external commercial borrowing, which means that more and more company can now borrow in foreign currencies such as dollars, and this means that the supply of dollar through external commercial borrowing will increase, thereby preventing the or reducing the demand for rupee, thereby preventing its slide. So third statement here is also correct, as it will, or it is a likely measure that the government will take to stop the slide of Indian rupee. And what about following an expansionary monetary policy? Now you understand, expansionary monetary policy means increase in money supply through monetary policy measures. Now we understood that slide of Indian rupee happens because there is an increase in money supply. And what will happen if we further increase the money supply? It will further reduce or it will further slide the value of rupee. Hence, D option here is incorrect. And from the perspective of question, as it is not the most likely measure which the RBI will take, your answer to this PYQ is option D. Now moving to another question that is related to money multiplier, and if you remember, a similar kind of question appeared in the year 2021 also. Now what is a money multiplier? Suppose you have 100 rupees in cash and you deposit this 100 rupees into your bank account. So now the money multiplier will be used from this 100 rupees. Now suppose the reserve requirement of bank is 20%, which means the bank will keep 20 rupees from your 100 rupees as a reserve, and then extend loans worth 80 rupees. Now suppose the person second who took this loan deposits the same amount of money in his or her bank account. Then again bank 2 now has 80 rupees of deposits. Now the reserve requirement, as I already told you, is 20%, which means 16 rupees out of this 20 rupees will be kept by bank 2 as a reserve, and then 80 minus 16, that is rupees 64, will be sent by bank in a form of loans, which again is taken by person second. Now this cycle follows up until and unless the reserve requirement increases to 100 rupees. So technically, if I were to say out of every 100 rupees that I deposited into the account, it led to increase in money supply by 400 rupees. That is, sum total of rupees 500 can be used by bank in form of loans or in form of deposits. And this is what the concept of multiplier or money multiplier is all about. That is, once you deposit your money into the bank, it enables the bank to extend loans, and this cycle repeats until and unless the reserve requirement becomes 100 rupees. Now, there are various reasons through which you can regulate the amount of money multiplier. Suppose if I were to increase the reserve requirement from 20 to 40%, so you understand the amount of money that will be extended by the banks following your deposit will reduce, hence reducing the money multiplier. So increase in cash reserve ratio and increase in statutory ratio reduces the money multiplier and not increases the money multiplier. Hence option A and option C here is incorrect. Now let us consider the option D, that is increase in population of the country. Now in case a population of a country increases, you cannot for sure says that it will force the population of depositing their funds into bank accounts. So D option here is again incorrect because for sure we cannot say that. Thereby, increasing the banking habit of the population means more and more money is deposited into your bank accounts, which means the banks will then divert that money for the loan purposes, thereby increasing the money multiplier. So, option B here is the right answer. Now, moving to another question, it is related to India's external debt. Now, such kind of figures are present in the union budget and also are displayed by the RBI on its own website on a yearly basis. Because RBI, as you can understand, acts as a debt manager of the government, that it issues the debt and then provides this debt money to the government. Now, most of the India's external debt is owed by governmental entities. Now let us consider from the perspective of the borrowers, and I've taken this data from RBI's annual status report on India's external debt of the year 2018 and 19, and from this you can understand that sovereign borrowers of the government are just 19% and not most of the borrowers. So first statement here is incorrect, as only 19% of the debt is owned by governmental entities. Now coming to the denomination in which these debts are issued. Now external debt, you understand, can be issued in any currency, be it rupee or be it any foreign currencies like dollar, pound, yen, etc. Now, does all of India's external debt is denominated in US dollars? The answer is no, as only about 50.1% of our debt is denominated in US dollars, whereas 35.6% of the debt is denominated in our own currency, that is rupee. So not all, but only about half of the debt is denominated in US dollars. So second statement also is incorrect, and we have to identify correct statements. Therefore, option D here is the right answer. Now moving to another question. Which of the following is not included in the assets of a commercial bank? Now, assets, as the name suggests, are those financial instruments which leads to income to the bank. Whereas on the other hand, there is a term called liabilities, which means the money that the bank has to return back to its borrowers. This is what are liabilities of the bank. That is, there is an obligation on the bank to return their liabilities. Now, advances, we understand, are used by banks to extend loans, which leads to income of the bank. Hence, it is included in the asset. Investments again provides return to the bank, and hence it is an asset. And so is money, which is provided by the bank at short and call notice, which provides bank with interest income. So D also is an asset. So what is remained is option B, that is deposit, which means these are not assets, rather they are liabilities of a bank, because bank are liable to return these deposits to the original lenders, like people like you and I. So from the question's perspective, this is not an asset, rather this is an liability. So option B here is your correct answer to this PYQ. Now moving to another question. In context of the India, which one of the following factors is or are contributors of reducing the risk of currency crisis? Now, what is first of all a currency crisis? That whenever the value of your rupee or your local currency depreciates rapidly, it is called as a currency crisis. Now, when does value of rupee depreciates? That is whenever the demand of rupee reduces or supply of rupee increases. Whereas in terms of foreign currencies like dollar, whenever their demand increases or their supply reduces, this constitutes a depreciation in rupee. Understood? Sorry. Now, the foreign currency earning of India's IT sector, it enables the India's IT sector to get money from other dominations such as US, etc. Because India is a net exporter of IT services to other countries. Therefore, India's IT sector is a big earner of US dollar, thereby increasing the supply of dollar and preventing the slide of rupee. So, it is a factor which reduces the risk of currency crisis, hence first here is correct. So is remittances from Indians abroad, because we know India is the largest country or the recipient of remittances across the world, which means even today, that is in 2024, almost $120 billion India receives every year in a form of remittances from its persons or people of Indian origin who live abroad and send the money back to India. Now this again increases the supply of dollars in the economy, thereby preventing the Indian currency from undergoing a currency crisis, thereby third here is also correct. Now, increasing the government expenditure has implications on the domestic economy and it does not directly leads to domestic crisis. Hence, second option is not correct from our question's perspective. Now, we have to identify correct answer. Hence, option B here is the right answer to this PYQ. Now let us move to another question. Which of the following is issued by a registered foreign portfolio investor to overseas investors who want to be a part of Indian stock market without registering themselves directly into India? Now suppose if I and you were to invest in India stock market, so what do we need? We need a demat bank account. Now this demat account is only provided to us after we give our KYC and identification details to the sectoral regulator. And the same is applicable to foreign investors also. That if they were to invest in India directly, they will have to provide their identity and KYC details to the India's security market regulator. So to prevent these regulations of becoming a sense of a hurdle of investment, what the government does is that it brought an instrument which was known as participatory note. Now this participatory note is a very unique instrument because using this P notes, as it is also alternatively called, the investors in Indian market can invest in Indian market indirectly without having the need to directly registering in the Indian market. However, even today, the investors or regulators are apprehensive of this P notes because it increases the volatility in Indian stock markets, as the investment for any company located even outside of India has become quite easy. So they can even send and take the money out of India quite quickly. And this increases the volatility in Indian capital markets. And this is what participatory note is all about. So from our questions perspective, the correct answer is participatory note, that is option D. Now we move to another question. This was a tough question because this was a question related to India's 5-year plans. Now, if you know, India abandoned the planning system in 2014 by abolition of Planning Commission, which was in charge of formulating and implementing the 5-year plans. And this question, if you see, appeared in the year 2019. So that is why I'm saying this question is difficult, because it relates to a thing that was a thing of a past. Now it is a straightforward question because you will be able to solve this question only when you know the related facts. Now the second 5-year plan is probably the most famous one. It was brought in the year 1956 and it was drafted on the plan document which was heralded by Mr. P.C. Mahalanobis. That is why it was also known as Mahalanobis plan. Now the intention of this plan was to make India a manufacturer of basic goods and also capital goods, which means this plan wanted India to become self-reliant in manufacturing both of basic and capital goods, and it wants also to reduce the import. That is, it favored an import substitution policy. So the first statement here is correct. Now the fourth 5-year plan, it was brought in the year 1969 after 3 rolling year plans of year 66, 67 and 68. Now this was brought forward under the Prime Ministership of Mrs. Indira Gandhi, and the objective of this plan was to reduce the concentration of wealth and economic power. And we saw during this plan, Mrs. Gandhi implemented a policy which was quite famous, called as nationalization of banks. So the second statement here is also correct. Now let us consider 5-year plan, that was 1974. Now there was this famous call made by Mrs. Indira Gandhi called Garibi Hatao, which in English means removal of poverty. So the intention of 5th 5-year plan that was brought by Mrs. Indira Gandhi was to reduce the concentration of poor in the country and to promote poor people from becoming richer. So the intention of 5th 5-year plan was not related to financial sector, was rather reduction in poverty levels in the economy. So third here is incorrect. So from the question's perspective, option A is the right answer, as we have to identify the correct answer. Now let us move to another article which appeared in the 2019 question paper, and this dealt with intercreditor agreement. Now, why was question on intercreditor agreement asked in the year 2019? Because at this time, India was witnessing a significant crisis in its banking sector, which was due to increase in non-performing assets. Now, non-performing assets are the loans which are not originally paid back by the borrowers of this loan, and it leads to significant crisis in the bank's balance sheet. As banks, they are not able to get the loans that they have extended bank, hence it prohibits the bank from undertaking future lending activities. And as a result, to prevent or to bring the banks out of this crisis, there was this intercreditor agreement that was brought forward, which means if any banks want to distribute a large amount of loans, it can take the help of another banks, and these banks entered into what was called as an intercreditor agreement. That is, the burden of the loans was distributed among many banks, and according to this intercreditor agreement, the banks will then be able to collect the loans back from its original borrowers in form of a group. So, this policy originally aimed at faster resolution of stressed asset of 50 crores or more. Hence, option D here is the right answer to this PYQ. Now, the chairman of public sector banks, they are selected earlier by a body called Bank Boards Bureau. However, currently this institution has been replaced by Financial Sector Institutions Bureau. So, the correct option here is Bank Boards Bureau, as we have already discussed in a previous PYQ that the Bank Boards Bureau is primarily responsible for appointing chairperson of the public sector banks, appointing members to the board of directors, as well as giving banks the suggestion of undertaking better business practices. So this was a very straightforward question and quite an easy one. Now let us move to another question. And the final question of this slide is that the economic cost of food grains, which is incurred by Food Corporation of India as a part of its minimum support price and bonus to farmers, it includes which of the following four options? Now, economic cost of which is incurred by the Food Corporation of India consists of three different heads. First is procurement price. Second is procurement cost, also known as procurement incidentals, and third one is distribution cost. Now, the procurement price, which is paid by the FCI, is paid to the farmers for purchasing of their food grains and agricultural produce. So this is what procurement price is all about. Now, to purchase the food grains, you also need to have a facility, that is to store these grains, and also you need to pay the laborers for the work that they have done in transferring this procured food grains from markets to storage godowns. So all of this is a procurement cost, or otherwise known as procurement incidental, which is incurred by the Food Corporation of India. Now, just procurement of the food items is not enough. Rather, what FCI has to do is that it also has to distribute these food grains into various parts of our country, and this is where the distribution cost, such as storage of food grains, transportation of food grains, become important. So technically there are three heads under which the Food Corporation of India calculates the economic cost. It includes procurement prices, which is paid to the farmers, procurement cost, which are incurred in storage and for labor charges, and distribution cost, which are used in distribution such as storage and transport related activities. So transportation cost only is incorrect, interest cost only is incorrect, procurement incidental and distribution cost is your correct answer, as it also includes a component of distribution of food grains to other part of the country. Understood? So with this, I conclude our today's discussion on the PYQ of the year 2019 from the economy section. Now, the first question which appeared in 2018 was related to which one of the following statements correctly describes the meaning of legal tender money. Now, what is legal tender money? Any money which is backed by the authority of the government. Now, the government states that we are issuing so and so currency in that country, and the people, they are legally required to settle their debt using that very currency. And it also means that in case someone refuses to accept that particular currency as an against settling their debt, then they will be liable for penalization. So this is the concept of legal tender of money. That person, they are legally bound to accept that particular currency in case it has a backing of the government. So this is quite a straightforward question belonging to the basic aspects of money and from NCERT itself. So the money which is credited under a compulsion to accept in settlement of his or her claims is the definition of legal tender money. Now, money which is tendered in courts of law to defray the legal cases, it is not a legal tender money. Or the bank money in form of checks, drafts and bill of exchanges, they are also not having the legal backing, although they are accepted as a means of payment. However, it is not legally bound on the government or on the banks to accept the payments in form of checks, drafts and bill of exchanges. So they are alternatives of legal tender and they are not the legal tender itself. Whereas the currency, that is e-rupee or physical notes, they have the sanctity to be called as a legal tender, and hence option B here is the right answer. Now I have given the definition of legal tender here, so you can take a look at it in case if you want to pause the video. Okay. Now we move to another question. This is related to opportunity cost. Now such type of questions, literally they belong to a part of economics called as microeconomics. But you do not have to stress about whether you have studied microeconomics or not, because as against many questions in the economy section, you can also solve this question just by virtue of using your common sense. Understood? So let us understand what is the term opportunity cost. Now in case, quite simply I'll tell you with the help of an example, that in case you had 200 rupees with you. Now you wanted, or you have an option of eating two kinds of food, that is a burger or a salad. And I give you an option that you can either select one of them and you are required to pay 200 rupees for either one of them. So eating a burger would mean that you would satiate your craving of having a good food. However, it comes at a cost of bringing a bad health to you, because you understand burger is an example of fast food. So on the other hand, if you decide to have a salad, you might not feel that much satisfied because it is a salad. However, eating a salad would mean that you are taking care of a good health and you are having something which is nutritious or which is not a fast food. So when it comes to making a decision, you have to calculate the opportunity cost. That is, the opportunity cost of having a burger is that you are satiating your cravings, but on the other hand, you're having something which is unhealthy. Whereas on the other hand, if you have salad, the opportunity cost comes in a factor that it is nutritious in nature. It will not deteriorate your health, but it comes at a cost of not having fulfilled your craving of having a good food. Understand? So when you make a decision whether to eat burger or a salad, this is an example of opportunity cost. Now such opportunity cost, it comes into play when corporates are making a decision that whether they have to give a part of their profits to employees as a bonus, or they have to invest that profit in setting up a new factory. So this is an opportunity cost that a corporate can calculate. Whereas the same comes with the government. If government decides to use the money that it has borrowed from the market in giving direct benefit transfers to women, but on the other hand, by giving direct benefit transfers to women, it might also mean that the government will not spend that money on infrastructural project. So deciding upon whether to construct infrastructural projects or to give that same amount of money directly to the beneficiaries, it is an example of opportunity cost. So this is what opportunity cost is all about. So if a commodity is provided by the government for free, that means the consumers of that commodity will not pay any costs. Understood? However, government will have to finance the cost for distribution of free good. So in that regard, what government does is that it takes money out of the public or state exchequer, which means who is funding the state exchequer? That means people like you and I who pay taxes, we end up paying money to the government, and government is utilizing that very money to provide a commodity for free. So in case the opportunity cost is not ignored, rather it is transferred from the consumer of the product to tax paying public, because if a commodity is provided to the consumers for free, that means the consumers of that product will not be required to pay any money against it. So the opportunity cost does not come into play. Whereas the government borrowing the money from state exchequer, which is paid for it by tax paying public, has to decide. So it is the tax paying public who is actually bearing this opportunity cost of the free product distributed by the government. Hence, option C here is the right answer. Now moving to the next question. Increase in absolute and per capita real GNP does not connote a higher level of economic development if now GNP, that is gross national product, it is summation of every product that is manufactured in India by people belonging to India. So this is what the definition of gross national product is all about. Now, theoretically speaking, imagine if there are just 3 people in India. So in year 1, if person A is contributing 100 rupees worth of goods to India, person B is contributing 60 rupees worth of goods for India, whereas person C is contributing 40 rupees worth of good to India. So from that logic, the GNP in the first year, as far as India is concerned, will be rupees 200. Now let us consider another example of year 2. Suppose the A person contributes 150 rupees, person B contributes 50 rupees, and person C contributes 30 rupees, then the GNP of that particular year will be 230. So if you calculate GNPs from 1 year to second year, you'll see that it is increasing by 15%. Understood? So technically, it is an example of absolute growth in real GNP. But if you see from this example, person A who was contributing 100 rupees, now it is contributing 150 rupees, which is increase in the person's contribution in the economy. However, B and C, they have reduced their contribution. So theoretically speaking, in absolute numbers, the GNP of India is increasing in year second. However, we cannot say the same about contributions by B and C, because most of the contribution in second year was made by A and not B and C. So this is an example that where there is an absolute increase in real GNP. However, it does not mean that the contribution of people are increasing. Now the same example is applicable also in the cases of natural disasters, because when natural disasters happen, you understand the economy does not function as it was already envisaged. However, to undertake rehabilitation efforts, government spends a lot of money in buying goods and services which is distributed to people to move away or to bring them back to normalcy. So these are also examples of absolute increase in GNP. However, in terms of economic development, you understand people who face natural disasters are economically and socially not well off, rather they are gotten worsened. So this is an example when even if real or absolute GDP is increasing in our country, it does not lead to economic development. So in case poverty and unemployment increase, we have seen, for example, B and C, their economic positions or the contributions to GDP have worsened and not improved. Rather, the most contribution is made by A, whose economic development and contribution has increased. So what if B and C becomes poor or unemployed? So even in that case, the absolute and per capita GNP might increase. Therefore, option C here is the right answer. Now, imports and exports do not have a connotation on GNP, so D is not correct. Agricultural output fails to keep up pace with industrial output is not correct. Although there is a case that agricultural output might still grow, and industrial output fails to keep pace with agricultural output, again is incorrect. So C is the most appropriate and hence the right answer to this practice question. Now let us move to another question. Consider the following statements. Human capital formation as a concept is better explained in terms of a process which enables individuals of a country to accumulate more capital. It is incorrect because it is an example of capital formation. That is physical capital, not human capital, whereas human capital means that the ability of a person to discharge any economic activity has improved. Now, how does it improve? For example, if an individual was not educated before, he or she might just be involved as a unskilled labor. But what if that particular individual gets an engineering or a medical degree? So naturally, the ability of that individual to participate in an economic activity becomes better. They can participate in more productive economies or activities. So this is an example of human capital formation. Now, whenever individuals get educated, they undertake skill training, or they have better health themselves, that are examples of human capital formation. Now, this human capital is not a tangible form of capital, which means a capital which you can't touch. So this human capital ability is an accumulation of not tangible but intangible wealth. So third becomes incorrect and fourth becomes correct. Now first, as I already told you, it is an example of physical capital formation, accumulation of more capital. Whereas increasing the knowledge, skill level and capacities of people of their country is an example of human capital, hence second is correct. So from our above discussion, we can safely say second and fourth are correct. Hence again option C here is the right answer. Now let us move to another question. Despite being a high saving economy, capital formation may not result into significant increase in output due to which of the following capital? Now, capital formation is a prime example of how you increase our country's GDP. But does increase in capital formation always results into a corresponding increase in economic growth? The answer is no. Because there is a related concept called incremental capital output ratio, which states the amount of capital that you need to invest for every particular output. Now, for example, if you are required to spend 100 rupees of capital and the requisite amount of increase in output is 1 unit. So from that definition, you can say that incremental capital output ratio in this is 100. But what if in another economy, only by spending 70 rupees more, you are able to produce one more output? And in this regard, the ICOR becomes 70. So from that logic, you can clearly understand that in option A, I had to spend a higher amount of money for just one increase in output production. Whereas in the option B, I need to require only 70 rupees worth of capital investment to get an additional unit of production. So in terms of economic growth, I'll be better off by investing say 3500 rupees in option B, because by investing 3500 rupees, I'll be able to get how much? 150 additional units of production. Whereas coming back to option A, here if I invest 3500 rupees, I'll be only getting how much? 35 additional units of production. So from this example, you can say that for same amount of money that I invest in economy B, my production will be higher in case of B as against option A. So from that logic, you understand that any economy which has a high incremental capital output ratio will mean that the increase in output will not be that significant as against compared to B. So that is why option D here, that is high capital output ratio, is your right answer. Now moving back to another question, consider the following statements. The Reserve Bank of India manages and services Government of India's security but does not any state government security. Now RBI, which is the Central Bank of India, acts as a banker to both central and state governments, which means if these governments, that is central and state governments, they require any form of debt from the market, it is taken care of by the RBI. That as against these governments, the RBI on their behalf acts as their debt manager and then approaches the market to take money and then provides that same money to the state as well as union governments. So this is the essential function of Central Bank of India, that is Reserve Bank. So in that case, RBI manages the services of Government of India securities and it also manages the services of state government securities. Hence, the first statement here is incorrect. The treasury bills, they are issued by Government of India and there are no treasury bills issued by state governments. Now there is a constitutional restrictions on the state government that although they they can issue bonds in the market, however, there is a condition that the state governments can only issue the bonds for long term, which means securities that have a maturity period of more than 1 year, only that can be issued by state governments. Whereas the central government can issue bonds for both short as well as long term, and the short term are issued through treasury bills, whereas the long terms are issued through government securities. So from that logic, as the state governments can only issue state developmental loans that are examples of government securities, so the second statement here is correct, that the treasury bill, which is an example of short-term debt instrument, can only be issued by Government of India and not state government. Now treasury bills are issued at a discount from their par value. Now the treasury bills in a way are not a coupon bearing instrument, which means they are, for example, if a treasury bills have a face value of 100 crores, so it will be issued at a discount rate of say 98 crores, and after a period of maturity, the investor will get the value, face value back. So we can say that the treasury bills, they are offered at a discount from their par value, that is, they're offered at a discount of their face value, and after redemption, the investor gets the value of face value back. So the third statement here is correct. So again from our discussion, first was incorrect, second and third are correct. That is why option C here is the right answer. Now moving to another statement or question. This is a straightforward question as it asks you 7 crops and asks you to identify which of the following for which the government announces the minimum support prices. Now I will tell you straight away that the MSPs are announced for barley, they are announced for finger millet, which are called ragi in Hindi, they are announced for groundnut, and they are announced for sesame. Whereas they are not announced for turmeric, they are not announced for coffee, and they are not announced for areca nut. Now MSP is a support price which is provided by the government to farmers who grow 22 crops in India. Now these include cereals, pulses, oilseeds. You can see sesame is an example of oilseed, groundnut is an example of oilseed, ragi here is an example of cereal, which is a type of a millet. Whereas the same is not offered for say areca nut, which is used in making pans, or coffee, which is a popular beverage, or a spice called turmeric. So that is why second, fourth, fifth and sixth is correct. Option B is the right answer. Now, if you want to remember the crops for which the MSPs are provided, I have provided a list here. If I say sugarcane, does MSP is provided? The answer is no, because this regime is not called MSP, rather fair and remunerative prices. So it is technically outside the ambit of MSP. Now moving to another question. With reference to governance of public sector banks in India, consider the following statements. Now the question itself became very important because the year it was asked in, it was 2018. Now if you remember, back in 2018, banks in India, primarily the public sector banks, they were grappling with non-performing assets, as the loans that they've extended to corporate houses, they were not paid back by the corporate houses because of many political and economic reasons. Now, to deal with this crisis of liquidity that the public sector banks faced, these banks approached the government. Now, these banks told the government that they did not have enough funds which will enable them to extend newer loans. Hence, the government decided to provide capital infusion in these public sector banks. So, this was the context in which this particular question was asked. So the first statement, capital infusion into public sector banks by the government has steadily increased in the last decade. So it is asking you, has in the last decade the capital infusion steadily increased? That you know it increased, but has it continued to increase? So in that regard, you have to understand the trends of capital infusion by the government of India. Now if you look at the trend from this graph, this lower line represents the capital infusion by the government. And you can see in the decade previous to the year it was asked, that was 2018. You can go back till 2008. India witnessed an increase in capital infusion here. However, such infusion decreased after 2009 and 2010. It again increased after 2013-14 when the NPA crisis was brought into public domain and the banks, they faced capital crisis. So again, the government increased their support through capital infusion. However, this support plateaued after 2014 and 15 and subsequently reduced after 2015-16 and into 2017-18. So can we say from this graph, has the government's capital infusion steadily increased? The answer is no, although it has increased, but it has also witnessed decreased in few years. So, coming back to our first statement, the first statement that it has steadily increased becomes incorrect. Now moving back to another question, to put public sector banks in order, the merger of associate banks with the parent State Bank of India has been affected. Now it was a straightforward current based question, because if you look in the past years before 2018, 5 banks, that was State Bank of Mysore, State Bank of Patiala, State Bank of Travancore, State Bank of Bikaner, as well as State Bank of Hyderabad, it was decided for these associate banks of SBI to be merged into parent SBI. And this was done through an act of Central Board of SBI, which gave the SBI the power to acquisite its subsidiary banks. Now, this was done not through RBI Act, but more importantly, it was done through the act which was made to bring SBI into fruition. So, the second statement here, if you see, is a correct statement. Now, you have to identify correct statement in this question. Therefore, option B, that is 2 only, is the right answer. Now, let us move to another question. Which one of the following best describes the term merchant discount rate? Now, merchant discount rate was in news back in 2018 because at the time, that was in 2016 or the late 2015, when government enacted the policy of demonetization, it also wanted to promote the concept of less cash economy. which means that the government discouraged the use of cash, and as an alternative, it wanted people to use digital payments. Now, prevalent at the time was concept of payments using debit card as well as credit card. Now, these are instruments in which you swap your credit card or debit card in a shop, and that shop can take your payment digitally. But to establish these credit card and debit card networks, there are companies called as payment companies. For example, you must have heard companies like Visa, MasterCard, American Express, or even our own RuPay. Now, these are examples of credit card processor. Now, what these companies do is that they set up a network of point of sale devices and they reach out individual retailers who sell goods and services. Now, banks enroll the services of these payment providers by saying that we will utilize your credit card or debit card network to undertake payments digitally. But the cost of setting up of this network is borne originally by credit card processors. So, in order to pay the services of undertaking digital payments, these companies, they charge funds from the banks who are originally issuing you your credit card and debit card. So if you see at any debit card or credit card, it has a name of your bank, but it will also have the name of these payment card services. And in exchange of services that are digital payments enabled by these companies, they charge a money to the issuing bank, which is called as merchant discount rate. Now, this was in news back in 2015 to 2018 because to promote digital payments in the economy at the time of digitization or demonetization, what the government said that these MDR payments were waived off for a temporary period, which encouraged or which reduced the cost of banks to set up these credit card payments, and in a way, it also made digital payments cheaper for broader public. So this was the example why MDR was asked in the particular year. Now coming back to our question. This is a charge to a merchant by a bank for accepting payments for his customers through the bank's debit card is a correct answer to this question because it is a charge levied by the payment card companies to the banks, which enables the bank to then extend digital payment services to its own customers. Now moving to another question, which was an issue quite prevalent at the time when it was asked back in 2018, and this was related to India's decision to levy an equalization tax on 6% on annual advertisement offered by non-resident entities. Now you understand popular companies such as Google, as well as Meta, which was known as Facebook back then, offer online advertising services to customers located in India. But there's a possibility that the online advertising departments of these companies are located not in India, but in their parent jurisdiction of US. So in case they earn any money through the delivery of their advertising services, these payments were not subjected to any taxation rates. Rather, what these companies did was that they told the government of India that although we have signed double tax agreement between India and US, so we are not liable to pay these taxes in India. Rather, we'll compensate the US government to payment for these taxes. The online advertising industry is quite huge. It was quite huge back in 2018 and it is quite huge even today when we are discussing this question in 2024. So from that logic, the second statement became incorrect because originally it was intended of an equalization tax to do away with the need of companies skipping up the payment of their taxes, citing the provisions of double taxation agreement. So second statement here is incorrect. While the first, it is introduced as a part of Income Tax Act, is a factual statement, again incorrect because it was introduced by Finance Act of the year 2016. So, first statement incorrect, second statement incorrect, thereby option D here is the right answer. But you need to know which of the companies were as per as the equalization levy. Now, the companies who are providing advertising services, but only those companies who do not have a permanent establishment in India. So, in case a company has permanent establishment in India, they will not be charged the equalization levy. Also, companies who are not having the threshold limit of turnover of 1 lakh, they'll not be able to liable to pay equalization levy, and so does in case the services is offered in professional or business terms. Rather, when it is offered for personal transactions, then also the equalization levy is not applicable. Understood? So these are the conditions based on which a company will be able to pay or is liable to pay equalization levy or is not liable to pay equalization levy. Now moving to another question. This one is straightforward from the static portion, that consider the following statements. The FRBM, that is Fiscal Responsibility and Budget Management Act Review Committee report, has recommended a debt to GDP ratio of 60% for general government, which is combined of state and union government, by 2023, and it comprises 40% of central government and 20% of state governments. Now, FRBM Act originally was enacted in the year 2003. However, as India witnessed global economic crisis in the year 2008, it was decided by the government to delay the targets which was set originally by the year 2003. Now, such targets were delayed further back in the year 2013. So, it was decided to set up a reform committee which will suggest new targets and the target completion date at a later date, which was fixed by a new committee by the year 2023. Now, this committee was chaired by Mr. N.K. Singh, who was a retired bureaucrat. Now, N.K. Singh was also the chairman of 15th Finance Commission. Now, the FRBM Act, the committee said that the government of India should try to keep the levels of fiscal deficit below 40% of GDP, and so does the state government of India should keep its debt below 20% of GDP, and the combined debt of union and state government should not exceed 60% by the year 2023. Therefore, first statement here is correct. Now, the third statement, as per Constitution of India, it is mandatory for a state government to take central government's consent for raising any loan if the former owes any outstanding liability to the latter. Again, it is a correct statement as it is given in the Constitution that the state governments cannot take any loan without the permission of union government if it has an existing loan pending with the union government. Now, coming back to second statement, the central government has domestic liabilities of 21% as compared to 49% of the state government. It is completely a factual statement. So, let us consider whether the second statement here is correct or not. Now, if you look at the table that I have given here, the internal debt of union government as a percentage of GDP in 2017 or 18, that was year before this question was asked, was 34.44% and not 21%. So, the first statement is incorrect. Whereas, the debt levels of state governments was 68.7% and not 49% as it was stated in the question. Hence, second statement, by the virtue of it being wrongly given, is an incorrect statement. Now, from our discussion, first and third is correct. Therefore, again, option C here is the right answer. Now, moving to another question. The capital adequacy ratio is the amount that banks have to maintain in form of their own funds to offset any loss that the banks incur if the account holders fail to repay their dues. Now, this concept of capital adequacy ratio, which is also known as capital to risk weighted asset ratio, is a ratio where banks have to set aside a certain amount of deposits in a different account, which will enable the banks to capitalize themselves in case they're extending loans which is paid or given to corporates or individual borrowers are not repaid to back to them. Now, higher the bank's capital adequacy ratio means the higher the ability of banks to sustain crisis. So this parameter, that is capital adequacy ratio, is an example of bank's good or bad health. That higher is the capital adequacy ratio, the better is the health of the bank. Now, this capital adequacy ratio was originally envisaged by banks of international settlement, which is located in Basel in form of Basel norms. Now, subsequent norms brought by banking of international settlement, it highlighted that as the economy increases, the banks located in that economy should envisage a higher capital adequacy ratio. Now, this capital adequacy ratio or capital to risk weighted asset ratio is a combination of tier 1 and tier 2 capital that the banks will have to maintain themselves. However, the actual levels of how much CRAR that the bank should have is decided not by the bank but rather by the Reserve Bank of India in Indian context. Now, Basel III norms, which is the latest norms passed by BIS, it states that bank should have a CRAR of 10.5%, which means 0.8% of capital adequacy ratio, whereas 2.5% of capital conservation buffer. However, on top of it, the RBI said that not 10.5%, but Indian banks should have at least the CRAR of 11.5%, which means 9% of capital adequacy ratio in addition to 2.5% of capital conservation buffer. So you can understand the RBI envisages a stricter capital requirement on Indian banks as envisaged by the banking of international settlement. Understood? So this is what CRAR is about, that it is a certain section of funds that the bank should keep in themselves so as to enable them to use these capital in times of crisis. And better is the CRAR of a bank, the better is the financial health of the bank. Now coming back to our question. CRAR is decided by individual bank. It is incorrect because in Indian context, it is decided by the Reserve Bank of India, not by individual bank. Whereas the first statement was correct, as capital adequacy ratio is amount of that the banks should maintain in form of their own funds to offset any losses that the banks might incur in case the account holders fail to repay their dues. The first was correct, second is incorrect. Therefore, option A is the right answer to this practice question. Now, this concludes our today's discussion related to PYQs which occurred in the year 2018. Now we will move on to the PYQs which came in UPSC Prelims in the year 2017. Now let us consider the first question which appeared in 2017. Which of the following statements is or are correct regarding the Monetary Policy Committee? Now earlier, the monetary policy decisions were made only solely by the Reserve Bank Governor. However, since late or mid 2015s, what we saw that this duty was changed, because from RBI Governor now we see there was this Monetary Policy Committee was formed which will have the responsibility of discharging monetary policy decisions of the RBI. Now this committee was formed as per the recommendations made by Urjit Patel committee, and this committee highlighted that you need a set of people who will decide on what the monetary policy will be as to decentralize the decision making in the RBI. Now this monetary policy committee consists of how many people? 6 people, which includes 3 people from RBI. It includes RBI Governor, who acts as a chairman for this committee,
RBI Deputy Governor who is in charge of the monetary policy, and a member who is appointed by the board of RBI. Now, in addition to these 3 members from the RBI, this also includes 3 members from the government who are appointed by the central government themselves. So, these 6 people are in charge of discharging monetary policy decisions, and the decision making of this body is done through majority. That is, the majority people, they will prescribe a particular policy and that will be adopted. Now, in some case, if there is a tie in the votes, then the RBI governor will have the casting vote. Understood? So, it is correct that this committee decides on RBI's benchmark rates, hence first statement is correct. Second statement, it is a 12-member body including the RBI governor and it is reconstituted every year. It is incorrect because it is a 6-member committee and it is reconstituted every 2 years. So, moving to the third statement, it functions under the chairmanship of Union Finance Minister. Again incorrect because as I told you, the chairman is the governor of the RBI himself or herself. Understood? So, that is why we can safely say only first option is correct. Hence, option A here, 1 only is the right answer. Now, I have provided the solution here also, so you can pause this video and take a look at the solution, but it tells you the exact same thing that I have told you in the discussion of our question. Now, let us move to another question with purpose of what is the purpose of setting up of small finance banks in India. Now, small finance banks, payment banks, wholesale banks, these are examples of differential banks, that is, as against scheduled commercial banks that discharge every functions related to banking. These small finance banks are responsible for a particular function. For example, you understand the flow of credit in our agricultural sector, in our rural economy is less compared to the flow of credit in the urban areas and in formal sector. So, we needed a kind of a bank that specializes in providing credit to the hitherto untouched sections, that are rural sector, agricultural sector, etc. And that is why small finance banks were set up by the RBI. And RBI also gave licenses to some parties that set up their respective small finance banks. So, as you can see from this slide, the objective of setting up of a small finance banks was to further levels of financial inclusion in the country. And it included provision of saving vehicles primarily for underserved and unserved sections of population. Also, in addition to supply of credit to small business units, to small and marginal farmers, to micro and small industries and other unorganized sectors. Understood. Now, these banks, they will specialize in these kind of functions and they will utilize technologies to assess the ability or the solvency of the borrower and also whether to provide loans to these borrowers or not. So, from our discussion, we can say it supplies credit to small and business units and supplies credit to small and marginal farmers. However, explicitly, there is no objective of small finance bank to supply or promote young entrepreneurs to set up their business, particularly in rural areas. So, from that logic, third statement here becomes incorrect. So, 1 and 2 only are correct. That is why option A here is the right answer to our second PYQ of the year 2017. Now, let us move to third question of the day. Which of the following is most likely consequence of implementing the unified payment interface? Now, you understand earlier when we used to make online payment, what we used to do was that we transferred money from our bank accounts into mobile wallets. For example, Paytm had its mobile wallet. So, what we used to do is that from our bank accounts, what used to transfer money to Paytm wallets and we could only pay money from Paytm wallet to another Paytm wallet. So, you can understand this restricted the process of interoperability, that is payment from Paytm to say Google Pay was not permitted.
So this was the issue related to mobile wallets. But with UPI, what we see that the role of mobile wallet ended completely. And instead of sending money from bank account to mobile wallet and then to mobile wallet number 2, this process eliminated the need of having wallet, and rather we can send money from one bank account to money to another bank accounts. Understood? So this was why option A, that mobile wallets will not be necessary for online payment, is the correct answer to this previous year question. Now let us consider other options also, why these other options are incorrect. For example, digital currency will totally replace the physical currency in about 2 decades. Now the purpose of Government of India to bring these UPI was to promote less use of cash, and rather the government wanted people to transact over digital medium. However, you understand cash transactions have certain inherent benefits. That is why we can safely say for sure that although digital currency or digital payments will become more prominent, however, they will not totally replace the physical currency. That is why option B here is incorrect. Now let us consider option C, FDI inflows will drastically increase. Now I will tell you that FDI inflows depends on many other factors. However, online payment is not one of them. So FDI inflows have no obligation or implications on the basis of digital payments. Hence, option C was incorrect. Now, direct transfer of subsidies to poor people will become effective. It has become more effective, but not through UPI, but through the process of direct benefit transfer. As using DBT and mobile linked and Aadhaar linked bank account, the government is transferring these benefits to the beneficiaries directly into their bank account. So it is not a consequence of UPI, rather independent of it. That is why I was able to say that option A is the correct answer to this PYQ. Now let us consider another question. This one also is a straightforward question. Which of the following statement best describes the term scheme for sustainable structuring of stressed asset recently seen in news? Now this question appeared in 2017, and you understand this was the year where banks in India, especially the public sector banks, they were facing the crisis of non-performing assets or NPAs. And these NPAs were the result that many corporate borrowers who had borrowed money from the bank, for many different reasons, they were unable to pay the loans back. And that is why the balance sheet of Indian banks was stressed quite significantly. And RBI in general brought many schemes, and these schemes were intended to ease out the NPAs and promote restructuring of debts that were taken by corporates. And one among these schemes was schemes for sustainable structuring of stressed assets, called as S4A scheme. Now in this process, the RBI, it wanted to restructure the levels of debt by highlighting or determining what is the sustainable debt level of a corporate and separate or bifurcate it from the outstanding debt of the corporate. And also, by the process of restructuring, what the RBI wanted to do was that a part of debt will be converted into an equity instrument, and the banks will not be given loans back, rather they will be provided equity in the respective companies. So this was the S4A scheme, hence option B. It is a scheme of RBI for reworking of financial structure of big corporate entities facing genuine difficulties is the correct answer. Now moving to another question. Consider the following statements. NPCI, National Payments Corporation of India, helps in promoting financial inclusion in the country. Whereas the second statement, NPCI has launched RuPay, a card payment scheme. Now the levels of financial inclusion, that is people participating in the organized sector of finances, was quite low in the country, and as a result government brought many policies and schemes. Primarily, government brought Pradhan Mantri Jan Dhan Yojana, where bank accounts of people who did not have earlier bank accounts were opened, and these primarily were opened in the name of women in the household. Also, government
enacted a company or formed a company called NPCI, that is National Payment Corporation of India, based on Payment Settlement Act of the year 2007. Now this company was formed and the equity in this company belonged to public and private sector banks, and the intention of this company was to bring out schemes and products that were brought forward just to ensure and increase the levels of financial inclusion in the country. For example, the IMPS system, that is immediate payment service, which is used by banks to transfer money instantaneously from one bank account to the another, is a product of NPCI. So is the unified payment interface. And also there were many payment gateways in our country that were operating at the time, such as Visa, MasterCard, Maestro, American Express. All of these were foreign based companies. So a competitor of that company called RuPay was also launched by NPCI, which enabled these banks in India to set up the payment systems not from a foreign company but from an Indian company, NPCI, and the product was called RuPay. So these are the two products, that is UPI, MPS, RuPay, etc., that was brought by NPCI to promote financial inclusion, to promote digital payments. Hence, both of these statements are a correct statement. Therefore, the correct answer of this question, as it asks us to identify correct statements, is option C. Both 1 and 2 are correct. Now let us move to another question, Prohibition of Benami Properties Transaction Act 1988, and we have to consider following statements based on this very act. Now what is first of all a Benami transaction? Now if I buy any property from my illegal wealth and if I give the ownership of that property on the name of any third party or a fictitious person, so that property which is owned in theory or in papers by a fictitious person or a relative of mine will be called as a Benami property. Because originally I am paying for that property. However, in paper, the ownership of that property belongs not to me but to another person. And that person can be a real person or a fictitious person. So these kind of properties are called Benami properties, but the act itself, it provides that even when the ownership of the property or the owner of the property denies knowledge of such ownership, even then the property is called as a Benami property and the transaction involved therein is called a Benami transaction. So from that explanation, first option is a correct statement, or sorry, incorrect statement, because property transaction is not treated as a Benami transaction if the owner of the property is not aware of the transaction. This is incorrect because it will be treated as a Benami transaction. Understood? Now let us see other two statements. Statement 2, properties held Benami are liable to be confiscated by the government according to this act, and this statement is a correct statement because first of all the process of Benami properties is such that these properties primarily are owned by people who have massive amount of illegal money or black money. Hence, the intention of the government to pass this act was to first identify which properties are Benami, then confiscate the property and then sell these properties in an open market and recover the black money from it. So, second statement is correct. Now, if you look at the explanation that I have provided, the decisions made by government under this act is subjected to be appealed under an adjudicating authority and it is further subjected to appeal to an appellate tribunal also. So, the decisions of the government under this act is subjected to be appealed in these kind of two adjudicating authorities and appellate authorities. Hence, if you look at the third statement, the act provides for 3 authorities for investigation but does not provide for any appellate mechanism is incorrect because it does provide an appellate mechanism. So, as only second statement here was correct and it asks us to identify correct statements, hence option B here is our right answer. Now let us move to another question. It is related to which of the following can join the national payment system or national pension system.
Now, national pension system is a kind of pension system which was brought by Government of India to replace the old payment system that existed before it. And this national pension system is a contributory pension system where suppose if I were a beneficiary of NPS, then I will contribute money to it, my employer will contribute the money to it, and it will form a corpus amount. And after say 60 years after I retire from active service, then I'll be able to get monthly pension from the corpus that I have secured over the time where I worked in previous years. Understood? So, this is the basic crux of what is a national pension system. Now, this question asks us to identify which of the following are eligible to get pension system or not. Now, the beneficiaries of this pension system are people between 18 to 17 years of age. So, second statement here is incorrect. Now, earlier this pension system was applicable only to resident Indian citizens only, but later on even NRIs who are working in India can enroll for just such system, and hence option A was also incorrect. Now, this pension benefits is available to all central government employees except the ones who are serving in armed forces, because they are determined by one rank, one pension scheme OROP, and they are not liable to register for NPS. Hence, option D here, which states it includes armed forces personnel also, is incorrect. So, that is why option C here is the right answer, that all state government employees joining the services after the date of notification of by respective state governments are eligible for NPS. Hence, option C here is our right answer. Now, let us move to another question. This question asks us to identify what is the most likely advantages of implementing the GST regime. Now, before goods or services tax known as GST came into fruition, the indirect payment system or indirect tax system of our country was very fragmented. That different states such as UP, Bihar, Delhi, they had their respective taxes. Also, these tax rates were varying in nature. That is, suppose UP might have been charging higher indirect tax on a certain commodity, whereas states such as Delhi might be charging less amount of tax, and this created a lot of problem related to compliance with related to benefits. So, that is why the government of India, by consensus with state governments, decided to enact goods and services tax, and this replaced the indirect tax system which existed in the country, that was a fragmented system. And as a result, the GST which was enacted was a unified system. That is, the same taxes, indirect taxes, was applicable on products sold in different states, and it reduced or it replaced the multiple taxes that were collected by multiple authorities before GST was enacted. So, first statement is correct. Now, let us consider whether second and third statement is correct or not. Now, it will drastically reduce current account deficit of India and will enable increase to its foreign exchange. Now, this statement is incorrect, because current account deficit is the difference between, or current account deficit is when exports from India is less than imports into India, and this is called current account deficit. And you understand, taxes in India will have very less application on the current account deficit levels of the country. So, it will not, you can't say that it will drastically reduce current account deficit, hence second statement is incorrect. Now, third statement, it will enormously increase the growth and size of our economy and will enable it to overtake China in the near future. Now, the benefit of GST is that it reduces the tax arbitrage, it makes compliance to indirect taxes easier, and hence it is expected to promote India's growth prospects. However, this statement is an absolute statement because it states it will enormously increase the growth and size. Although there will be an increase in growth and size, however, this increase in growth and size will be gradual and not enormous. Understood? So, first statement here is correct, second is not, and third is also not. Therefore, option A is the correct answer to this question.
Now let us consider another question. This was also straight away picked up from that year's current developments. Now the term domestic content requirement, sometimes seen in the news, is with reference to what? Now you know India primarily has been a agricultural based economy, and to promote growth and development in Indian society, what the government wanted was to develop its manufacturing sector. Now for promoting manufacturing, the government requires Indian companies not to import the goods from other countries, rather manufacture these goods in India only. And for that reasons, there were many policy measures that were undertaken by the government to promote manufacturing in India, and one of them was domestic content requirement. That is, any good sold in India, the domestic content requirement would want that certain percentage of that good which is sold in India should be manufactured in India. And that logic was applicable on the Jawaharlal Nehru National Solar Mission that was brought. And in this solar mission, it was made mandatory by the government that our solar cells and modules which will be used for this particular mission and installed in the houses and in factories and in commercial spaces of our country, certain percentage of those solar cells and modules need to be made in India only. So that is why developing solar power production in our country was the intention of domestic content requirement, especially for Jawaharlal Nehru National Solar Missions. Hence option A here is your right answer. So domestic content requirement, you understand, that is hypothetically 60 or 70% of the product which is used in any policy should have been made in India, and that is what domestic content requirement is all about. Now I have provided the explanation here. You can pause the video and look at the explanation. Now moving to another question. Now you understand India is a developing country, and to become developed country it needs to have world class infrastructure. Be it good roads, airports, railways, everything needs to be up to date, and this requires a lot of money. So the government itself, you can understand, can't just support infrastructural development, and for that we need foreign investment, we need investment from private sector also. And keeping that in mind, the government brought a National Investment and Infrastructure Fund called as NIIF. Now the ownership of this NIIF was made between government and private sector, and it was established that the government will contribute at least 49% of the total money required for this fund, and the corpus of this fund was rupees 40,000 crores. So that is why this was enacted by the government. Now 49% of 40,000 crores will be contributed by Government of India, and rest the NIF will solicit or take the contributions from private sector, from foreign investors, and the money then will be channeled into our infrastructural project, understanding well that these money will be utilized for construction of infrastructural projects like road, railways, bus stands, bridges, etc. So the objective behind creating this fund was to maximize the economic impact on India and invest in commercially viable projects, both greenfield and brownfield. Now this is a fund which is registered by SEBI, and it is categorized as an EIF or alternative investment fund. Now as you can see, I have already told you the contribution or the corpus of this NIF initially was 40,000 crores, and 49% of the total commitment was provided by Government of India itself. So coming back to the question, is it an organ of Niti Aayog? No, it is a fund which is registered with a SEBI or Securities Exchange Board of India, the regulator of India's securities market, and the corpus of this fund is not 4 lakh crore as senior, it is rather 40,000 crore rupees back in 2017. So both of the statements are incorrect, hence option D, that is neither 1 and 2, is the right answer to this PYQ which occurred in 2017. Now moving back
moving to another question, which of the following has or have occurred in India after its liberalization of economic policies in 1991? Now, the architect of this economic policy, that was Dr. Manmohan Singh, passed away recently. And even after his passing away, there were slew of articles that highlighted what kind of achievements India made after it went or saw economic reforms in the year 1991. Now, one of the major benefits of this economic reform was that India transformed itself. It earlier was an agricultural based economy, and hence after economic policies and reforms, we saw India started to gradually become a more manufacturing oriented economy and later on a service oriented economy. So, the share of agriculture in India's GDP after economic policy, it reduced and not increased. So, the first statement is incorrect. Now, as India started to become more manufacturing and service oriented economy, share of India's exports across the world, they increased actually. So, second statement is incorrect. Now, one of the measures that were brought in economic reforms of the year 1991 was that the controls with respect to foreign investment, they were reduced. And this in a way promoted foreign investment into India, and as a result we can see India's FDI inflows, they increased, because earlier India was having as much as just 3 million investment per year. However, this investment increased to $30 billion in the year 2017 to 2018. So, this was why I was saying that FDI inflows increased in India. Also, at the time when India witnessed economic crisis, and a result of these economic crisis was India reformed in 1991, was that our foreign exchange reserves were just $6 billion. However, after India's economic reforms in 1991, India's foreign exchange reserve increased enormously and it reached to a level of $413 billion in the year 2018 and 19, and currently in December 2024 it was 644 billion US dollars. So all of these reforms that were made back in 1991, it led to reduction in share of agriculture in India's GDP. It increased the share of India in export in products. It increased FDI inflows into India, and it increased enormously India's foreign exchange reserves. So first is incorrect, second, third and fourth was correct. Therefore, option B here is the right answer to this question. Now I provided all the data here, so you can pause this video and look at the data. Now let us consider the another question in this year, which asked us a trend related to tax revenue as a percentage of GDP and fiscal deficit as a percentage of GDP. Now, both of these phenomena highlight the buoyancy of government's finances. That if the government is able to gather more tax revenue, then it enables the government to spend that tax money on various social sector and infrastructural developments. The government, if it reduces its fiscal deficit, means that the physical levels of government is healthier. So these are kind of trends that we need to understand before we attempt next year's prelims. Now let us consider or see what was the trend related to tax revenue in the year 2018. Now as you can see from this graph, this line highlights the tax revenue of Indian government in many years. Now as you can see, the trend in this tax revenue is rather uneven, so we can't say for sure that it either reduced continuously or it either increased continuously. So first statement here that states that tax revenue as a percentage of India's GDP has steadily increased is incorrect, because this trend is rather uneven and not definite. Now moving to second statement, fiscal deficit as a percentage of GDP in India has steadily increased. Now what is fiscal deficit? Quite simply, fiscal deficit highlights what is the total amount of money borrowed by the government in a particular year. Now, naturally, government has a buoyant sources of income such as tax revenue, non-tax revenue. However, at times of economic crisis, these sources of income, they dry up. Also, to bring countries out of economic crisis, the government, they want to spend more money in order to create demand and consumption in the economy. So, as a result, we see during the times of economic crisis, there are increased borrowing by the government. So, as a result, you can see during the time world witnessed economic crisis in these many years, government's borrowing increased enormously and so did its fiscal deficit increased enormously. However, after the economic crisis got over, the government recognized the risks associated with fiscal deficit and hence you can see there is a downward trend after this particular set of economic crisis years, and this continued to stay down until the year 2019 and 2020. So, we can safely say that in the last decade of 2017-18, India's fiscal deficit reduced significantly. Now, what does the question say about this statement? India's fiscal deficit as a percentage of GDP, has it steadily increased? The answer is no, it has steadily reduced or decreased, hence second statement also is incorrect. And we have to identify correct statements here. Therefore, option D, that is neither 1 or 2 is the correct statement, is the right answer to this question. So, this concludes our today's discussion based on PYQs of the year 2017. Stay tuned to our channel for more such videos relating to 2016 and the previous years. Questions that have appeared in 2016, and the first question of the year was related to persistent deficit budget. There has been a persistent deficit budget year after year. Which action or actions of the following can be taken by the government to reduce the deficit? Now, when is actually government's budget is in deficit? When the revenues earned by the government is less than the spending made by the government. You understand, to fulfill the spending needs, the government needs to borrow money. So, the total amount of borrowing that the government does in a particular year is what you can call the deficit. And this is given in our budget documents as a percentage of our GDP. And it is categorized as the term called fiscal deficit, which in very simple terms is the total amount of money that the government is borrowing to meet its spending needs. Now, to reduce this deficit, you have to understand the government needs to reduce its borrowing. To reduce its borrowing, government will have to control the amount of spending it is doing on various activities. So, any decision by the government which will reduce its spending needs or on opposite side will increase its revenue amount of money that they are earning, it is called as a measure to reduce the deficit of the budget. So, let us see whether these 4 steps can either reduce or increase the deficit levels. Now, reducing revenue expenditure. What do you mean by revenue expenditure? The kind of expenditure government does in order to meet its day-to-day functioning is called as revenue expenditure. For example, payment of salaries to its employees, payment of pensions to its ex-employees, all of this amount to revenue expenditure. So, when government reduces revenue expenditure, you understand its spending will also reduce. Thereby, first option here is correct because it reduces the spending and thereby it reduces the deficits of a budget. Moving to the second statement, introducing a new welfare scheme. Now, whenever the government comes up with a welfare scheme, such as say Pradhan Mantri Garib Kalyan Yojana or Mahatma Gandhi National Rural Employment Guarantee Act, all of this welfare schemes entails higher spending by the government so that people will have welfare benefits. Now, whenever government introduces new welfare scheme, it will not reduce but increase the spending of the government. Therefore, to meet its spending obligation, the government will have to borrow what? Borrow more money and thereby increasing the deficit. Therefore, second statement is incorrect. Moving on to the third statement, rationalizing subsidies. Now, what do you mean by rationalizing? In other words, you can say reducing the expenditure on subsidies. Now, subsidy outgo by the government is quite huge money which it spends every year on food subsidy, fertilizer subsidy, subsidy related to petroleum products, and all of this amounts to huge spending by the government. So, what happens when government wants to reduce the subsidy? Naturally, the spending of the government will reduce. Therefore, the borrowing needs will also reduce because the government is spending less. Understood? So, third statement in the context of our question, that whether rationalizing subsidy would reduce the budget, is correct. Now, reducing import duties. Now, what happens when government reduces import duties? So, naturally, the tax collection from import duties will reduce, which means the revenue of the government is reducing. Thereby, again, when revenue is reducing, you understand for same amount of spending, the government will have to borrow more money. Therefore, by reducing import duties, there is a chance that government will have high budget deficit and not low budget deficit. So, from our context of our question, the fourth statement is incorrect. As you can see, first and third statement is correct. Therefore, option C here is the right answer because we have to identify which of the statements are correct. So, let us move to another question. This question you see appeared again, which of the following is or are included in the capital budget of Government of India? Now, for simplification ease, the government categorizes its budget into two different heads. First is a revenue budget and the second classification is capital budget. Now, any spending or earning by the government which affects its assets or liabilities are examples of capital budget. For example, if the government is creating new bridges, roads, etc., these are an asset of the government because it will pay rich dividends to the government in terms of economic growth. Therefore, it is an example of capital budget. But what if the government decides to take a loan from any other country or any multilateral body like World Bank or IMF? That is a liability to the government because any loan taken by the government will have to be repaid back after some time. So, these assets and liabilities of the government are included in the capital budget. For example, there are other assets of the government such as public sector undertakings, and if government decides to sell these public sector undertakings, it will lead to income for the government, and that is also included as a receipt, under the capital budget. Understood? So, these are what you can call constitutes capital budget. So, let us see whether these three are actually a component of capital budget or not. Expenditures on acquisition of assets like road, building, machinery, etc. You understand? These are assets of the government because using machinery, the government can produce goods. Using roads and buildings, it can discharge its function. And also, these are assets of the government. Second, loans received from foreign governments. Again, I told you, they are liabilities of the government which are included as a part of capital budget. Third, loans and advances granted to the states and union territories are assets of the government. Why? Because when government gives loans and grants, especially loans to the states and union territories, these are examples of capital budget. Why? Because when government is providing states with loans, the state will have to provide that loan back after some time. Also, the government will charge interest income to the state governments, which is again an income source. That is why third option also is correct from our discussion's perspective. Therefore, the correct answer to this question is option D because all of these three are included as a part of capital budget. Understood? Now, with reference to Financial Stability and Development Council, consider the following statements. Now, the purpose of Union government to constitute this Financial Stability and Development Council is to put heads of all regulatory body together so as to increase their coordination among each other, so as to enable them to have a macro view of the economy, whether economy is stable or not. And if God forbid there is a case when economy gets unstable, these chairpersons of regulatory bodies can act together, decide on how to stabilize the economy, how to make economy grow further. So this is the chief purpose of Financial Stability and Development Council. Now the chairperson of this Financial Development Stability and Development Council is the Union Minister of Finance. And other members, they include chairperson of RBI, PFRDA, SEBI, other regulatory authorities. So it is headed by Union Finance of Minister, who acts as a chairman of the council, and members of this body includes head of financial sector regulators such as RBI, Securities Exchange Board of India, Secretary of Department of Economic Affairs, Chairperson of PFRDA, Insurance Regulatory Development Authority, Forwards Market Commission, Finance Secretary. All of these are important functionaries as far as Indian economy is concerned. And you need these people to get together, coordinate their actions so as to stabilize the economy, so as to promote the economy further. And this is what the Financial Stability Development Council does. Now, this body was set up back in 2010, long before the formation of Niti Aayog. So, it is not a part of Niti Aayog. Now, it monitors microprudential supervision of the economy, and it also focuses on financial literacy and financial inclusion. More importantly, understood, the government brought Pradhan Mantri Jan Dhan Yojana, which enabled opening up of bank account of people who did not have bank account before. All of these are measures to further the financial inclusion. And the monitoring and coordination among the various stakeholders is achieved to Financial Stability and Development Commission. Understood? Now, let us solve the question. It is an organ of Niti Aayog. You understood it is incorrect because FSDC was formed in 2010, whereas Niti Aayog started functioning in 2014. It is headed by Union Finance Minister. This is a correct statement. It monitors macroprudential supervision of economy. Again, correct. Correct option is option C because second and third is correct. First is not. Understood? Now, what is or are the purposes of government's sovereign gold bond scheme and gold monetization scheme? Now, before solving this question, let me give you some context. For example, you understand Indians love gold. They love to buy gold jewelry. They love to use gold as an instrument of investment. They love to invest in gold, and India as a country is crazy about gold. Now, there are benefits of this craze because people have certain amount of gold themselves which they can utilize to get loans from financial institutions, which they can utilize or sell in the market in case for emergency purposes they need some cash. They can mortgage those loans in order to fund the educations of their children. So these are the benefits of the loan, gold. But on the other hand, India's craze for gold has also led to import of golds from other countries into India, which you can understand leads to flow of dollars outside India. Now, this creates all sorts of problems. Also, gold is a physical asset which you need to hold in terms of jewelry, biscuits, bricks, etc. And what if there is a theft incident in your house? So, you lose all the holdings in form of gold. So these are the risks associated with the craziness for gold. Now, to reduce this craziness in India and to channelize the gold which is there in the market, the Union Finance Minister in his budget of the year 2015 and 16 introduced two schemes called Sovereign Gold Bond Scheme and Gold Monetization Scheme. Now, in gold monetization scheme, what the finance minister offered is that the physical gold which the people have in their homes or kept away safe in the bank lockers, they can deposit this gold into bank accounts and the banks will provide interest money on the gold that people have deposited. Now, the intention of this gold monetization scheme was actually to promote the investments in gold, to promote use of gold to gain interest income from the government and to use the idle gold which was lying in Indian households in the economy. So you understand, first statement here is correct. Now also people want to buy physical gold in India because there is no other safer alternative as compared to gold. So as to do away with the need of holding physical gold and buying it from the market, the government instead bought the sovereign gold bond scheme. And in this scheme, what happens is that the government said you don't need to buy physical gold from the market because I will provide you with the bond which will have the same value as the gram or 10 grams of gold, and you can use these bond as an alternative of holding physical gold. And to make deals sweeter, the government also said that they will offer gold as a form of investment and also they will pay interest on the gold bonds also. So technically, if I am investing 10 grams worth of money in sovereign gold bonds, so after 1 year, I will get back the money that I have invested in gold. For example, the value of 10 grams of gold back then was 6.4 lakh rupees. And after 1 year, if this increases to 8 lakh, so I will get 8 lakh because I'm returning the 10 grams worth of sovereign gold bond. And on top of that, I will also earn the interest money from the gold deposited. And the interest on this was made tax free. So these were the benefits of investing in sovereign gold bond, that you need not hold physical gold. As against physical gold, you can instead buy a gold bond scheme from the government, which will not just pay you the capital gains from the investment you have made, but it will also pay you with the interest which is not available in case of physical gold. So it wants to reduce India's dependence on gold import because Indians are importing physical gold from other countries. So third statement is correct. However, it does not intend to promote FDI in gold and jewelry sector. Hence, second statement here is incorrect from our questions perspective. So the purpose of sovereign gold bond scheme and gold monetization scheme was to first of all channel the physical gold which is lying idle in our households and in our bank lockers, and to enable people from getting investments on those idle gold and also reduce India's dependence on gold imports. So first and third are correct. Our correct answer to this question is option C. Now let us move to another set of questions which are appeared from the banking sector. Now you understand, questions from the banking sector occur every year and there is not just one question because there are multiple questions from the sector. So you can say this has been one of the favorite segments from which UPSC asks question in every year's prelims. So let us try to understand what kind of banking questions appeared in 2016 and let us see whether we are able to solve it or not. The establishment of payment banks is being allowed in India to promote financial inclusion. Which of the following statements is or are correct in this context? Now first you have to understand what are payment banks actually. Now there are one type of bank called as scheduled commercial banks. For example, SBI, PNB, ICICI, HDFC. These are full-fledged banks that they offer multiple kinds of services, that they take your deposits, they provide you with the debit card. If you want to take loans, they give you loans. If you want to take credit cards from them, they also have that option. So these are full-fledged banks which provide you all kinds of banking services. As against the full-fledged scheduled commercial banks, there are differentiated banks also, one of which are payment banks. Now a similar question occurred last year, that was in 2017, and it was on small finance banks, and similarly in 2016 a question appeared in payment banks. Now payment banks are a kind of banks which are intended to facilitate digital payments in the economy. Now, these are kind of banks which offer only a handful of banking services. For example, you can deposit up to 2 lakh rupees as a saving banks account in the payment banks. And as against your deposits, the bank will provide you with debit card or an ATM card which you can utilize to withdraw the money from your bank accounts. and the upper limit of the deposits that you can make on payment banks is 2 lakhs. Earlier it was 1 lakh, however it was increased recently to 2 lakh rupees. But does this payment banks offer you loans? The answer is no, because these payment banks, they are restricted from offering loans to its customers, and hence loans are not a part of payment banks, and so is offering of credit card, because you can understand credit cards are also an example of loans which are offered by banks, and hence these payment banks can also not extend credit cards to their customers. So these are the examples of what payment banks can do, and these are the examples of what payment banks can't do. Now let us see whether we are able to solve this question. Mobile telephone companies and supermarket chains that are owned and controlled by residents are eligible to be promoters of payment banks. Yes, this statement is correct, because the license of payment banks were originally provided to mobile telephone companies such as Jio got the license, so did Airtel, and other payment companies such as Paytm, Google Pay, they all have the licenses to provide payment bank services. Also, supermarket chains like Big Bazaar, they were also offered the possibility whether they wanted to open payment banks or not. So, first statement is correct. Moving to the second statement, payment banks, they can issue both credit cards and debit card. I told you they can issue debit cards and ATM cards. However, they can't issue any kind of loans, and credit card are a form of loans. That is why they can issue debit cards, but they can't issue credit cards. Hence, second statement is incorrect. Now, payment banks cannot undertake lending activities. This is a correct statement, as I've already told you. They have limited capabilities that they can accept deposits in their saving banks up till 2 lakh rupees. However, you can't make these deposits into a form of fixed deposits. Understood? So, only saving banks and current bank accounts can be opened in payment banks, and these are not involved in lending activities. Hence, they cannot extend loans. So, the third statement is correct. First and third again are correct. Therefore, option B is our right answer. Now, the term core banking solutions is sometimes seen in the news. Which of the following statements best describes this term? Now, you understand, back in time, 30-40 years earlier, you used to open a bank account in a particular branch of, say, SBI, which was near to your house or office, correct? So earlier, you can only deposit the money and transact the money using that very same branch, because that branch maintained your account related data, because that was not the era of internet or digitization. But as the world became more connected, people started to move from one place to another, and hence it appeared a need for having access to your bank accounts even in different places or different countries. So to make things easier, the banks, they wanted to develop a core banking solution, which essentially is a software that is there in the computers of the bank, and this software enables the bank to access your account related data anywhere in the country. That is, suppose if you have a home branch located in your residence in Delhi, but what if you travel to Bangalore? So what if you want to withdraw the money from SBI bank account but in Bangalore? So using the core banking solution, when you visit the Bangalore branch of SBI, you say, this is my account number. The banking official will type your account number in the core banking solution, and he will see how much money do you have in the bank account. And accordingly, he will deduct the money which you are withdrawing from the bank account, and hence the process of banking becomes easier. So this is what the purpose of core banking solution is. That is, it connects every data of every bank branch in the country, and it enables seamless access to your bank accounts without the restrictions of geographical locations. So it is networking of bank branches that enables customer to operate their accounts from any branch of the bank on its network, regardless of where they open their accounts, is a correct statement, as the original idea behind core banking solution was exactly that. Second, it is an effort to increase RBI's control over commercial banks through computerization. This is incorrect. although the banks became computerized, however, the purpose of banks of becoming computerized was to ease their banking businesses, make things more efficient for their staff and also for their customers, and it does not has to do anything related to increase in RBI's control. So second statement is somewhat absurd in nature. It is a detailed procedure by which a bank with huge non-performing assets are taken over by another bank. Also incorrect, not relevant from our discussions point of view, because core banking solution is something else and not even remotely related to non-performing assets. So only first was correct, hence option A here is the right answer to this PYQ. Now, another banking related question, what is or are the purpose or purposes of marginal cost of funds based lending rate, abbreviated as MCLR, announced by RBI? Now, earlier bank used to follow a base rate structure for determining what kind of or what is the amount of interest rates they charge on the loans that they are extending to customers. However, the problem with base rate system was that whatever policy changes the RBI made, it was not transmitted in form of change of base rate of banks. And as a result, the transmission of monetary policy and its objective was not fulfilled, and that is why RBI came up with another solution. It said that the rates based on which the banks will provide loans in the country will be determined based on MCLR, that is marginal cost of funds based lending rate. Also, this MCLR, it is determined internally by the banks themselves. That is, RBI makes changes in its monetary policy, that is RBI changes what you can call is a policy rate or repo rate in the country, and this repo rate determines marginal cost of funds with which the banks lend money to you. Now, when this marginal cost of fund changes, you understand it will also have implications on MCLR and other factors which is used by a bank to determine what should be the MCLR in the economy is negative carry on accounts, which banks use as a cash reserve ratio, because banks need to keep certain amount of money separate under cash reserve ratio requirements, and that money cannot be used to extend loans to the customers. So naturally, the certain amount of money which are used as CRR cannot be extended as a form of loans and hence are a cost to banking operation. Further, banks operate using staffs, offices, etc., which also entails some cost of the banks, and also banks charge some kind of a premium on customers, because, for example, if RBI is depositing or accepting deposits at 6% rate, it charges 10% on loans which is offered to customers, and this is called as a spread. Now, spread determines the profit levels of banks. Understood? So, all of these factors put together constitute and determine what are the MCLR fixed by the bank, and it is the lowest amount of money or rate at which the banks can lend the money to. Understood? So this was the purpose of bringing MCLR, that is to ease the process of monetary policy transmission and to enable banks to assess what kind of interest rates they can charge, and these interest rates will be determined as per the basis of rates which is fixed by RBI. Understood? So these guidelines help improve the transparency in the methodology followed by banks for determining interest rates on advances. Yes, it is correct, because it gives you the objective parameters based on which the RBI will decide what to or what kind of rates will it charge to its customers, and this is what the MCLR is all about. Moving to second statement, these guidelines help ensure the availability of bank credit, the interest rate which are fair to the borrowers as well as to banks. Also, this is correct. Hence, option C is the right answer. Why second statement was correct? Because banks also use the operating cost parameter and the premium that they will charge on the loans that they are extending. Hence, it will take care of the interest of banks and also will take care of the interest of customers also, because the policy decisions of RBI will get transmitted to loans extended by banks using this very factor. Understood? That is why here option C was correct, because both of the statements are right. Now, which of the following best describes the term import cover? Now, import cover is actually the term which determines that countries, by utilizing their forex exchange reserves, how much amount of imports that they can do for a certain months, and this is what determines the import cover. For example, India has currently $643.5 billion worth of forex reserve, which means using this much amount of money, India can import goods at a current rate for 11 months period. So this is 11 months is what India's import cover is all about. And for example, when India back in 1991 had only $10 billion worth of its forex reserve, and because $10 billion worth of forex reserve only enabled India to import goods for 3 weeks, so back in 1991 India's import cover was just 3 weeks, and hence you can understand the financial stability of India, because from 3 weeks our import cover has increased to what, 11 months. So import cover actually is the total value of imports of a country in a year. Sorry, it is not correct. It is actually option D. It is the number of months of imports that a country could be paid for by its international reserve is what import cover is all about. For example, recently you can understand Bangladesh is witnessing economic crisis because of political instability, and because of its economic crisis, its import cover has reduced to just 3 months. So this is what import cover is used in the news, as it highlights the ability of the country to sustain imports for as many months by utilizing their foreign currency or international reserves. Understood? Hence option D here is the right answer. Now the term base erosion and profit shifting is sometimes seen in the news in context of what? Now you understand, whenever two countries have close economic relations, they sign what is called as a double taxation avoidance agreement, which means if a country or a company is operating in these two countries among which the DTAA signed, then the company is liable to pay tax only in one country. For example, Vodafone, it is a country which is owned by Britishers, and hence it is also operating in countries like India. So if theoretically is there a double taxation avoidance agreement between Britain and India, then Vodafone will have to pay tax either in India or in Britain, but in not two countries. So these kind of provisions facilitate investments in countries like India. But there is also another challenge associated with double taxation avoidance agreement, because many companies we have seen, they misutilize this provision by registering themselves as a company based on some tax haven country like Mauritius, Cayman Islands. And when India is agreeing to a double taxation avoidance agreement with such tax havens, what the companies do is that say, we are registered in Mauritius and hence we are liable to pay tax either in India or in Mauritius, and because the tax rates in Mauritius are low, so the company will decide to pay taxes in Mauritius and thereby not paying any tax in India. And a consequence of which is that this provision is misutilized by companies by evasion of taxes. Hence, this base erosion profit shifting is an initiative by OECD, which wants to reduce the amount of tax evasion the companies are doing through double taxation avoidance agreement by charging taxes on the difference tax rates on the companies who are utilizing this provision. Therefore, the purpose of base erosion profit shifting is to curb the tax evasion by multinational companies, and hence option B here is the right answer. Now let us see some questions relating to applied economics, especially with respect to questions that have appeared from some scheme of the government or not. Now with reference to Stand Up India scheme, which of the following statements is or are correct? Now similarly to Startup India scheme, Stand Up India scheme occurred or was brought by the government to promote entrepreneurship among the marginalized section of the society, that is members of scheduled castes, scheduled tribes, women, etc. That these individuals, if they want to seek any business opportunity by setting up of a new business enterprise, they can get loans from the government under the Stand Up India scheme. So the purpose of this scheme was to promote entrepreneurship among SCs, STs and women entrepreneurs is a correct statement. Now, the funds for the scheme is not provided by RBI or Government of India directly. Rather, what RBI and Government of India does is that it provides money to SIDBI, which is Small Industries Development Banks of India, and then SIDBI refinances this money by providing funds to banks who ultimately extend loans to entrepreneurs. Understood? So this is how this scheme provides benefits to its entrepreneurs, that is through refinance done by SIDBI. So both of the statements here are correct, hence option C here is the right answer. Now I've provided the various benefits of the scheme, as this scheme is available to the borrowers who are in the categories of SCs, STs, women, etc. They are eligible to borrow between 10 lakh to 1 lakh crore of funds for setting up of a new business enterprise, that is greenfield enterprise. Are such benefits available to existing businesses that are brownfield exercise? The answer is no. Only greenfield enterprises are eligible for this scheme. And in case if there are more than one person who are starting up of a new business and they seek funds under this scheme, then one of or majority of the ownership of that company should be vested in either a member of scheduled caste, scheduled tribe or a women entrepreneur. Now, this is formulated as a special refinance scheme where the assistance is provided with the help of SIDBI, and the assistance provided is total to the amount of 10,000 crore rupees. So these are the important points that you have to remember regarding the SIDBI and Stand Up India scheme. Understood? Now, another question. This is a quite straightforward current affairs based question. Recently, India's first National Investment and Manufacturing Zone was proposed to be set up in which of the following state? Now, National Investment and Manufacturing Zones were set up by Government of India so to provide the benefits of having manufacturing zones in the country. Now, India, in order to be developed, you understand, wants to make itself as a manufacturing hub. And for that, government is bringing many schemes, one of which is National Investment and Manufacturing Zone. And in these zones, the necessary infrastructure for setting up of new manufacturing factories, the logistics, etc. are taken care of. And the first NIMZ was set up in the state of Andhra Pradesh, and this was very relevant for the question of 2016. So it is quite a straightforward question. Now, moving to another question, what is or are the purposes of district mineral foundations in India? Now, India is witnessing lot of mining activities. It has some economic benefits because India is able to use the mineral resources of its country. But on the other hand, mining activities can also destroy environment, can uplift or shift the people who are living there to other locations, and it creates all sorts of social problems. So as to ameliorate the social problems of the existing community or the local communities, the government decided to set up a district mineral foundation. And the funds in this mineral foundations will be provided by mining companies themselves, as these companies will provide the funds which will be used by DMF to undertake social benefits of the local communities who are affected by mining activities. So promoting mineral exploration activities in mineral rich districts is not a purpose of DMF, rather it is providing social benefits to people affected from mining. Protecting the interest of persons affected by mining operation is a purpose of DMF, and authorizing state governments to issue licenses for mineral exploration, it is not an intention of DMF, hence only option B here is correct. Now this DMF was set up after amending the Mines and Minerals Development Regulation Act of the year 2015, and it came into force back in 2015. That is why you understand question appeared in the year 2016, and that is why we ask you to read current affairs on a daily basis, because the purpose of current affairs keeps you updated with the ongoing and contemporary developments, and when such questions are asked in UPSC, you will know the correct answer. Now, Pradhan Mantri Mudra Yojana is aimed at what? Now, Pradhan Mantri Mudra Yojana was brought by Government of India to promote entrepreneurship, especially among small and marginal entrepreneurs. Now, this Pradhan Mantri Mudra Yojana provides funds or loans to upcoming entrepreneurs, and these are divided into three categories. The first category is Shishu, which means the loans are available up to 50,000 rupees. Second category is Kishore, where loans are provided between 50,000 to 5 lakh rupees. And the third category is called Tarun, where loans are provided up till 10 lakh rupees. Now, recently, 2 months back, there was this new category which was added to Pradhan Mantri Mudra Yojana, was Tarun Plus category, and here loans are available up to amount of 20 lakh rupees. However, this Tarun Plus categories of loans will only be provided to individuals who have earlier taken loans under Tarun scheme and they have returned their loans to the banks, and that is why only these people will be eligible for getting loans under Tarun Plus category. So this was the contemporary development related to Mudra, and you can see even today the Pradhan Mantri Mudra Yojana remains news. And the purpose of this scheme was to bringing small entrepreneurs into formal financial system, because these entrepreneurs, you understand, earlier they were developed or dependent on informal sources of lending, which put them at financial risk, which also let these informal institutions charge higher amount of interest, thereby discouraging the entrepreneurship among youth, and that is why such schemes were brought by Government of India. So, the correct option here is option A, and hence it is the correct answer to this question. So, this concludes our today's discussion on PYQs from the year 2016. Stay tuned for more PYQs, as I will be discussing 2015, 2014 and also 2013 PYQs. So, the first question in today's discussion, which of the following brings out the consumer price index number for the industrial worker? Now, consumer price index is an index which is used to measure levels of inflation in the country. Now, one type of an index which is majorly called is consumer price index combined, which gives the headline inflation in the country. And which body calculates CPI? It is the National Statistical Organization, which is a part of Ministry of Statistics and Program Implementation. Now, this CPI is a combined CPI for rural as well as urban areas. But what about inflation with respect to industrial workers, agricultural laborers or rural workers? Now, the index for calculating consumer price index for industrial workers, agricultural labor and rural workers are not calculated by MOSPI. Rather, it is calculated by the Labour Bureau, which comes under Ministry of Labour and Employment. It is an attached office. So, correct answer to this question is option C, and you can see this is a straightforward question. Now, let us move to another question with reference to Indian economy. Consider the following statements. The rate of growth of real domestic product has steadily increased in the last decade. The gross domestic product at market prices has steadily increased in the last decade. Now, you have to realize and take note of few things. First is last decade. Now, this exam was held in the year 2015. So, last decade would be time period between 2005 to 2015. So, this is the time period in which we have to assess whether the rate of growth of real GDP product or gross domestic product, that is percentage growth of GDP, and gross domestic product at market prices, that is nominal GDP. We have to understand whether these two have increased steadily in the last decade or not. Understood? So let us try to understand this with the help of a graph that I have taken from the internet. Now, if you can see, this highlights inflation levels from 2004 and goes to 2014. So this time frame will allow us the analysis of whether the GDP of India at market prices and the rate of growth of GDP has increased in the last decade or not. And from this graph, you can see India's GDP increased steadily for the first 4 years. However, in 2018, it fell down from 10% to 6.9%, falling further next year to 5.88%. Now, what happened in this year that resulted into less growth in the India's GDP? That was the global financial crisis of the year 2008. So this was the event which created ripples across the world, and India was also not an exception to this trend. So the question which says that India's percentage growth rate of GDP, it has increased steadily, is incorrect, because we have seen here it has fallen down. Now, even if you look at the graph, in all the years, India witnessed some economic growth. However, the growth was uneven. It grew highly before 2008, then it fell down. However, it recovered in 2010 after falling in 2011 and 12 with further recovery in next 2 years. So this growth rate of India's GDP is uneven, and hence we cannot say it has steadily increased in the last decade. But what is important to note that in last 10 years, India's economy has grown by some percentage or not. So the value of nominal GDP, which is calculated at market prices, you can understand has increased every year, although by more percentage or less percentage. Hence, it has steadily increased in the last decade. So let us move back to our question. The rate of growth of real gross domestic product, which you have to understand, that is percentage growth of GDP, has steadily increased. It is incorrect. Therefore, first statement is incorrect. Second statement, the gross domestic product at market prices in rupees, that is India's nominal GDP, it increased in the last decade, and hence second statement here is a correct statement. Now we have to answer which of the following statements is or are correct. Second is correct, hence option B here is the right answer. Now moving to the third statement, a decrease in tax to GDP ratio of the country indicates which of the following. Now the government, it calculates what is the tax to GDP ratio of the economy, because it helps the government identify whether it has been able to collect more tax or not in case the country's GDP is increasing. Because on a very basic idea, you can understand that whenever country's GDP increases, it will lead to increase in salaries of people employed in the economy. It will lead to increase in profits of companies such as corporates, etc. And by increase in salary and profits, you understand naturally the amount of tax which will be collected by the government is also increasing. So the tax to GDP ratio gives us an idea whether the collection of revenue by the government in form of tax is buoyant or not. That means theoretically, if the GDP is increasing by 10%, whether government's tax collection is increasing by 10% or not. Understood? So this is the example that I gave you, that in cases of increasing GDP, that theoretically the tax collection should also increase. So what if the tax to GDP ratio reduces? You are able to say that the economic growth might be slowing. That is why people's salary are not increasing as expected. So is the profits of corporate sector, and hence it will lead to reduction in tax collection. Thereby, first statement here is correct. Now, second statement, less equitable tax distribution of national income. Now, I have to understand tax to GDP ratio is a quantitative term that it tells you the idea of how much tax is collected across the economy with respect to changes in GDP. However, the downside of GDP is that it does not take into account whether the growth has been inclusive or not, or whether all sections of the society are reaping the benefits of economic growth. Hence, we cannot say that it leads to less equitable distribution of national income. Hence, second statement here is incorrect. And we have to identify correct answer here. The correct answer is option A, because only first statement was the correct answer. Now let us move to another question. This one is related to monetary policy, and you know monetary policy is one of the favorite topics of UPSC along with banking. So this question belongs to monetary policy. When Reserve Bank of India reduces the statutory liquidity ratio by 50%, which of the following is likely to happen? Now, reduction in SLR will mean that the banks will require to keep less amount of money as a reserve, which otherwise would mean that the same amount of money that the banks would have been keeping as reserve can now be utilized by banks to extend loans to people. So you understand, this reduction in SLR will lead to increase in what? Increase in money supply in the economy. Also, as banks will now have more funds to give away as loans, then the banks will be promoted to reduce the interest rates on their loans as well, so as to promote the demand of more funds as a form of loans. So India's GDP growth rates will increase drastically. No, it is not a correct answer. Foreign institutional investors may bring more capital into our country. Not a correct answer. Scheduled commercial banks may cut their lending rates is a right answer here. Understood? Now, Basel III Accord, or simply Basel III, often seen in the news, seeks to do what? Now, there is a banking grouping located in Basel city of Switzerland. Now, this is an association of all the central banks across the world, and the purpose of BCBS, which is otherwise known as Basel Bank, it is to increase the coordination among the central banks across the country so as to protect the global macroeconomic health. And the intention of this Basel Bank was originally to increase the health of country's banking sector by making it more resilient and more robust. Now, one of these suggestions, which are known as Basel I, Basel II and Basel III Accords, these were intended to increase or enhance the health of country's banking sector, and in these accords, many agreements and suggestions were provided by the member banks of Basel Accord, and they highlighted of increasing the banking sector ability to deal with any financial crisis. For example, in a part of Basel III Accords, the banking sector is required to maintain a capital adequacy ratio of 10.5% of its risk weighted asset, which means 10.5% of weighted average of all the risk that is incorporated by banks, they should be kept as a safeguard, and this capital can be used by banks whenever they are facing liquidity crisis. So, Basel III Accords is intended to improve banking sector's ability to deal with financial and economic stress and improve their risk management. Hence, B option is the right answer. Now, with reference to India economy, consider the following statements: bank rate, open market operation, public debt, public revenue. Now, what is or are the components of monetary policy? Now, monetary policy, you understand, involves changes in money supply. That is, by monetary policy decisions, the central bank, which is primarily responsible for overlooking the monetary policy of the committee, decides whether it wants to increase the money supply or it wants to reduce the money supply. And the tools which are available with central banks are both qualitative as well as quantitative tools.
Repo rate, reserve repo rate, bank rate, open market operations which involve selling and buying of government securities, these are examples of quantitative tools. Whereas moral suasion, selective credit control, these are examples of what? Qualitative restrictions. And these tools are utilized by central bank, which in India's context is Reserve Bank of India, to discharge its monetary policy objective. Now, what are monetary policy objectives of RBI? It is primarily to control inflation. However, it should control inflation even after promoting economic growth. So, these are two objectives. This one is statutorily mandated to the RBI that it has to keep the levels of inflation between 2 to 6% of consumer price index. So, in discharging these kind of functions, what the RBI does is that it uses monetary policy tools such as bank rate and open market operations. Whereas public debt and public revenue are examples of what? Fiscal policy. And who discharges fiscal policy? It is the central government and not the Reserve Bank of India. So, third and fourth are examples of fiscal policy and not monetary policy. Hence, only 1 and 2 are correct. Therefore, option C here is the right answer. Now, with reference to inflation in India, which of the following statement is correct? Now, I told you it is the responsibility of the Reserve Bank of India and it is statutorily mandated on the Reserve Bank of India to control the levels of inflation. And it does so by qualitative and quantitative tools of monetary policy, as we discussed in the last question. So, quite straightforward question. This is the Reserve Bank of India has no role in controlling inflation is incorrect. Controlling the inflation in India is the responsibility of Government of India only is incorrect, because it is the responsibility of RBI primarily and also of the government. Decreased money supply circulation helps in controlling the inflation. Now, whenever there is an increase in money supply, you understand it increases the amount of money people will have, so it will also increase the demand for goods and services. Now, what we have seen is whenever the demand of goods and services they increase in an economy, so we see there is a upward pressure on the price levels of goods and services, and this is what inflation is all about. So, naturally, to control the increase in prices, that is inflation, what you can do is do the opposite of this step, is to reduce money supply in the economy, and hence decreased money circulation helps in controlling the inflation is correct from this question, whereas opposite, increased money circulation helps in controlling the inflation is incorrect. So, C here is the right answer. Pradhan Mantri Jan Dhan Yojana has been launched for, now this was launched in the year 2015 by Prime Minister Modi, and he announced this policy measure from the Red Fort when he was making the speech on the occasion of Independence Day. Now, this Pradhan Mantri Jan Dhan Yojana, which was introduced by Prime Minister Modi, it was announced in 2014. It highlighted that many people in the Indian economy, particularly women, people from marginalized community, they did not have access to banking services. Leave alone access to banking services, people did not even had a bank account. So, the intention of this Pradhan Mantri Jan Dhan Yojana was to first of all open bank accounts for all the unbanked people living in the country, and also encourage them to use banking services such as use of debit card, use of checks, use of zero balance accounts, and hence Pradhan Mantri Jan Dhan Yojana was intended to promote financial inclusion in the country, because as many sections of the society did not participate in the banking operations, they did not have a bank account, it led to financial exclusion of these people. So, by opening their bank accounts, providing them with debit cards, encouraging them to transact more using their banking accounts by
enabling them to open zero balance accounts. All of these measures were intended to promote financial inclusion in the country. Hence, option C here is the right answer. So, you can see most of the questions that have appeared in 2015 are quite straightforward. Whereas questions that are appearing in past few years, that is from 2021 and onwards, these questions are more analytical in nature. So, that is why we are trying to assess how the trends of UPSC's exam and papers have changed over the years, particularly with respect to economy subject. Now, with reference to union government, consider the following statements. The Department of Revenue is responsible for preparation of union budget which is presented in the parliament. It is incorrect because it is Department of Economic Affairs and not Department of Revenue which is responsible for presenting or preparation of budget. Now, second statement, no amount can be withdrawn from the Consolidated Fund of India without the authorization of Parliament of India. This is a correct statement because Consolidated Fund of India includes all the money which the government earns by measure of revenue such as tax collection. All of these are credited into Consolidated Fund of India, and to take money out of Consolidated Fund of India, government needs the approval of Parliament of India, which is done through passing of appropriation bill in the every year's budget. Whereas third statement, all the disbursements made from public account of India also need the authorization of Parliament of India. Now, this is incorrect because public account as against Consolidated Fund of India is an account where money from debt sources such as small saving schemes are credited into public account of India, and it is the discretion of the government that it can utilize the funds out of public account of India even without the approval of the Parliament of India. So, third statement is correct. Now, as you can see from our discussion, we can say that only second statement is correct. Hence, option C here is the right answer. Now, the problem of international liquidity is related to non-availability of which of the following? Now, international liquidity primarily deals with trade in goods and services. And as you can understand, the payments of goods and services are made primarily in foreign currencies. So, as to balance their capital account and current account, many countries, they have what is called as a foreign exchange reserves. Now, back in 1991, if you can recall, India faced an economic crisis, whereas forex exchange reserve reached to a level of $10 billion, which made India only able to import goods and services for some total of 3 weeks. So, this is what a situation highlights, that India faced a problem relating to international liquidity. Similarly, many countries such as Pakistan, Sri Lanka, Bangladesh now, they are facing some kind of economic crisis, and hence their foreign exchange reserve have also depleted quite significantly, which means they have to secure loans from other countries like India, China, etc. They have to demand some similar funds from IMF to fulfill the obligations of external payments. And these situations highlight the problem or the crunch of international liquidity. Hence, dollars and other hard currencies is the problem relating to international liquidity. Therefore, option C here is your right answer. Now, convertibility of rupee implies which of the following? Now, naturally, for external payments, you understand you have to exchange your domestic currencies for foreign currencies like dollars, pound, yen, etc. So, all of this is the process of what you can call convertibility of the currency, that is converting your domestic currencies into foreign currencies for the purpose of undertaking external payments. Now, there are two types of convertibility.
First is convertibility in current account, which means the amount of money you need to exchange for payments of goods and services that you have imported, or for payment of various small term transactions. Whereas for payment of long term transactions, that is capital account, there are also the need for exchange of domestic currencies with foreign currencies. Now, in terms of convertibility, India permits current account convertibility, which means barring certain restrictions of not sending more than $250,000 outside India, India permits full current account convertibility for short-term transactions. Whereas, as far as capital account convertibility is concerned, India has eased out the restrictions quite significantly. However, even today, there are very small amount of restrictions which impede full capital account convertibility. Now, convertibility of rupee, which means being able to freely permit conversion of rupee to other countries and vice versa, is the correct answer to this PYQ. Now, the index of 8 core industries, which of the following is given the highest weightage? Now, index for 8 core industries is published by Office of Economic Advisor, which comes under Ministry of Commerce and Industry. Now, this index of 8 core industries, as the name suggests, it takes into account 8 important core industries of India, that are coal, crude oil, natural gas, refinery products, fertilizers, steel, cement and electricity. And currently the highest weightage is given to refinery products, followed by electricity. Now, among these options, you can see electricity generation has the highest weightage. Therefore, option B is your correct answer. Now, traditionally, the highest weightage, as I told you, is given to refinery products, whereas electricity generation has the second highest weightage. But from among these 4 options, electricity generation has the highest weightage, fertilizers production has the least weightage. Hence, option B here is the correct answer. Now, fair and remunerative prices of sugarcane is approved by which of the following? Now, there is a process of announcing fair and remunerative prices, based on which these sugar mills will procure cane or sugarcane from sugarcane cultivating farmers. Now, this FRP is announced or advised and recommended by Commission for Agricultural Cost and Prices, also known as CACP. Now, this commission recommends the FRP, and it does so after consulting state governments and other stakeholders such as farmer organizations as well as sugar mill owner association. Now, after it recommends a CACP, it is the responsibility of Cabinet Committee on Economic Affairs whether to accept or to reject the recommendations of CACP. So, technically, it asks you who approves the FRP of sugarcane. It is the Cabinet Committee of Economic Affairs and not Commission for Agricultural Cost and Prices, because it recommends, whereas the approval of FRP is given by Cabinet Committee of Economic Affairs. Now, moving to last question. In India, markets in agricultural products, they are regulated under. Now, markets in agricultural products, in Hindi they are known as mandis. Now, these mandis are regulated by an state government formed Agricultural Produce Marketing Committee, and these APMCs, they are in charge of managing a particular mandis which are formed at a certain geographical locations. Now, the approval or constitution of these APMC mandis, they are done so under the aegis of Agricultural Produce Market Committees Act, which are enacted by respective state governments, and hence option B here is the right answer.
So this was all for today's discussion on 2025 PYQs from the economy section. And as you saw, most of the questions were quite straightforward. That is, barring one or two questions, most of the questions, they did not require any kind of analysis on the part of aspirants. On the other hand, questions which are appearing in past few years, especially after 2021 onwards, you will see the trend is becoming more towards the analytical based questions. However, the importance of PYQs, especially the older ones, remain quite decent even today, as you can understand the concepts or the thought process of UPSC which goes behind how to frame a question, and it will help you immensely over the course of your UPSC preparation. So stay tuned to our YouTube channel, as we are in the process of uploading more PYQs, and which you will be able to see a separate playlist given in the playlist section. Now the first question that appeared in 2014 was from banking sector. The terms marginal standing facility rate and net demand and time liabilities, sometimes appearing in news, are related or are used in relation to what? Now you must be aware of the term often which appears in the news called repo rate. Now repo rate is the rate in which banks can get loans from the central bank, that is RBI. Now as banks, they seek loans from RBI. But in return for these transactions, banks will have to provide government securities as a collateral. Now, the government securities which are provided by banks under the repo rate cannot be the government securities which it has kept for its obligation under statutory liquidity ratio. That is, there are some government securities which are utilized by banks and are deposited as its obligation towards maintaining a statutory liquidity ratio. But what if the government or the banks, it exhausts the amount of government securities which is left to it for use of repo rate? So in that case, the RBI offers another option to the banks. That is, the banks can lend money from RBI using the marginal standing facility rate, even utilizing the government securities it has kept for its SLR obligations. However, on the other side, the repo rate currently is 6%, but for seeking funds under MSF, the banks will have to pay higher interest of 6.25%. So you understand, for borrowing money under MSF, it incurs a kind of a penalty rate which is 0.25% extra over and above what the banks will pay for repo rate. This is why it is used in relation to banking. Now also, banks have certain kinds of deposits from its customers, and these can be categorized into two terms. First is demand deposits, which are deposits made under current account and saving account. And why are these called demand deposits? Because the demand for these deposits enable the banks to return the money to its borrowers whenever the lenders demand it from them. Whereas time deposits have lesser amount of liquidity, which includes recurring deposits as well as fixed deposits, because banks, they send these monies to these deposits for a longer period of time, and hence their liquidity is less when you compare it with demand deposits. So it is clear from our discussion that these two terms, that is marginal standing facility rate and net demand and time liabilities, are used in banking operations. Hence option A is the right answer. Now let us move to another question which appeared in this year. Now, what is or are the facility or facilities the beneficiaries can get from services of banking correspondents, also known as bank sathis, in the branchless areas? Now, there are many rural areas in our country, even in 2025, where the nearest bank branches or the ATM are quite far away. So, what if the persons who are living in a village which does not have access to banks or ATMs, what if they want to withdraw money from their bank accounts? So RBI and banks, they provided for a facility towards these people. That is, a banking correspondent, also known as banking sathi, will come to their villages and homes, and this or the villagers, they can withdraw money with the help of banking correspondents, as they will carry an instrument, and using these instruments, the banking correspondents or banking sathi, they'll be able to identify whether you control a particular bank account or not, and whether if you want to make a deposit, they will feed it into their systems and give you the required cash. Also, such banking correspondents enabled you to deposit monies in your social security accounts and also access to the subsidies that the banks or the companies transfer into your bank accounts. So all these kinds of facilities, which includes withdrawal of money from their bank accounts, withdrawal of subsidies, as well as social security benefits from the bank account, was the original intention of bringing this facility of bank sathis. So both first statement, it enables the beneficiaries to draw their subsidies and social security benefits in villages, is correct, and it enables the beneficiaries in rural areas to make deposits and withdrawal into their bank accounts is also correct. So therefore both statements are correct, hence option C here is the right answer. Now let us move to another article or another question. This question, in context of Indian economy, which of the following is or are the purpose or purposes of statutory reserve requirements? Now I've told you in our previous discussions also, banks, for example, for every 100 rupees which are deposited into the bank accounts, bank cannot extend the loans worth of rupees 100. Rather, some amount of money the banks will have to keep it with themselves as an obligation for statutory reserve requirements, that is cash reserve ratio and statutory liquidity ratio. Now currently this percentage of money which is deposited under SLR and CRR requirement, they vary, and it is approximately, for example, consider 20%. So for every 100 rupee which is deposited into the bank account, banks will keep 20%, that is 20 rupees aside as an obligation to meet its CRR and SLR obligation, whereas it can only extend loans worth of rupees 80. So you can see, through meeting SLR and CRR criteria, the bank, they are left out with less amount of money to extend as loans. So what if the RBI increases this rate? It will reduce the amount of money that the banks can lend further. And what if banks or RBI reduces this reserve requirement? This will increase the amount of money that the banks can lend, and hence this can change the money supply in the economy. So first statement, to enable the central banks to control the amount of advances the banks can create, it is a correct statement as far as statutory reserve requirement is considered. Now to make people's deposit with banks safe and liquid, the RBI has two mechanisms. First is insurance facility. It provides through DIGCC, whereas there is also a requirement of capital adequacy ratio, that a certain amount of money that the banks extend, their risk weighted amount has to be kept aside for banks in order to maintain the liquidity of the deposits. So in context of our statutory requirement, the second statement is incorrect. To prevent the commercial banks from making excessive profit is again not the intention of RBI for maintaining SLR or SRR, hence third is incorrect. To force the banks to have sufficient vault cash in order to meet their day-to-day requirements is also not a correct statement. Hence, only one is correct. Therefore, option A is the right answer to this PYQ. Now, if the interest rate is decreased in an economy, what it will result into? Now, in order to promote growth in loans, the banks or the RBI, it reduces the interest rate in the economy. So by reducing the interest rate, what the RBI wants to do is it wants to increase money supply in the economy. So let us try to understand whether by increasing interest rate or by increasing money supply, which of the following is correct. Now decrease in consumption expenditure in the economy. Now theoretically, whenever there is an increase in money supply due to reduction in interest rate, it increases also the consumption level of people. Because you understand, people will have more money in their hands, hence demand for goods and services will increase, thereby promoting increased consumption. Therefore, A is not the answer. increase the tax collection of the government? Also is incorrect, because we can say for sure consumption's level will increase, but will it lead to increased tax collection? We cannot say for sure. That is why option B is incorrect. Now, increase in total savings in the economy. Now, what if the interest rates in the economy is lower? Then you understand people will not encourage to put their money into the savings in the economy. Why? Because they'll be getting less amount of interest for the money they deposit as savings. So less amount of interest means the savings in the economy, they reduce and not increase. So D is incorrect. Thereby increase in investment expenditure is a correct statement here, because as interest rates they reduce, so is the banks will reduce their amount of interest rates they charge on loans, which will promote companies to take more amount of loans and increase their investment expenditure in the economy. So that is why option C here is the correct answer to this PYQ. Now let us move to the next question. With reference to union budget, which of the following is or are covered under non-plan expenditures? Now earlier, when planning commission was in place, the budget of Indian government was divided into two heads. First was plan budget and another one was non-plan budget. Now, any objective of the government, if it were to be fulfilled, such as meeting the amount of irrigation or educational or health outcomes, the spending made under those outcomes which are mentioned in the plan given by Planning Commission, that was categorized as a planned expenditure. Whereas rest of the expenditures made by the government, not in order to meet the demands of planned objectives, but for meeting its day-to-day requirements, such as defense expenditures, interest payments on loans, giving salaries and pensions to its employees and ex-employees, as well as providing subsidies to people of India under agricultural, food, fertilizer, etc. These are examples of non-planned expenditure. So all of these four are examples of planned expenditure, hence option C is correct. However, from the budget of 2017-18, the government, you understand, back in 2014 abolished Planning Commission and replaced it with Niti Aayog. And from 17-18 onwards, when the 12th plan ended, the government did away with the distinction of plan and non-plan expenditure. So this does not extend or exists anymore. Understood? So this kind of a question you cannot expect for UPSC to be repeated again. As all four were correct, hence option C is the right answer. Now let us move to our next question. The sales tax that you pay while purchasing toothpaste is example of what? Now sales tax earlier, particularly in the pre-GST era, was levied and collected by the state government. Now state government imposed indirect taxes on many goods of consumptions, be it toothpaste, etc., and sales tax was one of them. However, when GST came into application, all of these kind of indirect taxes such as VAT, sales tax, etc., they were done away with and was replaced by single unified indirect tax called as goods and services tax. As it was levied and collected by state government, hence option D here is the right answer. Quite a straightforward question. Now, with reference to balance of payments, which of the following constitutes the current account? Now, nation's balance of payment can be categorized into two different accounts. First is current account, which deals with all short-term and one-time transaction, such as transaction for trade in goods, trade in services, or for transfer payments such as remittances. So expenditures incurred under capital account, it included short-term transactions, particularly in return as a payment for goods and services which you import or what you get out of goods which are exported out of country. Similarly for services and transfer payments, because these are one-time payments. Whereas the second category of balance of payment is called as capital account, which includes all long-term transactions made by the citizens and government of India. Now, examples of capital account, they include investments by foreign investors through FII route, through FDI route, loans taken by government and companies such as external commercial borrowings. All of these are examples of the transactions made under capital account. Now, this question asks you to identify the applications or transactions under capital account. Now, to make things easier, let us try to understand what constitutes current account. And the screenshot that I have provided here, I have taken it from NCERT. Now, you see, current account transactions utilize trade in goods, and the difference between exports and imports are termed as balance of trade. Whereas trade in services and the difference between imports and exports are termed as balance of services. And it includes net factor income, non-net factor income, which includes the compensation you receive from employees, and net investment income, and transfer payments such as transactions related to gifts, remittances and grants. These are the composition of current account. So coming back to the question again, balance of trade is a part of current account, so is balance of invisibles, which is anything except trade is categorized under balance of invisibles. Whereas foreign assets are long-term assets, you can understand, hence these are examples of capital account and not current account. So is special drawing rights, which are rights that the India has in multilateral bodies such as IMF. Also, these are long-term transactions, hence they are example of capital and not current account. So only first and third is correct, hence option C here is the right answer. Moving to another question, what does the term venture capital means? Now you understand, startups, in order to become more productive and grow, they require large amount of money. So there are two kinds of investors. First are called as angel investors, as these are high net worth individuals who invest in the very nascent stage when the startup is trying to build into a business. Now these kind of investments, these are generally made on personal connections, that a high net worth individual, if he actually believes in the potential of the startup, then he or she will decide to invest in the company, and they are called as an angel investor. Whereas there is an other kind of investors called as venture capital, and the intention of these venture capitalists is just to make economic profit out of the investment in startups. Now they see the balance sheet of the startup, they understand the potential of the startups, and then if they feel that the startup will actually get better in future, these venture capitals, they invest their money into the startups, and after a period of time when that money has turned manifold or has increased multiple times, then the venture capitalists themselves will try to sell off their stake and move to another startup. So these are the kinds of investment made generally in startup, particularly with angel investor and venture capitalist. So these are long-term startup capital provided to new entrepreneurs just from a commercial point of view, and therefore B is the right answer. Now, what is the main objective of 12th 5-year plan, and why this question appeared in 2014? Because 12th 5-year plan was in place from 2012 to 2017. Now, this is a very factual question, that if you have read the objectives of 12th year plan, then only you will be able to solve this question correctly, and the options are quite close: inclusive growth and poverty reduction, inclusive and sustainable growth, sustainable and inclusive growth to reduce unemployment, or faster, sustainable and more inclusive growth. So let us try to seek our help into the objectives of 12th 5-year plan, which was the last of the 5-year plans that India saw, and the main objective of 12th 5-year plan is faster, sustainable and a more inclusive growth. And why did we needed a faster, sustainable and a more inclusive growth in 2012? Because India witnessed an economic downturn when the world was grappling with global financial crisis in 2028. And India, after it recovered from the fast economic growth that it saw previously to 2008, it wanted it to grow much more faster. Also, this growth needed to be sustainable so that India, although is a developing country, but for it to need to become developed, it needs faster growth which should carry on for a large amount of years. And that is why you needed a sustainable growth. And why? It needs to be more inclusive because the fruit of economic growth should be borne by each and every section of the Indian society and not so that the amount of inequality increases in the economy. So this is not what any economic growth objectives would want, and that is why faster, sustainable and more inclusive growth was the objective of 12th five-year plan. And the main aim of 12th five-year plan was to increase the pace of GDP growth, and it sought to achieve an average annual growth of 9% per year, which included 4% of agricultural sector growth and about 10% of minimum of manufacturing sector of growth. Understood? So coming back to our question, option D here is the right answer because 12th five-year plan had faster, sustainable and more inclusive growth as one of its objectives. So this was all for our today's discussion for PYQ from the year 2014. Stay tuned as one more video in this series is left, that is PYQs of the year 2013. Now a question might be appearing in your mind that why are we taking questions from 2013 onwards? Why not 2015 or 2016? Well, the reason to this curiosity is that from 2013 onwards, UPSC reformed or changed its pattern of questions in the prelims. And since then, from 2013 and onwards, we have seen particularly from the subjects like economy and polity, more questions are being asked. For example, from 2013, 17 questions in economy were asked, and this trend of questions, more than 15 questions every year, has almost continued since 2013. So that is why we have been trying to approach our PYQs from 2013 onwards, and individual subject-wise PYQs are being provided, and I'll also make sure that a composite PYQs for all economy related PYQs from 2013 to 2024 will be provided to you in one single video also. So in that context, let us now try to start solving the questions which appeared in the prelims of the year 2013, particularly from economy section. Now in India, deficit financing is used for raising resources for which purpose? Now actually deficit is, difference between government's expenditure, and when expenditure of the government is more than the revenue of the government, you understand it is termed as a deficit. Now there are many sources through which the government finances this deficit. For example, it borrows fund from the market, it borrows fund from banks, it may ask the RBI to borrow funds from the market. So these are the kind of ways in which the government deficits its finances. Also, there is one more controversial way that governments prints more cash. However, printing more cash has several economic implications. For example, it leads to rise in inflation. Now, the purpose of the government for deficit financing, first of all, is to encourage economic growth in the country. Why? Because when government undertakes more expenditures, particularly for capital related expenditures or undertaking welfare measures for the people of India, that means government wants to make people much better off. It wants to make the level of our infrastructure in the country much better, and all of this is having one single goal, that is for undertaking economic development. So that is why first option A is the right answer to this PYQ which came in the year 2013. And mostly PYQs from this year are quite straightforward, which you'll understand this in the scope of our today's discussion. Now, this is the explanation which you can watch after pausing this video. Now, let me move to another question which appeared in 2013. Consider the following statements. Now, the first statement, inflation, it benefits debtors, and inflation, it benefits bondholders. Now, let us try to understand how inflation impacts debtors and inflation impacts bondholders. Now, for example, if you or I go to a bank and we borrow sum total of 1 lakh rupees from the bank, and we have to repay this next year, that is next year. Now, suppose if there is an inflation in India this year. So, what inflation does is that it erodes or reduces the value of money. So, technically, we have to repay this amount next year. But what if due to increase in inflation, the value of 1 lakh rupee in relative terms reduces? So, that is why people like you and I who get loans are called as debtors, and we debtors, we have to reduce or we have to repay the exact amount of money after 1 year or when the time the conditions require us to return the money, but the relative value of rupee has reduced actually. That is, although you are returning 1 lakh rupee, but the value is not equal to 1 lakh because of rising inflation rates. So, that is why whenever we are required to return the money after some time, and if there is an inflation, it benefits the debtors of the economy. So, the first statement is correct. Now, let us see how inflation impacts bondholders. For example, I bought a bond for rupees 1 lakh and I have to pay 4% interest, or I am liable to get 4% interest on the investment I made in the bond. Understood? So, this is my rate of return. But what if the inflation in the economy was 6% that year? So, technically, my rupee which I have invested just to get 4% rate of return, actually the value of rupee is increasing by 6% in that particular year. So, my actual rate of return will not be 4%, rather it will be the difference of 4 and 2%, that is minus 2%. So, in theoretical term, because of inflation, the value of my 1 lakh rupee which I have otherwise invested in a bond has actually reduced by 2%, and this is my real rate of return. So, that is why you understand inflation, it erodes the value of investment or interest that a bondholder gets, hence it does not benefits, rather it goes opposite of benefits, hence second is the wrong answer. So, from this discussion we can safely say only first statement is correct, and we have to identify correct statements here. Therefore, option A is the right answer, because inflation actually benefits people who get loans or who are borrowers in the economy. However, people who invest in the economy, particularly using bonds, they are negatively impacted by inflation, and hence it does not benefit them in any manner. Now, disguised unemployment generally means what? Now, suppose I have a farm, and to grow crops on that farm, I require 5 laborers in general. So, what if these 5 laborers, they are responsible of growing the crops on my farmland? But what if I decide to hire 8 laborers? So, do you think actually the farm will give more output just because I am hiring more laborers? Because there is a capacity beyond which the farm cannot give out more crops, irrespective of the amount of laborers I put in. So, suppose if I am employing, or my farm requires just 5 laborers, whereas I hire 8 laborers against them. But you understand, the output or productivity of my farm will not be impacted, whatever be the case of laborers I hire. So, in that logic, these additional 3 laborers or extra 3 laborers will be categorized as disguised unemployment, which means their role in increasing the productivity of my farmland is 0. That is the additional productivity just by hiring extra laborers, I'm not getting any. So this is what the meaning of disguised unemployment. That is, marginal productivity of labor becomes zero because they do not economically contribute to the economic activity just because they are working in a farmland or any economic enterprise. So that is why when marginal productivity of a labor is zero, that is, they are making no economic contributions, this is the term used for disguised unemployment. Now consider the following liquid assets: demand deposits with the bank, time deposits with the bank, saving deposits with the bank, and currency. And you have to organize these four options in current sequence with decreasing order of liquidity, which means you have to go from highest to lowest in matters of liquidity. Now, among these four, you can easily say that currency has the highest liquidity. That means our answer should begin from 4. Whereas time deposits, which are fixed deposits, recurring deposits in bank, which you can only mature after their end period. That is, if you have deposited your money for 2 years under fixed deposit, you will only liable to get your money after 2 years, which is an example of fixed deposit. Now, theoretically, you can always withdraw your money, but you have to pay certain penalties for that. So that is why the liquidity of time deposits is lowest. So we leave out 2 slots and the lowest is 2 because time deposit has the lowest amount of liquidity. So correct order is 4 and last one is 2. Now, which among demand deposits and saving deposits have the highest amount of liquidity? Now, demand deposits consist of 2 kind of deposits made under current account and made under savings account. Now, liquidity in current account is higher. Why? Because current accounts are those accounts, especially the ones where business enterprises open their account in banks, and this allows the businesses to withdraw and deposit their money at much ease. So in terms of liquidity, current account, they have higher liquidity when compared to saving account. So the liquidity of demand deposits will be higher than saving deposits. So the correct option here is 4, 3, 1, 2. Sorry, beg your pardon. The correct option will be 4, which has the highest liquidity, followed by demand deposits. This will be followed by saving deposits, and the least amount of liquidity is there with time deposits. So the correct order is 4, 1, 3, 2. Option D here is the right answer. Now, a rise in general level of prices may be caused by which of the following factor? Now, there are 2 factors with which there is an increased level in prices. For example, if a demand of a commodity increases or supply of that commodity reduces, it leads to increase in level of prices. Also, if you increase the money supply, this money supply will automatically mean the demand for goods will increase because people have more money, and it also leads to increase in general level of prices. So increase in money supply is correct. As I've already told you, increase in money supply increases the aggregate level of demand in the economy. A decrease in aggregate level of output means reduction in supply. It increases the demand for that same supply because now more money is chasing less amount of goods. So decrease in level of supply increases the level of prices. An increase in effective demand, as I've already told you here, because of many factors like more disposable income, higher employments, less amount of taxes, there is a chance that the amount of money that people have will increase, and naturally this will mean that people will start demanding more and more goods, which increases the effective level of demand, thereby increasing the general level of prices. Now all of these 3 are correct and we have to identify correct answer. So option D again is the right answer to this PYQ. Now, which of the following is likely most inflationary in its impact? Now, whenever government
has some kind of deficit, one of the ways that government makes up for its deficit is that it can borrow money from the market, it can ask RBI to borrow money on its behalf, or also the government can decide to print the money to get out of its deficit. But one of the implications that by printing money, the government increases the level of money supply in the economy. And from our previous discussion, you understand whenever there is an increase in money supply, general demand for goods increases because more amount of money is now chasing same amount of goods. And this leads overall to increase in price levels in the economy. Now, as compared to other financing methods for its debt, the printing of new money to finance its budget deficit is the most likely or the most inflationary in this regard. So, therefore, option D here is the right answer. Now, whenever government repays its public debt, it means the level of debt for the government reduces. Thereby, it will not have that impact on inflation in the country. Now, borrowing for public to finance budget deficit, you understand, does not leads to increase in money supply because public had the money and the same money is now given to government. Now, borrowing from banks to financial budget deficit, you understand, can have some impact, but the impact on inflation is less than when the government starts to print new money because it is a policy called helicopter money. When money supply drastically increases in the economy, thereby pushing the price levels up. That is why option D here is the right answer. Now, supply of money remaining the same, when there is an increase in demand for money, there will be what? Now, this kind of happens when banks in our country face liquidity crisis because there is no increase in supply of the money. However, the demand for money for various purposes in the economy increases, one of which is demand for newer credit. So, when supply of money remains the same, what banks does to attract money into its bank account is that it increases the rate of interest in the economy. And hence, whenever the supply of money remains the same and the bank increases their interest rates, it increases the attractiveness of bank deposits and thereby increasing the demand for money. So, option B, increase in rate of interest, are the example of when the money supply is the same, the demand for money increases. Now, economic growth in the country X will necessarily have to occur in which of these following four options. Now, if there is a technical process in the world economy, I understand that can happen, but will it lead to increased economic growth in every condition? The answer is no. For example, there are countries like Japan and Germany who are technically very advanced, but they do not have the level of labor supply so as to undertake economic growth in general. So, that is why we have seen despite several technological advances, these countries have rather remained very less economic growing or even somewhat economically stagnant in nature. So, first statement we can say for sure that technological process obviously leads to world economy. What if there is a population growth in X? Now, population growth may lead to economic growth. However, in general, that case may not be true because what if your population does not have adequate amount of food or good health or even educational outcomes? So, if your population does not have access to these kind of basic goods, they will not emerge into an economically productive workforce, and hence population growth does not always guarantee high economic growth. Now, what if volume of trade grows in the world economy, but there is no absolute way that it will lead to economic growth in a particular country, because what if countries Y or Z are responsible for increase in world trade and not X? So, that is why these conditions may exclude the country X, hence option D is the wrong answer. So, from our discussion we can say whenever capital formation is happening in X, it means investments in infrastructure are increasing, and investment in infrastructure, you understand,
plays a key role in capital formation, plays a key role in creating jobs, creating key role in economic growth. So these are the reason why increase in capital formation leads to better infrastructure, and this creates opportunities for economic growth and more jobs. So option C here is the right answer. Now, national income of the country for a given period is equal to what? Now, national income actually is the income or final value of goods and services produced by the nationals of a country. So, sum total value of goods and services produced by the nationals is incorrect because it takes into account both intermediate and final goods. However, to calculate national income, we have to exclude intermediate and include final goods. Therefore, option A here is incorrect. Now, money value of final goods and services produced is the right answer because that is the definition of national income. That gross national income is the difference between countries' GDP and net factor income abroad, which means the contribution in our economy by foreign nationals are excluded, and contributions in other countries' economy by Indian nationals, they are added to get the value of NFIA, and which we deducted from GDP to get the gross national income of a country, which is option D. Money value of final goods and services produced is the example of national income. Now, Reserve Bank of India regulates the commercial bank in matters of what? Now, it regulates commercial matter that whenever any branch is expanding into newer localities, the banks will have to take permission of the RBI. Or what if two or more banks decides to merge their business? Again, they have to seek permission from RBI. And what if a bank which is facing several losses or some sort of a corporate crisis, if they want to close their business, again they have to approach RBI. Whereas RBI regulates the liquidity of banking assets through measures such as capital adequacy ratio, statutory liquidity ratio, cash reserve ratio. All of this reduces or increases the value of liquidity of assets. So from our discussion, all of these four are methods through which RBI regulates the commercial banks. Therefore, option D is the right answer to this PYQ. Now, an increase in bank rate generally indicates that now whenever RBI increases its policy rate such as repo rate or bank rate, this implicates that RBI wants to reduce money supply, because whenever there is an increase in interest rates in the economy, it will promote people not to have cash with themselves. Rather, they will prefer that the money that they have in cash, they will deposit it into their bank account so as to gain higher interest rates, which is a purpose of increasing the repo rate and bank rate. So, the purpose of increasing repo rate or interest rates in the economy is to reduce money supply, which generally happens whenever the inflation levels in the economy are quite high. So, market rate interest are likely to fall is wrong because it is likely to rise. Central bank is no longer making loans to commercial bank, again incorrect. Central bank is following easy money policy. Easy money policy is where bank wants to increase the money supply. So this is not the case. We have understood that by increasing repo and bank rate, bank wants to reduce money supply, not increase. So option C incorrect. Therefore, central bank is following tight money supply. Tight money supply means it wants to reduce the money supply in the economy. And how it reduces the money supply? By increasing policy rates such as repo rate, bank rates, etc. So option D here is the right answer to this PYQ. Moving to another question, in context of Indian economy, open market operations means what? Now, there are many qualitative tools which are available to the RBI so as to increase or reduce the money supply in the economy. One of which we understood in the last question. It was the policy rate such as repo rate, that whenever RBI increases repo rate, it reduces the money supply in the economy. Now, another quantitative tool which is available with RBI is called open market operations, and in open market operations, what RBI can do is that it can buy or sell government securities in the market. Now, what will happen when RBI decides to buy or sell government securities? Now, suppose if RBI decides to sell government securities, which means it will get more money from public, whereas in return RBI will provide the public with government securities. So, by selling government securities, you understand RBI, it is reducing the amount of money in the economy, that is, it is reducing the money supply. Whereas the opposite will happen when RBI decides to buy the government securities for the market, because if the government securities is bought by the RBI, which means the RBI will has to provide cash in requisite amount to public. That is, when public is selling their government securities to RBI and RBI is the buyer of government securities, it will mean that the cash levels in the economy will increase and so is the money supply. So, through open market operations, what the RBI does generally is that it buys and sells government securities in the open market with an intention to either reduce or increase the money supply. So, it is purchase and sale of government securities by the RBI. Option C therefore is the right answer. Now, you can see there are plenty of questions from the banking sector, and banking sector is one of the favorite themes based on which the UPSC always asks questions. Now, priority sector lending by banks in India constitutes lending to which of these sectors? First, let us try to understand what is priority sector lending. Now, whenever the formal banking system was established in India, particularly after the independence, the Indian central bank, that is RBI, it felt that there were many needy sections in the Indian economy which was not getting required amount of credit from the banks. Rather, what the government or the banks did was that it diverted its credit to economically more productive sectors such as industries, etc. And the RBI felt that there should be some sectors with which the banks should extend credit to so as to lead their developmental efforts. And these sectors were called as priority sectors, which means that every amount of money that the bank is extending in a form of loans, certain share of those loans have to be given to priority sector lending. And currently, 40% of all advances made by the bank, it should be made mandatorily to the sectors belonging to priority sector lending. Now, earlier these were agricultural sector, micro small enterprises, weaker sections, but nowadays we have seen increase in the ambit of priority sector, which means green financing or financing which you are undertaking to undertake development of renewable sector. All of these constitute priority sector lending. So, from our questions perspective, both ABC is correct. Therefore, option D, all of the above, is the right answer, as 40% of the advances currently, they are extended by the bank to the priority sector in general, and if the banks are unable to extend these many percentage of loans to priority sector, the banks are subjected to be liable to face penalties. Understood? Now, the balance of payment of a country is a systemic records of all import and export transactions which happen during a normal year. So, this is what balance of payments is all about. It is a straightforward question that whenever money going out of India, that is for payment of imports, or money coming into India, that is payment of Indian exports, these are recorded by the Central Bank of India as per the directions of the International Monetary Fund. And this is what the balance of payments of a country is all about, which records all money going out and all money coming in during a given period of time, which is particularly a year. So, option A therefore is the right answer. Now, we have understood what is balance of payment. Let us try to understand what is capital account. Now, all the transactions which increases your debt or increases your assets and liabilities are termed under capital account, and these capital account are with respect to money going abroad or money coming from abroad. Now, particularly these are transactions which are long term in nature. For example, foreign investors or corporates, when they borrow from other countries and other foreign related sources, these are termed as external commercial borrowings. These are example of transactions undertaken in the capital account, which are long term transactions, and they are transactions which either has an impact on assets or liabilities of the Indian players in the economy. These are the examples of capital account. Now, I have taken a screenshot from the NCERT which states the various heads taken into account under capital account. For example, foreign direct investment, foreign portfolio investments, these are example of capital account. So are external borrowings, which are loans both long term and short term in nature by corporate debt. Also, any external assistance which are provided by foreign governments or multilateral bodies like IMF, World Bank, these are also examples of capital account, which means if you are purchasing any assets outside, which means you are supplying dollars to it, that is also taken under capital account. And if you get any liabilities, which means if you are taking loans in dollars from the market, these are also included in the capital account. Understood? So, going back to the question now, foreign loans are example of capital account, foreign direct investment, portfolio investment are capital account, whereas private remittances, these are just one-time payments by people of Indian origin living abroad, and when they decide to sell or send money into India, these are just one-time transactions because they do not create any asset or liabilities in India, and hence private remittances are part of current and not capital account. So, third is incorrect, whereas first, second and fourth were correct. First, second and fourth, option B is the right answer to this question, because private remittances are a part of current and not capital account, whereas foreign loans, foreign direct investment and portfolio investments are constitute or they are a part of capital account. Now, which of the following groups are items included in India's foreign exchange reserves? Now, India's foreign exchange reserves includes foreign currency assets, that is dollars, pound, yen, Chinese renminbi. All of these are foreign currency assets held by the Central Bank of India called RBI. Also, gold, it is the second largest component of foreign exchange reserves. So is special drawing rights of IMF that India has, and India, like every other member of the IMF, is required to keep some amount as deposits with the IMF, which are called as SDRs or special drawing rights. Also, there are other component called reverse transposition. So these are the four components which are included in any country's foreign exchange reserve. So, foreign currency assets, gold holdings of RBI, SDR is correct answer to this question. Now, loans from foreign countries are not included in the part of forex. So, option A is incorrect. Loans from World Bank are not part of forex, and loans from World Bank also not a part of forex. Therefore, option B, which consists of foreign currency assets, gold deposits as well as special drawing rights, are included in the forex reserve, hence option B is the right answer. Now, which of the following grants or grant direct credit assistance to rural households? Now, first let us take into account of National Bank of Agriculture and Rural Development. This is a body which is responsible for refinancing. Now, what is refinancing? As this NABARD, it provides funds to banks, and it is the responsibility of banks to lend these funds to rural people. So, technically, the NABARD, it is not directly providing funds to rural people, rather it is refinancing the banks, which banks is directly providing the finances to people. So, NABARD is not directly providing credit assistance, hence it is incorrect. Whereas regional rural banks, these are examples of differential rural banks which have a very regional presence. And the intention of forming these kind of banks was to increase the credit in the rural sector, particularly with respect to small medium enterprises, with respect to agricultural sector. So these are responsible for providing direct credit assistance, and so are land development banks, as these provide direct credit assistance to rural people to meet their day-to-day needs as far as land and other related purposes is concerned. So first and third is correct, second was not. Option C here is the right answer. So this was all from my side as far as the prelims PYQ of the year 2013 is concerned. There are more videos in the section which you can see. There's a separate playlist for PYQs, and I will also be putting a composite videos of all economy related PYQs from 2013 onwards till the year 2024. And these PYQs, they are indispensable as far as your prelims preparation is concerned, because these PYQs give you an idea of how the questions have evolved over the period of time, how the recent questions have been asked or framed so as to apply your knowledge and not give the knowledge directly as was the trend before. So this is how you try to solve these PYQs, and it will be very essential for your prelims examination.
StudyIQ IAS, अब तैयारी हुई अफोर्डेबल।